Good morning, and I think we'll have some people still coming in, and I think you all experienced our friendly and efficient security as you came in the building, and there's still some people filtering through. We also have colleagues from the New York Fed who will be coming in and out throughout the day. And welcome to the Federal Reserve Bank of New York. My name is Per von Zelowitz. I'm the director of the New York Innovation Center here at the New York Fed. And it's a pleasure to be here at this incredible gathering of academics, innovators, industry and regulatory leaders at 33 Liberty Street. This annual innovation conference is a collaboration between the New York Innovation Center and the Markets Group and our research and statistics group here on the bank. The theme for this conference is finance at an inflection point. And this isn't just a phrase, it's an acknowledgement of our current reality. The rapid maturation of transformative technologies is moving us past an era of experimentation and into a period of real structural integration. Over the next 2 days, we're going to look closely at these trends. We will ask whether agentic AI is a simple market tool or a fundamental paradigm shift. We'll examine the mechanics of transforming law into verified code. We will tackle the development of prediction markets, public blockchain trade-offs, and the necessity of quantum safety. As we explore these trends, our work is anchored in a dual mandate: progress and safety. True financial innovation cannot exist without stability. Progress without safety is a risk. Safety without progress is stagnation. As we explore these trends, our work is anchored, or achieving that balance requires what this room represents: a commitment to convening, learning, and collaboration. The public and private sectors cannot operate in silos. We must build a shared understanding of risk and opportunity. And there's no better place to do this than right here, where innovation in the Second District is thriving. New York has always been the center of global finance, and please take time today to meet with the innovative young companies at the expo just outside of this room. They're examples of what's happening today and also what's next. Through the New York Innovation Center and events like this, we continue to serve as a bridge between the public and private sectors. And thank you all for bringing your expertise to the table. So with that, it's now my privilege to introduce Leanne Russell, the Chief Information Officer and Global Head of Engineering at BNY.
Good morning, everyone. Thank you, Per, for the invitation, and thank you to the Federal Reserve Bank of New York for bringing us together and convening this conversation, which I think, despite the last 3 years, is probably the most timely for us to get together. Innovation in financial services has always carried a particular responsibility. It's not possible for us to innovate in a vacuum. We innovate inside a system that people, institutions, markets, and economies depend on every single day. And that's why, as Per has said, right now, this AI moment feels very important, but also a little bit different. I don't usually quote Charles Dickens, but here we go. A Tale of Two Cities starts with a set of contradictions. It was the best of times, it was the worst of times. And that phrase really endures for moments like this. Moments of profound change never really come as one thing. They come as two things, or a set of things. And that's really what articulates this moment very well for me in AI right now. Because we're living through a moment of extraordinary promise, perhaps the most significant expansion of institutional capacity that we have seen in our generation. But it's also a moment that's going to demand of us some quite unusual discipline. Because in finance, speed does not exist in isolation. Speed interacts with trust, resilience, cyber, controls, governance, and actually confidence in the system itself. Because the question that we're here to dwell on for the next couple of days isn't, is AI powerful? It most certainly is. And it's not about who can move the fastest. The real question for us is, how can we make this acceleration responsible, the governance scalable, and human judgment more integrated, not less integrated, as this technology is becoming more powerful? And that's the tension I'd like us to explore today. How do we capture the promise of AI without creating a new fragility? How do we move with speed without losing coherence? You'll hear that word from me quite a bit this morning. And how do we build institutional learning that's not just automated, but is more capable, more trusted, and more resilient? And for me, the answer to that is responsible acceleration. We need to be fast enough to matter, but disciplined enough to last. 3 shifts are making this transition especially important: the pace, the shift to core infrastructure, and completely redefining how work gets done. Let's start with pace. Innovation cycles used to be measured in years and months, and innovation cycles are now measured in weeks, and I have seen more recently minutes. So when we think about a large-scale transformation, we start with a model, a workflow, and a use case. That's how we've always done things in financial services. It comes with great opportunity, but it also comes with real complexity. We've always built our transformations this way, around sequencing, of strategy, of planning, of controls, of delivery. But AI adoption does something very different to transformation. It completely compresses that cycle of idea to innovation. And when that tempo changes, we have to completely change our operating model. Now, secondly, when AI, for the last couple of years has been talked about of a lot of use cases, but what AI is doing today is becoming core infrastructure. We're not looking at pilots or innovation labs anymore. We're looking at AI becoming the actual architecture of financial institutions alongside data and controls and operations and client platforms. But you'll never be able to scale AI just because the technology is powerful. You'll only be able to scale AI when you have the foundations in place, when your data is high quality, your architecture is resilient, and our governance is embedded into the systems themselves. And that's where coherence really matters. And that's that word, coherence again, because in complex institutions, coherence is what really turns experimentation into capability. Without coherence, you're just going to get pockets of innovation. With coherence, you're going to get institutional capability that scales. And then third, where we are today with AI, is work itself being completely redefined. We're not just accelerating individual tasks anymore. We're reshaping entirely how work gets done, redistributing the efforts, enhancing workflows, and just supporting the decision-making process. AI is increasingly becoming an active participant in this process, not just a tool that sits on the side. So when AI becomes embedded in all these processes, the conversation really needs to change. It's not about what the model can do anymore. It's about how does this institution completely work differently? How can we make decisions differently? How do we govern differently? How do we train our people differently? And how can we create a system of trust in our sector where humans and machines are going to increasingly work together? Those are the key questions that I think is really important for us to answer over the next couple of days. That's the moment that we're in. AI accelerating faster, becoming foundational, and changing the nature of work itself. And that's why I believe for us in financial services, we can no longer just talk about AI adoption. We have to talk about accelerating this adoption with institutional scale, with trust. And for us, trust is not a slogan. At BNY, trust is core to the relationships that we have built for now over 242 years. It's what gives our clients confidence that their assets are safe, that can move efficiently when needed. And trust sits at that center of managing assets, raising capital, settling transactions, and helping institutions through volatility and change. This is why I keep saying that AI is not a technology development, but an institutional capability. So a little bit about what we have done at BNY. We did not have AI as a side experiment or a collection of pilots. We decided, as a systemically important institution, we could never just say, what do we use this technology for? We had to say to ourselves, how do we make this safe enough, trusted enough, and useful enough to become how BNY institutionally operates? That required us to lean in early, and thanks to our CEO, Robin Vince, and every single member of our 20-person executive committee, we moved very quickly from AI curiosity to AI adoption, and from adoption to scaled enablement. For that entire capability, we look at our system, which is called ELIZA. Now, ELIZA is named after Alexander Hamilton, who founded BNY 242 years ago. She was the wife of Alexander Hamilton and a philanthropist in her own right. And ELIZA is our enterprise AI platform. ELIZA is how we bring third-party models, data, workflows, controls, and governance into a single system that makes AI usable at the bank, but also governance embedded and scalable. Because when you're a complex institution like us, you can't have fragmentation. It's completely the enemy of trust. So with ELIZA, we had to say, how do we systemize and use experimentation to get what we now have today, which is scaled intelligence? And we made 3 deliberate choices in building out ELIZA. We said we were going to put people at the center, that we would build enterprise infrastructure, and that we would put in governance embedded into ELIZA from the very beginning. And when you look at BNY today, every single one of our employees at the bank are trained on ELIZA. 60% use AI every single day, and about the same amount have built their own agents. That's just not usage statistics. That's evidence that trust is being expressed through behavior. People don't adopt technology just because it exists. They adopt technology because it helps them do their work better. And today, we have more than 290 enterprise-grade solutions of ELIZA touching almost every single thing that we do at the bank, whether it's predictive analytics, anomaly detection, payment processing, reconciliation, or code remediation. AI is fundamentally changing how work gets done. But we had to make sure that our workforce grew with that capability. And that's why the most important thing that we did, and the very first thing that we did, and the only thing that we measured in the early days of AI, was learning, development, and adoption. Helping every single employee at the bank have confidence, judgment, and fluency in an AI-enabled world. Because we really do believe that AI is creating capacity, but we still firmly believe that people are creating value. So if we take some examples relevant to this room, for example, cross-border payments, 5% of cross-border payments fail every day, usually just because a piece of information is missing or absent. So that just sounds like, that's an ops issue. But when you're BNY and you have $59 trillion under custody, asset, and management, and $2.5 trillion of payments moving through the bank every single day, small frictions like that become compounded into manual work very, very quickly. So we developed an AI solution, a digital employee, we'll come to that in a moment, that automates part of that repetitive repair process. And today we are 75% faster at repair times. And this has really freed up our people to work on more complex, high-impact cases where really human judgment makes a difference. And we see the same pattern everywhere in those 280 solutions. 25% of new client onboardings were AI assisted this year, and we did those 20% faster. Settlement inquiries are handled 80% faster year on year. And in my own organization in engineering, today more than half of the code at BMY is written by AI. That's not productivity for productivity's sake. The whole point is about capacity, the ability to know more, move faster, and really direct our human capability towards higher value work. The next choice we made was to build AI as a platform. ELIZA is a completely centralized platform where we bring everything together, not just the technology, but our data scientists, our engineers, our machine learning capability, our business, all in one place. That has allowed us to innovate without becoming dependent on any single model provider. We use OpenAI, we consume Gemini, we consume Claude, we consume open source models, and we bring together all of that expertise into a single enterprise-grade harness. And the final principle that we developed our AI strategy was around AI was governance not being a brake. Governance is really what makes scaling possible. If you add governance as an afterthought, it's going to completely slow your processes down. If you bake in governance from the very beginning, the governance becomes the runway. It gives people the confidence to move faster because they have the controls, the testing, the accountability, and the oversight as part of the system. And that's what we saw when we built our very first digital employee, and we now have more than 150 digital employees at the bank. Digital employees are fully agentic, multi-agent models that have their own login, they have a human manager, they're capable of learning, and they can communicate via Teams or email. I will say building digital employees wasn't really the hardest part of that effort. The hardest part of that effort was designing, testing, and validating a governance model that could make digital employees sit alongside our human employees and move together at once. And this is really where we are today in this phase of agentic AI. In our industry, the question has never been, what can we do more of? The question has always been, with our AI institution, under what authority does this digital employee system act? With which boundary conditions? With which evidence? With which escalation path? And with which human accountable? Now, we describe these digital employees as our key capabilities, but even that phrase of digital employee was very intentional. Not because digital employees are people, they most certainly are not, and not because they replace human accountability, they absolutely do not. But because once AI becomes a participant in the workflow, you need to have the same institutional discipline around a digital employee as you do a human employee. Every digital employee has a job description, has a set of permissions, a set of boundaries, an audit trail, an escalation path, a human manager. You can find all of our digital employees in our company organizational system, and they even have a performance review. Because that's where the control principle really matters. We did not reduce the need for control, and AI doesn't reduce the need for control. It raises the standard for control. And in high-scale environments like payments exception or reconciliation, where these small inefficiencies compound quickly, AI has allowed us to remove friction, not just task by task, but we now have removed friction from the level of workflow itself. And the more capable these systems are becoming, and as you know, they're becoming very capable very quickly, the more disciplined our institutions need to be to manage traceability, oversight, testing, and accountability. And that's where the paradox of agentic AI lies. As the technology becomes more autonomous, and it is very quickly, our institutions must become more accountable. And I'll just focus on 3 particular agentic capabilities that are very pertinent for the financial services ecosystem. Financial services risk at a system level, cyber, of course, and labor. In financial systems risk, AI is introducing new dynamics to markets and market infrastructure. If we begin to use similar models and similar speeds, then speed and correlation become new risk variables. And we have to understand not just what the models do in isolation, but how our models are working together across a connected ecosystem. The second is cyber. And in a mythos, post-mythos world, cyber can be definitely increasing our defensive capabilities. We are using mythos and tools like that to help us detect, analyze, and respond to threats with greater speed and sophistication than I have seen in my lifetime. But the same technology is also available to the attackers. So cyber becomes another place where we see that contradiction of 2 things at once. Defenders becoming more capable, we certainly feel more capable, and attackers becoming more capable too. And one thing is for very sure, you cannot fight an AI cyber attack in human time. And then, of course, the most important and final point is around labor. AI is undoubtedly creating capacity in all our firms, but that will not be distributed evenly. Some work is being augmented, some work is being completely redesigned. Some roles will completely change in a very significant way. So our challenge as institutions is not to only create productivity, but to ensure that productivity translates into opportunity. Opportunity for redeployment, reskilling, and higher value work across the entire financial workforce. And I will just say, I've talked a lot about governance, trust. I don't actually think these are arguments for us standing still. I just think these are arguments for us building the right operating model with discipline, transparency, and engagement amongst all of our institutions, our regulators, our market participants, and our technology partners. So I'm just going to close with a pragmatic view of where I think we can go from here. There's not any one of us in this room who are going to be able to predict the shape of the financial services industry in coming years. This landscape is evolving every single day. But when the map is unfinished, the compass becomes more important. And I believe that compass has to be responsible acceleration. Again, it doesn't mean moving slowly, and it doesn't mean moving recklessly. It means moving with enough speed to capture the opportunity ahead of us, but with enough discipline that the system we serve is protected. And that requires us to be institutionally ready, and not just technology. And the differentiator will not be who has the best model on any given day. It will be how well your institutions align talent, operating models, risk frameworks, and governance to absorb the challenges that face us. And that's why that word, coherence, became my word of 2026. I'd like to say, and I do say to my organization very oftenly, build it once, but build it well enough to evolve. And as AI expands, the role of us as people, as leaders, and as frontline expertise really actually becomes more important, not less important, because suddenly we can process information really quickly. We can detect patterns and move faster. But as people, we still have to decide what matters. We still have to understand our clients, we still have to exercise judgment, and we still have to carry accountability. None of us will be able to change this future alone. The future of financial services will be shaped collaboratively across the banks, academia, the regulators, technology partners, and the broader market infrastructure. And perhaps that's where Dickens can help us once more, because this whole era of AI is full of contradictions. That extraordinary promise paired with real responsibility, this immense speed that I've never seen in my lifetime, paired with unusual discipline. But I'm going to say I'm an absolute optimist. I really believe on the best of times, worst of times, as Dickens quoted, this is really going to become the best of times yet for financial services. Because if we do AI really well, AI is going to help us realize a financial system that is more capable, more resilient, and more adaptable to the future than it ever has been in our history. Thank you.
Thank you, Leanne, for these insightful remarks. Now we welcome Sung Lee, Deputy Associate Director at the Federal Reserve Board of Governors, leading his panel on, is agentic AI a tool or paradigm shift for financial markets?
Okay, let's, everyone can hear me? Great. First of all, terrific keynote by Leanne there. And also, to start things off, big thanks to the organizers. I kind of know how this conference was assembled, and it's quite a feat. So congratulations, organizers, on this setting up this conference. I'm Sung Lee. I'm at the Federal Reserve Board. I oversee what's called the Financial Stability Cyber and AI Solutions Lab. May have the hardest job at the Fed because I have to innovate and also think about financial stability. What I'm going to do here today to start things off is quickly introduce the panelists, our distinguished panelists, and then kind of start things off by kind of asking some of the panelists to set the scene here. So we have Tanya Babina from the Smith School of Business from the University of Maryland, Stefano Pascali from Doman, Greg Rupert from FINRA, and Craig D'Souza from Palantir, and last but not least, Carolina Belwell from Citi Wealth. As you can see, a very diverse group of people. So we just heard about Dickens and Eliza and Hamilton, so I'm going to start off with a quote by James Madison. Ambition must be made to counteract ambition. And there's so much going on in AI these days with kind of the opportunities and risks and vulnerabilities. It's really, you can't understand the risks of AI without understanding the benefits of AI, and you can't realize the benefits of AI without understanding the risks of AI. So with that said, we're going to start things off by first going to Craig here from Palantir, and you are a forward deployed engineer leading Palantir's financial services business. First of all, for those who may have heard this for the first time, what does the title mean? And then please go through and define agentic AI for us, and also kind of go through what you're most excited about regarding what it can do.
Absolutely. First of all, thank you so much for asking us to be here. Very excited to talk to you about what we're doing and what we see the opportunities with agentic AI. So to start off, for us, what forward deployed engineering really means is that we exist to deeply partner with our customers and with organizations we work with. And what that means is that we are looking to understand what is it that uniquely differentiates them from other organizations and their competitors. And our job is to determine, okay, what is the software, what are the solutions we need to build and deploy for them so that they can continue to lean even more into that differentiator. So what gives them that competitive advantage allows them to maximize the value they can generate from that. And we've always been heavily focused on outcomes and what works in the field. Is the thing that we're building for you, is it working for you? Is it helping you make better decisions? And if it's not, let's course correct. That quick iteration has always been very important to the forward deployed ethos for us. And then the other part of that I think is equally important is because we are always in the field, we're looking at what is working, what is not working. We're taking those learnings back to then build compounding product investments that become part of the core offerings that we have, so that the next time a forward deployed engineer is trying to build something for a customer or a customer engineer themselves is trying to do it, they're able to get to those outcomes much more quickly because they have the learnings from past experience, past product questions that we've run into, and can further the boundaries of what our customers can accomplish. As far as agentic AI is concerned, like obviously there's the kind of standard definition for that, which is it's an AI system that is able to autonomously move towards an outcome or a goal that you've set for it. And in order to get to that outcome, it is able to use a defined set of context or tools that you've given it access to. And so this is different from traditional kind of LLM request response interactions that we've had, where you have to prompt it to get to the next level. This is really about it using its reasoning capabilities to be able to move autonomously to the next step. I will say the couple of things that we have seen that are critical when it comes to whether agentic AI is actually providing a lot of value within the organization. One is obviously, do you have the capability to kind of dial up and down what the amount of autonomy that it can have in a system? When does it bring in humans? When does it bring in other agents? The ability to have that control and also to be able to then hand off in a secure and consistent way to not just other agents or sub-agents that you might be running within your organization, but also to humans, where it makes the most sense to be able to do that. And then finally, to your last point, the things I'm really most excited about with agentic AI is just all of the opportunities that we are seeing in order to be able to just augment the operators and the people who are doing day-to-day jobs at a lot of these institutions. Just like being I like to say, like it's about giving them the Iron Man suit to be able to do an even better job than what they do today. And we're seeing this across a lot of our customers, whether it's agents working alongside relationship managers and advisors to be able to, in real time, understand, okay, what is the risks for my customer? What are the opportunities that exist? And how can I work as a team to be able to action those opportunities or mitigate those risks? Or in an industry as old as mortgage, across the entire operations of mortgages, how does an agent kind of run ahead of humans and gather whatever information, whatever context is needed, so that somebody who's servicing a mortgage or who's underwriting it or who's working with a customer on actually onboarding them, can we give them all the information they need so they can make the best decision that they possibly can? And they can kind of delegate a lot of the tedious and what has traditionally been labor-intensive work to systems that can accomplish that much faster than a human can, while the humans can focus on those really precise and very high-fidelity decisions where they can bring their unique expertise and intuition to apply to those situations.
Thank you so much. That was a great introduction at the micro level. We're going to go really to the macro level now. And the next question is for Tanya here, who's an associate professor at the Smith School of Business, studying the economic impact of technological change on firms and workers. I personally love going to your annual AI and Finance conference, so big thank you for organizing that regularly. So I was wondering if you could kind of leverage both your research and also kind of the literature in general in terms of what you're seeing in general about how AI is impacting firms and whether you have any insights regarding agentic AI.
Yeah, well, thank you so much for having us here. So as I mentioned, I am a research professor. I try to understand how new technologies affect firms, workers, and financial markets more generally. And to give you like a broad overview, in 2019, early-ish, I got really excited about this new, shiny, very promising technology, AI. What it is and what it does to firms, how firms operate, to workforce composition, who's getting hired, who's getting fired, and how that affects risks of financial markets in general. I do empirical work. For that, you need to have comprehensive data, right? Anecdotes are great, but us researchers, we need data which consists of many anecdotes, many firms, many workers, et cetera. And I was trying to figure out where to get data on firm investments in AI, which didn't exist. I tried many different things, and it turns out one of the methods to see what firms do with AI is seeing if they hire AI-skilled workers. So if you see that Citi hires machine learning engineers or agentic system developer, we know they're trying to do something with AI, right? So our measures for, it's a very comprehensive thing, all firms in the US, from all data from LinkedIn, about 2 billion people globally, very good coverage. So we have very good understanding of what US firms, who they hire for AI, and what they do with it. So early development of AI, 2010 through 2020. You might or might not know that AI existed before ChatGPT. What we found, firms actually in that period already benefited from investing in AI by growing sales, and their market valuations, smart investors were figuring out, using our data and other data, who is investing in AI. So during that period, firms' market valuations already adjusted for this AI investments capability. And interestingly, there was no labor replacement, and actually firms increased employment in that period. So over the past year and a half, I've been rebuilding this data literally through now. So what are the new insights? From research, it's not even public. So by now, if you look at US public firms, which is our core sample, 2% of all employees within public firms across all sectors are doing something with AI internally. That's huge if you think about it, right? Like if you think for comparison purposes, 0.5% of people in the US are medical doctors. So 4 times people of that doing AI. So there is relocation from people who did coding to people who implement AI within firms. And if you look at, so we also introduced measures, are they doing all the AI, machine learning versus new AI, agentic AI versus Gen AI, you see that about 0.5 percentage point of people doing the new AI. But what's really interesting is that all of these investments are very cumulative, which is, resonates with what the keynote speaker said, which is firms who are ahead of AI in terms of you just rank firms, how much they invest in AI in before ChatGPT period. Firms who are ahead are 3 times much more likely to jump on these new technologies, agentic AI, and drive growth through it. Now, what's really changed in terms of impact, firms still grow sales with AI, I think past 5-6 years, but employment is flat now. I mean, good news, I guess, we're not losing workers yet, but it's not, employment is not growing at the same rate as sales. So firms make more money with the same amount of people. What that mechanically translates into is improving in productivity, right? If you make more with same amount, you are increasing productivity. So that's one of the exciting things, because you might or might not know, economists are excited about productivity because historically that's what drives growth, improves standards of living and stuff. So I guess the agentic AI and the generative AI over the past few years really kind of impacted firms' ability, improved ability to operate more effectively and efficiently.
Thank you so much. A very, very kind of high level and macro level description there. Really appreciate that. And we're going to go straight into kind of real world applications. Next question is for Carolina, who is the head of data intelligence and automation for Citi Wealth, and drives the strategic vision for all core Gen AI and agentic AI initiatives there. Can you discuss the recent kind of application that you have developed called Citi Sky, which is basically an AI advisory assistant I know that publicly you have mentioned that it'll be out to clients by the end of the summer. And so what is the goal of this particular product, and what benefits have you seen so far in kind of your process?
So this is something that we're super excited about, and we're working closely with Google on this. We announced it at their Google Next conference in April, and then we talked about it at our Investor Day. So this is a huge step forward in terms of the type of experience and the type of service that we can provide to our customers. It is also a huge step forward in terms of how we can actually support our financial advisors as they service our customers. So this technology, agentic AI, conversational AI, Sky is actually, it's not a digital twin, but you are going to interact with AI that has a face that looks realistic. So this technology allows us to think differently about how we service our customers within the US. It is meant to supplement our advisors. Our advisors today, within our Citigold wealth business, they have a very large client portfolio. So they interact with the customers, but they can have up to 1,000 clients at the most sort of extreme end in terms of the number of clients that they're supporting. And there are certain conversations, certain timings that they have with the clients. The thing with the clients is that a client may have a question in the middle of the night. They may be reading the news, it may be 10 p.m. Your advisor probably will not pick up at 10 p.m. if you call them. I'm sure there's exceptions to that. But this allows us to service our clients, to be able to answer questions for them around the clock. And it connects back to the advisor directly. So it is an AI-powered member of our team. It does not replace people. It supports them. It allows them to have greater scale. It allows us to enrich the experience that our clients have. And the technology is very immersive. It feels a lot different than the kind of technology that was available before. So you really can create a value-added, immersive, rich experience that supports your overall business and that helps your own employees as they interact with your clients. So it's very, very exciting for us. And we have a strategic partnership with Google. So this is part of that effort. We're working very closely with them. We're working with their DeepMind team. So it's very exciting across the board. And we're really, really excited about how this is going to transform the experience for our customers.
Thank you so much for that real-world example to kind of also contribute to this panel. Next up, I do want to shift the focus a little bit in terms of kind of sovereign AI topic. So next, Stefano, who's you are Executive Vice President at Domain, and I've personally known Stefano for a few years, even when he was at BlackRock. I really enjoy reading your papers, so please continue with the great research there. But it has been a journey for you. You now kind of are working at Domain, kind of with sovereign AI, especially explainable AI techniques. Can you kind of go through that journey for us to kind of, yes?
The journey, thanks for inviting. Yes, we've been in touch for many years now, and I'm happy that you continue these conferences that are a good moment to share ideas and connect academia, business, and regulation. That's very important. The journey was that before in Bloomberg, I was working on liquidity model. In BlackRock, I was building all the liquidity and trading model, or the routing. I was leading a team called Investment AI. And I learned that building the best possible model can go for linear regression to machine learning model, NLP, early stage NLP to generative AI is not necessarily enough because you need to build a model that you can control and understand because then use the model for mission critical application. Everybody get excited about the efficiency we can have from home using AI to summarize a document. The most likely we know the topic. So if I take 5 hours to read a document, in 2 minutes, ChatGPT can give me a summarization. I spend half hour to find the correct error. I still gain 4.5 hours. Usually many conferences I go, still on trading, I ask people, raise your hand if you use AI today. Everybody in the audience raised their hand very proudly. When I ask, raise your hand if you trade $50 million corporate bond based on agentic outcome, nobody raised their hands. And so the opportunity was to join Domin and building this on the foundation level, from the platform, the tech stack. We are investing a lot in data center. So the idea is to provide a full vertical stack from chip to user experience. But most important, sovereign AI is sometimes confused like I have the model in my own data center. I own the GPUs. For sure, segregation, air gap in infrastructure is important, in particular nowadays, but it's more about being in control of what the model does. I learned the hard way that we got very excited when ChatGPT exploded. Personally, I read that attention is all you need 1 week after it came out, so ages before ChatGPT. And we are dealing with the probabilistic model, trained on data that somebody else select. We don't know how, we don't know where. They train a model in a certain way that we don't know how, we don't know where, and now we're delegating our institutional, company, corporate intelligence workflow to that model. Personally, I think this is not a sustainable model for business, for financial stability. And so I think the LLM is not having LLM talking with data. We have the problem that, first of all, we are leaking information about our data to an external environment. And second, we are not in control of this. So one thing that we invest a lot of time in our sovereignty endeavor is as well to provide, to find a way to embed company knowledge inside agentic reasoning. Let's not forget that a larger corporation, before Bureau's being well represented, I come from BlackRock, 80% of the know-how of this company is the real thing for business. And that 80% most likely is not even in the training of large language model from the hyperscaler, one. And second, you don't want to do that because it's our own strategic advantage. So how do we embed this thing? We learn about system prompting techniques. We all realize that never works and not scalable. So I think now it's becoming very, very evident that personally, we develop our own knowledge graph technology to embed the institution knowledge. So now we combine institutional knowledge with the large language model, can be segregated, so you have full air gapping, and now I think that's the recipe to obtain the right level of sovereignty. For us, we believe that the large language model, we have our own model. 3 days ago, we won the commitment from the European Union, from Project Europa. We're going to be the one leading a consortium to build the open source public European large language model. So 3 days ago, we got this amazing news. But we still believe that the large language model, public, private, fine-tuning house, are 20% on the entire movie. If you don't have a way to embed the institutional knowledge, to orchestrate in a safe and traceable measuring trajectory on the reasoning, and then doing governance on those trajectory in order to evaluate how your model behave, agent behave for your business application, I don't think you will never be able to rebalance portfolio using AI. I personally can use from home an agentic AI system to have advise how to rebalance portfolio. First of all, we know that we switch off the laptop. We open the laptop, half hour later, we do the same question. We're going to have a different answer. Very similar, but still different. So how are we going to do regulatory reporting based on this probabilistic outcome? So I think that one is the paradigm we are focusing quite a lot. And last, when we make these black boxes, it's impossible to make these black boxes white boxes or glasswing boxes, but at least we can make this some shade of gray, have more control. It's important to have an evaluation framework that we can discuss later about how do I score every step of the process in order that the final user, the human being in charge that Leanne Russell was mentioning before, now I have a lot of information process, a lot of reasoning that I didn't control. I have some telemetry. How do I trust the outcome? So I push the button, or I let the agent operating and moving $50 million on a trade. And that one is a part of, we call internally AI Sentinel, hyper-paranoia about governance, evaluation, trajectory, measuring hallucination, biases. We have 17 papers in 9 months, only with Domin, plus the one I published with Becco, exactly because as a joke, we say that we spend half of the time building solution, half the time destroying them. We did a lot of jailbreaking, red teaming, and then the direction we're taking now.
Thank you so much for that perspective. And I feel like what I said earlier, ambition must be made to counteract ambition really applies here. Again, thank you for that perspective, and please continue with the great work. Next, last but not least, Greg, you're the Chief Regulatory Operations Officer at FINRA. So you have kind of, I think, a great vantage point in terms of the use cases that the financial industry has in terms of AI and agentic AI. Can you actually kind of go through what you see in terms of the meaningful agentic AI applications that you see these days? And also, please feel free to expand on your January publication regarding AI agents.
Sure, no, thank you. Thank you for having us. The unique value of a self-regulatory organization that FINRA has is we not only have the traditional regulatory oversight responsibilities around doing exams and investigations and enforcement, but also we have the ability to connect directly with our members and seek that type of two-way sharing of information. So we've embarked on a number of initiatives around kind of the current technology moves. We have large firms like Carolina's that's very innovative, all the way down to very small or almost like a mom and pop or single advisor firms. So we see the range, and then from the types of firms, we see everything from what you would normally think about with the stock market of a retail-based firm to clearing firms, as well as others that are producing products and selling items to those firms. So given that range, we do see a lot. So we published a few years ago the generative AI use cases, and we did it as an infographic, and it's available on finra.org. But we have 14 use cases where we're really trying to unify the nomenclature that, one, regulators are using across the space with the firms, so that we're all kind of looking at it in similar directions. And then we recently shifted and created one related to agentics. And so we were seeing agents being deployed. And as you see how fast this area is moving, we are constantly in touch with our firms to keep up on it. The big areas around the agentics right now are process automation, process optimization, getting into the conversational agents, but then now also we're seeing it move into automated surveillance of markets, of trading, of AML, of fraud, and then we heard the keynote speaker talk about cyber and cyber-related fraud. So we're seeing it in all of these different spaces. The risks are what my colleague here just said, that you would see as traditional model-type risks. To go kind of more granular, we're really trying to require a thought process around having a good governance, and that governance necessarily just isn't the old scale governance when we think about new products and or just technology products, but really bringing in a host of people around your firm. So it's not only technology to understand kind of what's being built or purchased, not just legal from what are the general legal risks, but you want to bring in somebody from probably your vendor risk area, because a lot of products that are either having specific AI capabilities, you have a vendor component to that, but we're seeing now traditional vendors that you've had for years add on a related AI tool. So we started talking about fourth-party risk. As of yesterday, we're now up to fifth-party risk. So really tracking that life cycle of the relationship. And then you get into your privacy concerns. You have your cybersecurity related concerns, so you would want your CISO involved. And then we're seeing huge amounts, we'll talk later, about fraud and adversarial use. So your fraud officers, potentially your trade surveillance or your anti-money laundering officers in the room. So it's a much larger governance than you've ever had before in this area, because you start to see different things. So when we think about kind of nuanced risks related to it. If you turn your agent on to go out and say, what is the applicable rule set related to this activity that is put into the chatbot feature, we've seen agents go out and they grab the entire history of every rule from every industry and maybe even globally. So right now we're running on T+1, so trade date +1. We've seen models come back with decades old T+7 rules. So trying to figure out what is the corpus that your agent is going out trying to define the rule book. And then just even how you have coded your chatbot to interact with your clients or your investors. So if you say you want it to be friendly and provide friendly advice, does that advice leave the realm of just making a black or white decision? So in one instance, we saw the portfolio balancing tool saying, does this portfolio match what this portfolio ideal balance should be, right? Very, very simple, yes, no. But the agent, the way it was coded was to provide friendly advice, and it made a recommendation of, you really should consider rebalancing your portfolio and buy this stuff instead. So tracking it of not only how it's designed, how it's then interacting, and then what does that output look like. So the full life cycle of what we've been doing throughout the years with kind of technology, initially model risk, and then now with your normal generative AI, it just speeds up now with what we have to think about with agentics.
Yes, thank you for that perspective. I think it's really important to kind of have a balanced view. Actually, it's the capabilities are so incredible. Like we kind of already seeing kind of you kind of have to look at the benefits and risks almost simultaneously. But we're gonna kind of dig a bit deeper into what the concerns people have, what we should be careful based on kind of experience. So going back to Craig. Let's start with you from a technical deployment point of view. Can you kind of describe some of the things that you think that people should be aware of, be careful about?
Yeah, for sure. I think as large language models and AI systems get more and more capable and they are able to do increasingly complex tasks, there's a tendency to kind of think that they can solve pretty much anything. It's like, I'll just use the agentic AI system to solve this problem. I think that's not necessarily the right way to go about it. We, as humans, we should continue to be very, very skeptical and very realistic about what are the problems that I can solve with agentic AI, what are the problems that are just not suited for that and can be best solved with deterministic models or rules that are grounded in determinism. So that healthy amount of skepticism, I think, is going to be really important so that we are getting maximum value out of agentic AI and LLMs. And then the other part I will say is that, like, this has been mentioned a bunch of times, that governance layer, the observability, the ability to do testing and evaluation, those are going to become increasingly important as these models get more and more capable because it allows you to ground in reality and in confidence. As the systems evolve, you are able to go back to what is the ground truth, what works, what doesn't work, how do I incorporate new versions of these models and agentic AI systems, but still have full confidence in how it's performing against the objectives that I want it to perform against. And so those couple of things are going to be really critical as these systems continue to evolve.
Thank you for that insight. Stefano, actually, do you have anything to add there? I know you work with a lot of different models simultaneously, for example, in the same like agentic AI system, et cetera. So anything to add in terms of, based on your experience, what I think people should be aware about or kind of be careful about?
Maybe going random in the many things I can say, but one is trying to make the workflow that the agentic need to replicate as much deterministic as possible. You can do that, still gain advantage and benefit from using large language model. One thing that we talk about generative AI, but we forgot about machine learning and traditional AI. I didn't forget about that. There is a huge opportunity. Actually, we're doing a lot of research on this to build more model based, first of all, on causal analysis, counterfactual analysis. So finally get out of the world of dealing forecasting financial market based on correlation. So we are doing a lot of this new type of analytics based on machine learning. I go back to the paranoia about governance, transparency, be aware that a powerful machine can be very dangerous, black box. So we published many papers last year. One, the most funny one, based on data, as I would say before, not anecdote. We tried to replicate a trading agent. We provide to several LLM, public one, including our one, a lot of financial data, risk exposure, historical series, SEC filings, fundamentals, everything. We ask the question, which is the best investment between Tesla and Microsoft? And the agent answer with 2-3 pages of analysis that I wouldn't be able to do such a deep analysis, very, very competent analysis after 20 years and plus in finance, explaining why Tesla was the better investment than Microsoft. And I would have believed this in and out all the time. Same prompt, you invert Microsoft Tesla, is telling you Microsoft. And we published a paper last July on this, on positional. And this is one of the many effects of negative effect of transformer about positional bias, tend to be biased on the first entity mentioned in the prompt. So if you think in financial services, 90% of the questions we ask to our analytics, old-fashioned and AI in power, are relative value analysis. So now if we're under the fundamental risk to confuse, to choose the first one because just the first one, is an example that why to raise the alert that we need to do much more governance, traceability, harness, and groundness on this.
Yes, I mean, similar to what you just mentioned, I also have a paper that kind of switches off kind of a red signal for a bad signal and a good signal, and it really confuses the LLM. So really, that resonates with me personally. Carolina, kind of anything to add there? I know you have to really think about governance and et cetera, transparency, et cetera, but anything to add to what Stefano said?
So we spend a lot of time thinking about governance, and we're a business of trust, so how we build is very, very important to us. As a practitioner in the space, one of the things that I've noticed personally is that a lot of people are touching AI outside of work, and they're reading about it. And so they're interacting with it, and they're forming a set of expectations, and they're forming a terminology. For example, everyone now, I think in the last 6 months, is calling everything an agent. So prior to 6 months ago, let's go a year back, that term had a highly specific meaning. It's the one that Craig defined at the beginning. That is the meaning of an agent. But right now, it is really being used when you talk to people across the business, across sort of your life. It is being used to refer to anything that calls out to an LLM or anything that leverages an LLM. It's really important when you're building with it and you're a practitioner and you're building with it for scale to understand exactly how you're using these terms, because the way that you define what it's doing determines the level of governance, the level of sort of systemic support around that key activity that you're building in order to get the outcomes that you're targeting. So you want a certain set of outcomes. You care about trust, so you're going to be very responsible. You're going to govern, you're going to observe. So the way that you define those terms and the way that they're used to talk about what you're building is incredibly important, especially if you're working across a large company, because you want everyone who's touching it, building with it, to understand that these are the requirements if this is the specific thing you're building. These are the requirements if this is how you're using it on this end instead. So that's been incredibly important.
Yes, the kind of the need for precision around definitions, tools, and rules also definitely resonates with me and hopefully with the audience as well. Greg, as part of a self-regulatory organization, can you kind of just lay it out there? Some kind of additional important risks to keep in mind. In addition to what others have mentioned so far?
I'll break it down to kind of 3 top ones we're concerned about. And the one is really the vendor risk that I alluded to earlier is, are we tracking not just the AI specific vendor, but all of the other vendors in your firm's ecosystem that provide or could in the future provide AI level services? And then what are the dependencies throughout that life cycle? So we've started, we have a new initiative for our firms that we're monitoring a set of vendors, specifically in the cyberspace, for potential risks that are happening outside of the firm's ecosphere, maybe happening to other companies or other firms, and we're proactively reporting that out to firms to say, we're seeing something that is a heightened risk. Are you aware of this, within your systems? Then we're starting to get into how do we start leveraging the bidirectional sharing between firms, because I think we have to start working as an ecosphere in this space. Everybody is using very similar either processes or services, and again, we can share kind of that risk oversight together and being able to feed that back. So we've created the Financial Intelligence Fusion Center for our firms that is, again, a bidirectional way to share what's happening, and that really starts to dive into the adversarial use of AI, that is all of our old famous frauds and risks, from financial to cyber, and down the path. But what we've seen is a proliferation of criminal actors, criminal organizations, really understanding more sophisticated areas of financial markets. So the old days was just figure out how to wire that money out, get access to it and wire the money out. We've now seen them move into the areas around market manipulation. Now they're able to then target individuals and get them under the official term FOMO, fear of missing out, to drive in and do trades related to low price securities that they actually already have control of. And so there was the kind of classic pump and dump. So if you used to imagine or used to watch the older movies, that it was that boiler room and it was a bunch of registered brokers convincing people to buy stuff that they otherwise didn't know what they were buying. We've now seen that move outside of the broker-dealer space, but even offshore. And so investors are coming to markets, usually in self-directed accounts, and making those trades. And it's really AI that's leveraging the capability to identify the victims ahead of time, identify kind of which securities, and then really build custom marketing materials and then fake websites. And then they're able to impersonate all kinds of financial experts or luminaries, from anybody that's on TV all the way down to really reputable firms or investment advisors, and being able to personalize that. So we're tracking all of those types of activities. We just published an alert for investors that's really tied back around deep fakes and phishing. So it's either on our website, it's on my LinkedIn page, as something for people to be watching out for, because it's, while those of us that are in industry, we've seen similar type activity, the proliferation and speed of which AI is able to allow our adversaries to do this is much like the keynote speaker said. It's something that they are getting fast just as we're getting fast. So it's again, it's something to be ever vigilant against, and something that we're focused on.
Yes, I have to admit, yes, a little scary the deeper you go into this. And I think the first step is awareness. So thank you for kind of laying that out at the end there. Last but not least, Tanya, please bring us home in terms of kind of the big picture, what kind of you want people to kind of be aware of from your perspective, whether it's concerning the financial system, economy, or even the labor markets.
Yeah, so one of the things that bothers me a lot is fear-mongering about AI taking all the jobs. So I just finished a review paper looking at all the research in the world that's been done by the best people in the world who do it with data, with good methods, with causal inference. And we don't have any papers that actually show systematically that AI is taking jobs. And so you can find it, it's on my website, tanyababina.com, and read it. And it's a lot of people are irresponsible for promoting this message. I don't think it's very healthy. AI is a tool, it's a useful technology. We can use it in many kinds of useful way. as opposed to AI just taking the jobs. And I think a big part of it is our journalists. A couple of months ago, a journalist from Bloomberg, you'd think a reputable outlet, emailed me and said, Tanya, send me academic evidence that AI is taking jobs of junior employees. And I was like, well, I just finished this review, and we actually don't have any systematic ones. We have anecdotes, but if you look at any data in the US, Europe, wherever, but Brazil, we don't have systematic evidence of that. And the journalist responded to me and said, oh, I don't like this. This complicates my story. And she just went ahead and printed an article about how AI is taking all the jobs, especially of junior people. So my concern, and if you talk to, I teach as well, right? If you talk to younger people, students, all of this fear mongering creates such an anxiety and such an unhealthy mindset of being afraid of this technology, right? Instead of encouraging young people to leverage it, to use how to become way much productive than you could without it. Instead, it scares them away from using it productively. So I think big picture, society-wide concerns about this technology and all of us, I think that's one of the biggest one I have. And by the way, so far we don't have evidence. It might change. But I think if you look at I also study the history of innovation. For example, a paper studying 200 years of innovation in the US. All of these technologies, they come, they take some jobs, they create other jobs, and typically they improve the quality of the jobs, right? So I'm quite optimistic, and I think if there are any journalists in the room, I want you to be more open-minded and truthful about this technology and impact on society.
Thank you. Wow, your concern is about the concern. That's kind of a unique take. Really appreciate that. And I think, so fantastic way to end this. And going back to the original theme, agentic AI as a tool or paradigm shift, I think it's fair to say, I think the audience could make that judgment yourselves just based on this fascinating kind of panel here. I think we have some time for questions, if my understanding is correct. Yes.
Hi there, Matt Toms, an advisor to Mayflower Specialty Insurance. I've got a question for Greg. At FINRA, you talked a bit about risk management with AI, best practices for your member firms. I wanted to ask whether FINRA has any guidance or requirements specifically around insurance. There's a lot of carve-outs of conventionals, whether it's D&O policies, errors and omissions policies, employment practices, anything from bad hiring decisions to an algorithm or giving poor advice. These things are kind of left out of a lot of conventional insurance products specifically. So I wanted to see whether FINRA is doing anything in that area or if you have any guidance.
Yeah. So specific, we really don't regulate insurance. We regulate the securities and the broker-dealers. There's some parallels you could kind of tie. We have our annual regulatory oversight report, which we published last December. We have one coming out this year where we're specifically calling out AI and looking at it. We're technically we remain technology neutral, so I would say draw back to what is the original rule set that you're looking at, and then I kind of drive back to the kind of foundational model risk areas of, does that model, how is it designed, is it operating as designed, but more importantly, is it ingesting the right data that you want? So a really robust data validation area to be looking at. And then from where we're at, it's really concerning to go to that next area of getting into recommendations. So with the regulation BI, or Reg BI for short, there's one area that we're having lots of discussions now that when you're making that recommendation, if you're going to allow an agent making that or your generative AI to make that, and there is no human in the loop related to that activity, that's going to have increasingly scrutiny over that, because how is that designed, and is it considering everything that it should be considering? So that's kind of one area we're still, not seeing a lot of firms making that leap, but we've seen some announcements that there's some interest in it. And then if you dive back into specifically with agentics, if you're offering agentics at your firm, are you controlling what's being asked? So does it have to flow through an employee to get to that, or are you letting the clients have direct access to your agentic or AI model? And so that is, again, a heightened scrutiny of what is that model authorized to do, and how much are you tracking the output? And then we are seeing people talking more about having the client or customer bring the agentic to the firm. So it's being allowed either through an API or some other mechanism. So I think those three areas are really on the developmental front that I would say be kind of more cognizant of that, and look about how this is being considered and evaluated at your firm.
Thank you. Yes, but can you please use the mic?
So I like that question, but maybe, and where you were going with the answer, for anyone in the panel that wants to take on this one, if you think about the systems we're talking, the agentic systems are not deterministic, and a lot of folks think deterministically about systems. So when you think about automation and you're comparing it to human work, which is not deterministic at all, and you take the analogy of how hard it is to get driverless full self-driving approved because there's no tolerance for error, and yet we tolerate human error every day. So anyone that wants to take that one, maybe Craig, was it Craig from Palantir? Yeah. Yep. Anyone that wants to take it to say, are we making it too hard to get in this full autonomous loop? Because you destroy a lot of the value when you put the human in the loop, and you don't get much uptick for it. So anyone want to take on that one, what you're seeing in the field in terms of this double standard of acceptance for high variability of human output versus low tolerance for agentic work?
Right. So just to kind of paraphrase the question, the benchmark should be humans or perfection, essentially. Please, Craig, you want to start?
Yeah, I can start with that. But that's kind of why our thesis has always been, it's not just about these autonomous systems acting on their own. We really should be thinking about, okay, how do they complement the human operators and decision makers? Because in cases you can put rails, like with the systems and the foundations that we build and that our keynote speaker was talking about, you can have the rails in terms of, okay, even though they are non-deterministic, can you funnel them to be creating outputs for the next set of operators that are in some ways deterministic, or at least it can give you some sense on like, hey, I think this is the thing I recommend, but this is how confident I am about that. And you can complement that. You don't have to just rely on the LLM to be able to tell you that this is the level of non-determinism. You can complement that with machine learning models and other ways. And so it's really, I think, about how do you bring those two groups of actors in any enterprise together and delegate to each what they are the most capable at, and so that together you can get the maximum value out of that in the enterprise, in the organization.
If I can add, I agree with you that there is this myth of the human in the loop that sometimes makes things worse, but I think we get used to the fact that there is a lot of human control. So the human can make mistakes, but there are a lot of humans that do the manual work that our keynote speaker was mentioned before. We got comfortable with those controls. So now we are in a start with, we delegate this to even more black box that we control even less. So it's about implementing control for the black box. So I'm not scared about automating processes, but we need to implement much more telemetry. That you can actually, we have a huge opportunity. We can make a much better evaluation of the reasoning to improve, to reduce the human error, but now we are under the risk to add the human error, the machine error. It's going to be a catastrophe, in particular for some financial stability. So I think the harness part, investing in harness telemetry, transparency, according to me, is the key.
Thank you. Any other questions?
Perfect timing.
Yes. Actually, does anyone want just, I know Carolina or Tanya, do you have anything to add to?
So one of the points that Leanne made earlier when she was speaking was that when you think about, I guess they have this concept where they have these, they call it agentic employees, but it's a similar point where with a person, you have a certain set of inputs they take and that you expect a certain set of outputs from them. And when you oversee human work and the controls that you put in place, it's all around the outputs out of their job and also how they do their job. But it's not deterministic either, which is the point that you made. It's a similar concept when you're looking at agentic. So when you listen to these conversations within the industry around how to govern, how to oversee, this concept of govern it like it's a person is a concept that comes up often because it's the same idea that you have a certain set of inputs and you expect a certain set of outputs with a certain set of consistency, and then you have controls in place to ensure that and mechanisms in place to ensure that you get those outcomes. So it's a similar, the way she voiced it, it's a very nice way to think about it. It's a similar set of sort of high-level concepts on oversight when you're looking at agentic.
Great. So one last comment from me. Like all this is great and resonates with me as well. But kind of the experimental nature. I think we really need to. There's a lot of people pushing AI to kind of reap the benefits, and we also really need to push kind of, in some sense, adversarial AI as well. I think again, kind of both parts are very important. But with that said, if everybody could give a round of applause to the panelists here. Fantastic panel. And I think we're on break.
Thank you, Sung and panelists, for this exciting discussion. So next, we have a short break. There are refreshments outside the doors and a reminder to check out as well the vendors at the Innovation Expo. We'll restart at 11:05 for our research spotlight session. Thank you. Welcome back, everyone. Next, we have a research spotlight from Neha Narula, Director of the Digital Currency Initiative, MIT Media Lab, on the hidden plumbing of stablecoins, financial and technological risks in the Genius Act era.
Great. Thank you. Thank you, everyone, for being here. And thank you to the New York Fed and the organizers of this conference for inviting me to present some of our work. So my name is Neha. I work at the Media Lab at MIT. I've worked on cryptocurrencies and blockchain technology for over 10 years now, leading the Digital Currency Initiative. And I'm here today to talk about a paper that we put out in February. And this is joint work with my co-authors who are listed here at the bottom. So I'm very excited to talk to you about this. So at a very high level, what I want you to take away from this talk is that when it comes to digital money, the rails really matter. So what do I mean by that? Well, traditionally, money is seen as an object, and payments is seen as the rail on which the money operates. So an analogy you might have in your head are train cars and train tracks. So these are two distinct things. You could imagine picking up one train and putting it on a different set of tracks. And I want to change this intuition, if this is the one that you have, because digital money is not really an object. It doesn't actually exist outside of the systems that enable it. And so what that means is that the systems in which digital money operates enable and constrain the very monetary properties that we might care about. It's almost like physics. The systems are like the gravity that control how we can move the money, what it can do, how it can operate. So in this talk, I'm going to cover the following. I'm going to give you a brief overview of stablecoins, how they fit into the hierarchy of money, and what Genius says. Then I'm going to talk a little bit about the goal that we want to achieve with any payment or financial instrument, which is par value exchange. A dollar should be worth a dollar. I'll go into a bit of detail about two different kinds of rails, the market implementation for treasuries and blockchain technology, and then I will conclude. And we will have a few minutes at the end for questions, so please be ready for that as well. So let's get started. Stablecoins under Genius. Now, before we dive into that, I just want to make sure we're all on the same page in terms of terminology. So what is a stablecoin? Well, first we need to start with a cryptocurrency. A cryptocurrency is a native currency which secures a decentralized blockchain. Now, on top of that decentralized blockchain, you could issue what we call a token. A token is a non-native asset. And these can be issued by a specific issuer, like a company or a person, or usually via a smart contract, but it might be decentralized. There might be no specific company behind it. Now we get to a stablecoin. So the stablecoins that I'm going to be talking about in the rest of this talk are tokens pegged to a fiat currency through one-to-one backing. So that's usually things like treasuries or cash reserves in a bank account, might be other assets. There are other types of tokens that go by the moniker stablecoin. For example, there are stablecoins that are issued through smart contract and are over-collateralized with cryptocurrency. And there was a very famous stablecoin called Terra Luna that was secured via an algorithmic mechanism. These are not the types of stablecoins that I'm talking about today. I'm primarily talking about ones that are issued through one-to-one backing. And if you think about the spectrum of decentralized to centralized, this is how you should think about it, with cryptocurrencies being very decentralized, stablecoins much more centralized. So where are we in 2026? Stablecoins have about a $300 billion market cap. It's forecasted by various sources to grow to $2 to $4 trillion, perhaps by 2030. And the Genius Act was passed in July of 2025. I think this market cap statistic, though helpful, might not even capture the whole story, because what we're seeing is that actually stablecoins seem to have a pretty high velocity. And so volume, stablecoin transacted, is growing even faster than the market cap. So we released this paper in February of 2026. It's a working paper. It's still in progress. We're still editing it, called The Hidden Plumbing of Stablecoins. And in this paper, we were trying to address a very specific question, which is, if stablecoins were to become widely used as a payment and settlement instrument, what might go wrong? So I want to be very clear. This paper is not about use cases for stablecoins. Do they make sense? Why stablecoins instead of faster payment systems? This paper was not about dollarization, international roles of stablecoins. We're really looking very specifically at this risk issue. So let's take a look at the Genius Act. So the Genius Act has been law for almost a year now, and it has three important components. I'll use this to summarize the Genius Act. So first of all, it mandates one-to-one reserve backing. That can be in cash, bank deposits, short-term treasuries, or treasury reverse repos. The Genius Act makes it very clear the types of stablecoins it regulates cannot be algorithmic. The Genius Act also specifies what I'll call par value redemption. So what does this mean? A dollar should be worth a dollar. The Genius Act says that a stablecoin issuer has an obligation to convert at this fixed monetary value and to maintain the expectation of stable value. And the Genius Act mandates monthly disclosures. Stablecoin issuers cannot rehypothecate customer assets. So in summary, Genius treats stability as a balance sheet problem. But what we show through our work is that par also depends on markets and on technology, because a stablecoin's ability to trade at par under stress depends on redemption. Okay, so let's go into a little bit more detail about what I mean when I talk about par value exchange. I think a really useful framing here is by a gentleman from Boston University. His name is Perry Merling, and he has this framework he calls the hierarchy of money. And here I'm showing a figure from our paper, and the idea is that the hierarchy goes from left to right. So at the left, we have, and the hierarchy also represents money in terms of balance sheets, so assets and liabilities. So at the far left, we have the central bank, which has a balance sheet. They have assets, might include things like treasuries, and they have liabilities, reserves. Then, directly to the right is the next level of the hierarchy of money, the banking system. The banking system's assets are the liabilities of the level to its left. So the banking system has assets like reserves in the central bank balance sheet, and its liabilities are deposits. Then we have the private sector. And if we want to put stable coins into the hierarchy of money, well, we have to take a look at their balance sheet. What do they hold, and what are their liabilities? And what we see here is that stable coins have assets. They have bank deposits, so liabilities of the banking system, but they also have securities, which are liabilities of the private sector. And then stablecoins liabilities to the user are the actual stablecoins that have been issued. And if we think about this process of how do stablecoins operate, what we see is that in order for a stablecoin to meet its liabilities, to meet redemptions, it has to work with the banking system to transfer bank deposits, and it has to sell treasuries or securities via the private sector. Now, this placement isn't fixed. This is how stablecoins work in the United States, but there are proposals like those of the Bank of England, which mandate that stablecoin issuers actually hold central bank deposits. So that would move stablecoins to be in a slightly different place in the hierarchy of money. Something that's really important to note here is that stablecoin redemption, like I said, requires selling treasuries through broker-dealers to convert those treasuries into bank deposits to meet the redemptions. Par value is enforced by the option to convert. That's the key idea behind the hierarchy of money. The reason that things to the right still have value, the reason that we believe that they're going to be worth $1 is because they're convertible into things on the left. And at times of stress, people really want to make that conversion. I want to highlight two distinct concepts when it comes to how we think about risks. So first of all, there's solvency. And like I said, Genius does a great job with this. The idea of solvency is that for issuers, we want the market value of the backing assets to meet or exceed the liabilities. Unfortunately, under Genius, it's kind of a knife edge. Genius mandates one-to-one backing assets. Oftentimes, we require a bit of a capital cushion. And we talk about this a little bit in the paper. You might not need that much of a capital cushion for stablecoin issuers, but it's an interesting question. And a lot of the rulemaking for Genius is happening right now. And a lot of these agencies are thinking about this question of capital cushion. But another equally important concept is that of liquidity. Assets actually have to be convertible into bank deposits in time to meet redemptions. The reason that this is a bit tricky is because treasuries settle at T+1, and they settle through this market with broker-dealers who face balance sheet constraints. And we've actually seen those constraints cause issues in the treasury market, namely in 2020, which I'll talk about in a moment. So solvency is necessary but not sufficient. Execution requires liquidity, the ability to actually trade your assets for bank deposits, to move down or up that hierarchy of money. So let's speak really quickly about the mechanics of stablecoin redemption. So if I'm holding a stablecoin like Circle's USDC, and I want to redeem that stablecoin, I want to trade it for dollars, this is how I would do that. So step number one is I would need to make a transfer of that stablecoin on a blockchain. So wherever I'm holding those stablecoins, the USDC, maybe it's Ethereum, maybe it's Solana, I would need to actually make a transaction on that blockchain, sending my stablecoins to the stablecoin issuer. After that, a lot of stuff needs to happen in the background. So ultimately, the stablecoin issuer needs to get me back bank deposits. That's the deal. That's how we make this transfer. I give them stablecoins, they give me an equal amount of bank deposits. This is assuming that I'm allowed to redeem directly with the stablecoin issuer. I'll caveat this a little bit by saying that there's actually a primary market and a secondary market. So stablecoin issuers like Circle and Tether, they only deal with a limited number of known actors with whom they have relationships on the primary market. I can't actually redeem my stablecoins directly with Circle or Tether. I have to go through secondary exchanges, usually crypto exchanges, but let's ignore that for now. This is how the primary market would work. So, okay, you've transferred the stablecoins to the stablecoin issuer. The stablecoin issuer now needs to come up with the bank deposits in order to pay me back. Obviously, they might have a buffer of bank deposits available, but that could get depleted. So at some point, eventually, the stablecoin issuer is going to have to sell a treasury in order to come up with the bank deposits to pay me. And the second row in this figure demonstrates how that would happen. So, they'll go to a security buyer, they will get a payment from that security buyer for the treasury, and then they will make the transfer to the stablecoin redeemer's bank. Now, there's a couple of things that I want you to note about this process. So first of all, the top row happens on the blockchain. This requires a blockchain transaction. In the second row, we're actually having things happen in two different places. First of all, there's a transaction on the treasury market, selling the treasury. And second, there's a transaction in the banking system, moving bank reserves. The other thing that I want you to note, because often there's a lot of confusion about this, is that in this process, there's actually no first order changes to the quantity of bank deposits. The net level of bank deposits stays the same. And it also stays the same in the mirror process, where we mint stablecoins. So I think oftentimes there's a lot of confusion. Maybe the people in this room don't have it, but I've definitely seen it out there, that buying stablecoins or moving your money into stablecoins somehow decreases the quantity of bank deposits. First order, it does not. However, it does increase the demand for treasuries. So second order, yes, if you're buying those treasuries from the central bank, then it will decrease the quantity of deposits in the banking system, but that's a second order effect, not a first order effect. So I just kind of wanted to make that point since there's a lot of confusion about it. Okay, so now that we're all experts on the mechanics of stablecoin redemption, you know exactly how it happens, we can note that maintaining par value exchange is actually a property of this whole stack. If any part of this stack doesn't work, there's going to be a problem with people having faith that their stablecoin is going to be worth $1, because that faith is based on being able to get more real dollars if you want for your stablecoin. And this stack is financial plumbing, so the solvency and capacity of the issuer's balance sheet, but it's also market plumbing, dealer intermediated treasury liquidation and repo, and technical plumbing, the actual blockchain, the smart contracts, consensus, validators, and bridges that compose that blockchain and intermediate any stablecoin transaction on that blockchain. And so all three actually need to work at the same time. And what we note in our paper is that they interact under stress. And stress is what you really have to worry about. 99% of the time, all of these markets are working great. All of these systems are working great. The problem is that 1% of the time, when things go really wrong, we don't want to have a disaster. So let's go into a bit more detail about these rails. So I'm going to speak very briefly about the market bottleneck, because the people in this building know much more about the treasury market than I do. They are the ones who make this market happen. They are the ones who have to probably wake up and work on a weekend when something happens with this market. So I'm going to go over this very briefly, but you should talk to the markets team at the New York Fed if you want to know more about the treasury market. So we talk about a couple examples in our paper of when the treasury market had issues. One of those was in March of 2020. I'm sure we all remember that. That was a pretty traumatic time for our financial system. And what we saw then is, when we actually calculated it out, it was about $216 billion of net treasury selling that caused a pretty large dislocation in that market. And when you look at this number, it's actually under 1% of treasuries, of overall treasuries held by the public. And it's about 2/3 of today's stablecoin market cap. So the thing to take from this is that actually a fairly small amount of the overall treasury market, we think of the treasury market as being very big, very large, very liquid, even a small amount under the right circumstances might cause issues, selling might cause issues. And importantly, the stablecoin market is, as it grows, approaching that amount. Another issue is what we call the supplementary leverage ratio, the SLR. Most of the operators in this market, the dealer banks, operate near their SLR floor. And so that means that they have less capacity to maybe take the actions that we want to see them take in a time of stress. Again, when we made these calculations, dealers are sitting at like 0.2 or 0.8% above the 5% SLR floor. The Fed has important facilities in order to help this market. One thing we note in the paper, the Standing Repo Operations Facility, the SRP, does supply reserves, but it doesn't actually relieve the leverage constraint, so that's still an issue. And importantly, the feedback runs both ways. So the issue here is that if people are worried about a market seizing up, if they're worried about not being able to get their money out of stablecoins, this could actually trigger a run. This could trigger a race for people to be the first to get out. So these things kind of operate in cycles, and there's a causality. And I'm going to talk a little bit more about that. So that's briefly the market structure piece of this. Please check out our paper if you would like to read about this in more detail or you have specific questions about it. So now I'm going to move on to something I know a bit more about, which is the technology rails. And the idea here is that the technology rails are also part of the monetary mechanism. So if we think about how stablecoins actually work, they are ledgers or accounting in smart contracts on top of public permissionless blockchains. So the stablecoin issuer for the largest stablecoins, that's Circle and Tether, they control the smart contract. It's theirs. They wrote the code. They usually have permission to upgrade the smart contract. They usually have something that we call a block list, so they can comply with things like OFAC sanctions. But the stablecoin issuers do not control the underlying blockchain rails. Those are decentralized. And that means that things like transaction inclusion and finality come from this protocol, consensus among a set of dispersed blockchain validators. And that's very different than the way our existing payment and settlement systems work, where we have a supervised system that is controlled by known actors, oftentimes with contracts. And I mean legal contracts, not smart contracts. And so what this means is that recourse can often be a bit unclear. Validators do not have a customer relationship with transactors, or usually they do not have a customer relationship with transactors or stablecoin issuers. And thus, smart contracts execute, and there isn't really a way to intervene after these transactions execute. So the point I'm trying to make here is that the settlement layer now shapes important parts of the system that affect monetary properties, and much of it is outside the issuer's control. So in the paper, we describe a framework for how to think about this technical risk. Okay, all of this is risk, all software has risk, all systems have risk, the risk needs to be mitigated. So there's two major failure modes that we talk about. One would be something like uncontrolled supply. So, if there's a bug or a compromise that could lead to someone minting more of the stablecoin than they're supposed to be, given the backing. And another is a loss of liveness. So what I mean by liveness is somehow you can no longer execute transactions that need to apply to the stablecoin contract. So, you can think of this as a solvency event and a medium of exchange event. We classify the risks by likelihood, systemic impact, and controllability. The key idea here being there are issues that the issuer can control, and then there are issues that are external, that the issuer does not have control of. So here are just a few examples in some of the buckets, but you can refer to the matrix to see more. So for example, things that are that we categorize, and this is our take, as high likelihood, high systemic risk, are smart contract logic flaws. This has happened numerous times. All software has bugs. The smart contract is under the control of the issuer, and usually there are upgrade keys. So we mark this as an I. It's under the control of the issuer. Things like bridge failures. Bridges are a big part of blockchains, and they facilitate moving funds from one blockchain to another. We live in a multi-blockchain world. There have been a lot of hacks of bridges. And something a little bit maybe more esoteric, something we call a flash loan pricing attack. Then we have a category least likely but most severe, and that would be things like consensus attacks on the underlying blockchain or cryptographic exploits. Blockchains are based on cryptography, and cryptography can be broken over time. Quantum computers are an example of something that might break some existing blockchain cryptography. So you can check out, and importantly, these are not under the control of the issuer at all. There's very little the issuer can do to mitigate any of these problems because they don't control the underlying blockchain. And you can check out the full matrix in section 6 of the paper. So, like I said, there are some things that are issuer controllable, contracts, upgrades, and keys, and there are best practices that hopefully all stablecoin issuers are engaging in, but we don't really know for sure that they are. One fun example that shows that this has actually happened in practice was in October 2025. Paxos mistakenly minted $300 trillion worth of PYUSD, PayPal stablecoin. Now, to be clear, this was not exploited. That $300 trillion did not filter out into the rest of the blockchain economic system, but it was there. You can go and look at it on Etherscan. It was corrected very quickly in about 23 minutes. But there was still a depeg on PYUSD because this was a shock, right? This was a little bit frightening. And there's really no free lunch here. So yes, stablecoin issuers can control smart contracts. They can upgrade them. They can theoretically rewrite everyone's balances in them. But that makes their upgrade path a point of failure. So if stablecoin, if you have the authority to upgrade something and to change the code, then that means that if you're exploited by a bad actor or maybe an internal employee, that's also a path that they can use to cause problems or to exploit the code. So these things all work together. And there are a lot of best practices that we identify in the paper that people should be making sure that the stablecoin issuers are doing, but I don't know if they actually are, like doing a lot of testing, getting audited, doing things like formal verification, and then having certain processes like using multiple cryptographic keys that are dispersed, or having things like time delays for minting or for redeeming. So to briefly talk about these external risks that we maintain are very hard for stablecoin issuers to control. So there have been a lot of hacks in bridges. So two of the largest ones were in a bridge called Wormhole and a bridge called Ronin. Ronin did involve a lot of hacked USDC. And a lot of these bridges, as far as we know, have no formal relationship with the stablecoin issuer. There's an appendix in our paper where you can read more about these. And then there's the underlying consensus of the blockchain. So the way these blockchains work is they try to distribute control. This is the goal of blockchains, decentralization, which means that no one actor or small set of actors has control, and every user can verify and see what's happening. However, they do this using distributed consensus protocols, and these protocols have assumptions that this is just sort of the fact of life. And what that means is that you need to have a certain number of honest actors. In the case of most blockchains, if more than a third of the stake or the validator participants are dishonest, they can collude to halt or censor transactions on the chain. So this means that if more than a third of the validators in Ethereum, for example, decide to collude, they can stop a stablecoin issuer from being able to process mint or redeem transactions or smart contract upgrades. They could censor specific transactions. They don't have to censor all transactions on the blockchain. And so this is a way in which security risks of the underlying blockchain can interact with the stablecoin issuer, and there's very little the stablecoin issuer can do, at least on the blockchain, should something like this happen. I want to note that this doesn't affect the backing of the stablecoin, the treasuries, the bank deposits. Those are in different systems. But you could imagine how this might cause a lot of uncertainty and confusion and might cause a depeg and a run on the stablecoin. So a point that we make in our paper is that liveness is an economic property. So liveness is this property of chains processing transactions, and stablecoins depend on this. For transfers, redemptions, and arbitrage sometimes, and any sort of halt, which could happen in many different ways, suspends the very mechanism of transfers that anchor par value for the stablecoin. And another important note we make in the paper is that these things can feed into each other. So you could imagine a blockchain failure, whether that's an attack, a consensus breakdown, or some kind of bug or cryptographic break. This causes the blockchain to no longer be able to process transactions, or maybe a subset of transactions, so issuers can't process redemption requests. This will lead to a secondary market discount. The stablecoin will depeg. We've seen this happen for other reasons numerous times. Market makers will reprice the stablecoin below $1. There'll be uncertainty about when redemptions might resume. This could create a run dynamic. People want to get out before the depeg gets even, happens even more. This becomes self-fulfilling, and this could lead to a treasury fire sale. So if the stablecoin has to process a lot of redemptions, even if they can't do it on blockchain, maybe they still, they have to do it with their first order primary market dealers. They'll have to liquidate a lot of treasuries, and this can have a cyclical effect. So the discount can deepen the run can deepen the discount. And we don't have a solution for this. Good controls can help, but you cannot completely eliminate all external chain risk. So like I said, there's some factors that can cause this to exacerbate. Another one of them is scale. So the larger a stablecoin becomes, the larger the reward for an attack on a stablecoin on a blockchain. But the underlying value securing the blockchain is priced in the blockchain's native cryptocurrency token. So just because the stablecoin usage scales and the stablecoin grows and the reward from an attack grows doesn't mean that the underlying security on the blockchain is also growing with that. The value, as stablecoins grow, the value they can transact can eclipse the economic security of the chain underneath. Large issuers, and this can have very different effects. One concern is that the issuer could actually become a dominant player in the governance of the blockchain. But maybe that's actually what we want. So issuers have a lot of different best practices, which I'm going to just briefly allude to here. But like I said, good controls cannot completely eliminate these risks. And so that's why a lot of issuers are looking at implementing their own blockchains. So I just want to really briefly talk about purpose-built stablecoin chains. So the three major examples of this are Stripe and Paradigm working together on a chain called Tempo, Circle, which is releasing a chain called Arc, and then Tether actually has a couple of different chains that it's supporting through investment, Plasma and Stable. These are all different approaches. So Tempo is a multi-stablecoin chain. It is purpose-built for payments. So all of their design decisions are around facilitating payments. ARC is USDC first. They are trying to build an economic platform for USDC, with USDC at the core. And then Plasma and Stable are kind of two different approaches for Tether. One is a retail-focused chain, and another is an enterprise-focused chain. But the key thing to note here is that all of these chains fundamentally compete with open blockchains like Ethereum and Solana and Tron, and all trade off control for neutrality. To date, these are all permissioned blockchains. The validator set is controlled and known. Some of the people who work on these chains will tell you that the goal is to get to decentralization. It's unclear if that's really going to be possible or will happen. And so therefore, they are trading off neutrality. Every time people mention Tempo, they mention Stripe. It's Stripe's blockchain. Similarly, ARC feels like it belongs to the company Circle. So it remains to be seen if this is a useful point in the design space. We're going to have to wait and see. Do people value this trade-off of neutrality for control, and is it going to be sustainable? So now I'm going to share a few conclusions from our paper. So one thing we posit in the paper is what we call the central dilemma, which is access to the Fed. So in the United States, stablecoin issuers do not have any particular access to Federal Reserve liquidity facilities. That's the status quo. But we ask the question as to whether that's sustainable if we want to really guarantee this par value exchange during times of stress and risk. So we have, option one, which is the status quo, no direct Federal Reserve access. This preserves the existing monetary hierarchy and market discipline, but unfortunately, it leaves these vectors of risk that I've described intact. Option two is what are called skinny Fed accounts or payment accounts. This proposal would give issuers, if issuers were to obtain one of them, direct access to the Federal Reserve balance sheet for payments, but it wouldn't actually give issuers access to Federal Reserve liquidity facilities, which is the third option. The third option is access to the discount window and the SRP, which would help facilitate liquidity during times of stress. So this is also the most sort of complicated option when it comes to effects on monetary policy. It could complicate monetary policy. And the third option, though it reduces risk and improves safety, would have the most potential for bank disintermediation. So we pose this as a dilemma that we are probably going to have to grapple with in the future and figure out exactly where we want to make this trade-off between risk, safety, and the potential for disintermediation. And so just to conclude, I want to sort of present a little bit of a framework that I use for thinking about all of the different options for how to innovate in payments and digital currency. So I'm going to put all these options on a spectrum, from the existing system to things that are kind of new, and break them down by interventions that the public sector makes versus the private sector. So we have things like central bank payment accounts, so-called skinny accounts, this idea of giving more financial organizations access to the Federal Reserve balance sheet. We have faster payment systems like the ones that we've seen take off in Brazil and India, like PIX and UPI. That's another intervention that we could make. We have this intervention of wholesale central bank digital currency. There are a lot of really important projects going on here at the New York Fed related to that. We have tokenized deposits and stablecoins. So tokenized deposits are the idea of, instead of backing a stablecoin, a token on a public blockchain with treasuries, we back them with bank accounts, bank deposits. And there are a lot of people experimenting with these. We have some research that we've done in collaboration with JP Morgan, if you'd like to check that out, kind of looking at payments and tokenized deposits. There's the whole category of retail central bank digital currency, which I've grayed out because in the United States, that's not really moving forward. But there are some options, and for the sake of completeness, I'll put them up here. And then there's, of course, cryptocurrency. So you can think about all these different interventions. The only point I want to make on this slide is that it's not either or, that these are all happening in parallel. They're all happening to different degrees. They're happening in different countries in different ways. But this is sort of the way that I like to think about all of these interventions and compare them. So to conclude, so first of all, I hope you agree with me that asset quality alone is not enough. Par value exchange, which is critical to stability, depends on market intermediation capacity and dealer balance sheet, as well as blockchain rails, which introduce new risks, many outside of issuer control, and an integrated regulatory approach is required. Genius is a start, but to holistically address risk, we're going to have to think about markets and technology. And so with that, I will conclude. This is where you can find us. And I'm not sure about timing, but maybe we have a minute or two for questions. Okay, we have a minute or two for questions. So thank you very much.
Tim Massid, currently at the Kennedy School. Neha, that was a terrific talk, and as you know, I'm a big fan of your paper. One issue, though, that you didn't touch on, which kind of adds to all this, is we don't even have the whole private law framework for finality of payment and discharge of debt that we have for existing payments, right? I mean, we know when a bank intermediary in a payment is obligated to pay someone and discharge that. How do you, I mean, that's kind of a whole nother thing, right? I mean, you talked about how stablecoin issuers can't control the rules of the blockchain, but the rules of the blockchain aren't even really legal rules. They're just really operational, right?
No, this is why I use the analogy of physics, right? The rules of the blockchain are technology is kind of like the substrate of what's possible, right? I think you raise a really important point. I don't have the answer. I just want to caution against writing rules and laws that assume the technology works the way it does today, because it will change very, very fast. So we need to take a principles-based approach rather than a prescriptive approach, but it's definitely a concern.
Hi, thanks so much for your presentation, Natasha with Wells Fargo. Towards the end, when you highlighted the disintermediation risk of banks when or if stablecoin issuers could get access to Fed liquidity, I'm curious to know, to what extent do you think tokenized deposits can play a role in defending that potential future?
Yeah, so I think the tokenized deposit story is still unwritten. We're still at the very beginning of it. Certainly from one perspective, I understand why people are very excited about tokenized deposits. So they are existing highly regulated institutions. So don't have to create a whole new regulatory framework to deal with them, presumably, though there's still issues like operating on a public blockchain you have to address. And in addition to that, deposits are a much cheaper source of backing than treasuries, right? However, they haven't really taken off yet. It's unclear exactly if there's market demand for tokenized deposits. One issue, which we briefly touch on in the paper I didn't even get to, is this idea of interchangeability. How do you actually ensure one stablecoin or tokenized deposit is worth another? If you have a Wells Fargo tokenized deposit and a Bank of America tokenized deposit, are those two completely different things? How do you trade between them? So a lot needs to be worked out there. And I think it remains to be seen. I know there's at least one tokenized deposit that exists. That's JPMD, which is issued by JP Morgan on Base. And it's still very early stages. So it remains to be seen.
Thanks a lot. My name is Zach. I work at a small company called Native Markets. I thought the discussion of the treasury liquidity was excellent. But when we talk about the price of a stablecoin, it's always the secondary market price. And as you acknowledged, most of us have to go through a very specific exchange often, or sell on the open market. Have you done any work on secondary market liquidity, and how do you see that tying into the stack for par value stablecoins?
Yeah, that's a great question. We have not done a lot of work on secondary market liquidity at all, other than noting DPEGs in the secondary market. So obviously, the most well-known DPEG was Circle when Silicon Valley Bank went under. That was, I think they went down to 87 cents in the secondary market. However, they will note that they processed dollar-for-dollar exchanges in the primary market. So I think that's an excellent question and one that we have not really looked into. Thanks.
Hi, Neha. This is Andrew from Coinbase. I actually really like the slide noting the potential liquidity solutions, including the Fed's skinny payment accounts, as well as potentially access to the discount window itself and the overnight repo facilities. For some of the options in those latter categories, and in particular access to Fed liquidity, why not do that? What are the risks? What are the potential downsides?
Yeah, so I think doing something like that is a pretty big change to the architecture of our monetary system. So it's really central bank assets are all the way to the left in the hierarchy of money. They're sort of the best form of money, and access to that balance sheet is very tightly controlled. And so I think making a change to that is a big change. So you have to think through the ramifications of that. And I'm not an expert on monetary policy, but I think there are a lot of monetary policy implications. Should we make those changes? A lot of risks to consider. So it's just a bigger change than the other options in the list. I think we need to have a conversation about all of it. We need to be very honest about the trade-offs, which trade-offs can be mitigated or worked around and which ones can't. Great. I'll close then to keep us on time. Thank you so much.
Thank you, Neha, for this excellent presentation. So we'll now have our lunch break. We'll be taking the elevators back down to the first floor for lunch in the Liberty Dining Room. And we remind as well during the lunch break to check out the Innovation Expo just outside if you haven't had a chance already to do so. And we'll reconvene with our next panel at 1:10 p.m. Enjoy your lunch. Hello, everyone. Welcome back. Hope you had a great lunch and a chance to visit the Innovation Expo. So we now welcome to the stage Pablo Azar, financial economist at the Federal Reserve Bank of New York, for his panel on turning law into verified code. Thank you.
Thank you very much. And let me welcome to the panel our panelist, Homan, who's the co-founder of ICME Labs. He previously sold his previous company, Close.io, to DocuSign, and he has 14 years of experience as a professor of law at New York Law School. He's also a fellow at the Stanford Center for Legal Informatics. Our second panelist is Sarah Losky, the LB Lowell and Sumitra Devi Lowell Professor of Law. She studies tax law, computational law, and the intersection of the two. Her recent work focuses on the formalization of tax law. Professor Losky's research argues for using a particular non-standard logic to formalize tax law is the conceptual foundation for the domain-specific programming language Katala, which is the project of a team of computer scientists and lawyers. And finally, we have Daniel J. Weitzner, who is a founding director at the MIT Internet Policy Research Initiative and the 3Com Founders Senior Research Scientist at MIT Computer Science and Artificial Intelligence Research Lab. Thank you to all the panelists for being here. I'm going to open it with a question that I think will help inform our audience. But when we talk about turning law into verifiable code, how do you approach that in your day-to-day work? What does that mean to you? And what's the nuts and bolts of doing that?
Thanks for having me. I'll just start and close to you. Hi, everyone. My name is Human, and turning law into verifiable code to me in my day-to-day work at ICME Labs means taking the rules or the policies or the guardrails that govern how AI agents act, turning those rules into formal logic, something that's mathematical or computational, and then verifying that what the agent does its actions are consistent or not with those rules. And so there is a movement from natural language to something that's formalistic and some checking and verification. So that's a verifiable code in that sense.
The context that I'm thinking about turning law into code is in the context specifically of statutes, legislation. I focus particularly on tax statutes, portions of which are very susceptible to formalization, and thinking about the ways to translate tax statutes into computer code, like executable code. Both what type of language is the best target for that, and also thinking about what is the best methodology, whether that's humans or some kind of agent or some combination of those two things.
Thanks, Pablo, for having me and all of us. So I'm going to give a slightly different kind of answer. My research for the last 20 or so years has been in the area of accountable systems. We've been interested in filling what I think is a real gap in computer science, which is that we're very good at building computer systems that that can provably solve all kinds of problems that look like math and logic. We're really very bad at building systems that can attest to whether the information in those systems is used according to a particular set of rules or not. So I'm very glad that my colleagues are working on the question of how to formalize legal rules. I'm really interested in the question of how to generate the kinds of facts that are needed in order to assess whether those rules have been followed. I think in most systems, most operational production systems, the rules that are followed are actually relatively simple. They are a distillation of the very complex legal corpus of rules we have into rules that would look to us quite easy to follow, easy to express. Our problem, I think, in the digital world that we live in, broadly speaking, is that we have no way of looking at the behavior of systems to figure out whether they're actually following those rules or not. The result of that is the systems appear unaccountable. Governments, regulators, enforcers have a very hard time figuring out how to assess compliance. Enterprises actually have a very hard time figuring out how to assess compliance. And the net result of that is reduced trust by the public, and actually a lot of unnecessary cost and wheel spinning. So our research in accountable systems takes a kind of a very practical view of how we can generate a bona fide sense of accountability. And I'll just flag one issue that maybe we can come back to. Having worked a lot in the space defined by internet platforms and e-commerce services, I love coming to financial services arenas because I think this environment has a much more sophisticated sense of how to systematize accountability and risk, and I'm interested in talking more about that as we go.
Thank you. For formalizing the law, but also in terms of accountability, where do you see is the low-hanging fruit right now in 2026? What do you think is easy potentially to formalize, and what do you think is very difficult?
Yeah, I mean, I think easy to formalize are the rules that are kind of more binary, that are almost if this then that type of rules. I think it lends itself to being measured or quantified. And I think that's important, and taking out the ambiguity. That's certainly how our system works. And at my prior organization, we had a open source project called the Accord Project that worked on translating contract text to something more formalistic with a domain-specific language that's now been deprecated called Ergo. And I think that also shows the difficulty, though, in translating law or contract or at least large parts of it, of course, into something more formalistic, measurable, and checkable. But I also think the important part too is part of our system is the accountability part, and what we look at is checking to see what agents do against what they're supposed to do, the formalistic aspect of their rules. And we use a system called automated reasoning, which is a decades-old system for that was used in aviation systems to make sure planes fly correctly and that type of thing. Very serious types of checking systems that Amazon Web Services has recently applied to natural language. And then what we do on top of that as another kind of verification mechanism or accountability mechanism, if you will, is run it through a zero knowledge proof, a cryptographic system where you can tell very easily if the system is correct or the answer was solved. So I think that there are different pieces to that. One is formalizing, another is checking and verification.
The question of what is hard to formalize from in sort of the statute world, I would actually maybe even break it up into things where we're talking about just volume, so that it's a lot of work to formalize, and what's the way that we can formalize stuff that fundamentally should be formalizable, versus things that just are really going to resist formalization. And in the world that I work in, a lot of the things that can be formalized have been for a really long time. And the question is sort of, and the example is sort of tax forms. Tax forms are formalization of parts of the tax law. They've been around long before we had computers that we could access. They're not super accessible or flexible ways to formalize tax law. They don't really combine with other parts of the law very well, but to the extent that things are low-hanging fruit and easily made computable, often within the law they are computable, but maybe not in, that has been done. And the question is there a way to do this that is more verifiable, more transparent, where these things can easily be combined? So what makes that hard is just volume. Then there's things that are going to be really resist formalization, things where there is genuine ambiguity, and intentionally so, right? Ambiguity within law is often a feature, not a bug. We want there to be ambiguity in many parts of the law. Congress intentionally leaves aspects of statutes ambiguous. Parts of the law that the intention is really for it to be resolved by a court, for example. These parts of the law are going to be very hard to formalize, and appropriately so, probably. So that sort of two different kinds of difficulties that, or challenges that, as we think about it.
Somebody has some kind of script going on.
Yes, I hear it.
Sorry, do you mind turning that off? Can you say that louder? Oh. Well, I guess we'll talk louder over the protest. Just tune it out.
Thanks for clarifying that. I appreciate it.
Thank you.
So,
I just want to make sure we didn't interrupt Sarah.
Oh, sorry. So I want to also, again, take a very kind of pragmatic view of the question of what's easy and what's hard. I think Sarah's point is really important, that in large-scale operational regulatory environments like tax systems, we've tended to, as much as possible, reduce complexity and make it so that at least most people, most of the time, have clear rules to follow. And clearly on the margins, there's disputes that happens, and there's good reason for that. But I think any legal system to be functional or credible mostly has to have rules that mostly are clear and understandable and implementable in the context that they are pointed. And I want to give just a very kind of practical answer to the question of what's easy and what's hard. What's hard is to add any kind of computational reasoning, digital accountability to existing systems. That's hard because those existing systems tend to have a lot of variation and legacy unevenness in them. And it's comparatively much easier to add computational reasoning, formal accountability into new systems because because there's effort being put into actually building and designing those systems. So I think it is really worth looking very hard at what are the new systems that are coming along and making sure that we think about these governance questions. I think the question also of what's hard and what's easy is really relative to the cost that's imposed by failing to have good computational reasoning. I want to give one example of a quite dramatic accountability failure in the digital realm that has shaped a lot of the way I've thought about accountability and automated reasoning for privacy, which is an area I work in a lot. Who remembers the Cambridge Analytica scandal? Does that ring a bell for most people? Okay, so simply put, and I'm just going to give this example because I think it's a helpful motivator. Simply put, there was an academic researcher at the University of Cambridge who was able to collect a lot of data about Facebook users. He used that data initially for bona fide research purposes and got consent from the individuals who he collected that data about. Because Facebook had built such a porous developer environment, this researcher also got the friends and friends of friends of the couple 100,000 users he worked with, and that amounted to somewhere around 50 or 60 million Facebook users. He then turned around and sold that data to a market research firm called Cambridge Analytica. They proceeded to make some exaggerated claims about how they'd been able to sway the 2016 US presidential election with this data, but nevertheless, it was a very, very large-scale data leak and a very large-scale privacy intrusion that affected tens of millions, almost 100 million people. I bring this example up because during the time that all this data was leaked from Facebook, Facebook was actually under a consent decree with the US Federal Trade Commission and being audited on an annual basis. And the audits didn't reveal the fact that this enormous data leak was happening. Neither that there were policy failures that enabled the leak, nor the actual fact of the leak. So it's an example of, I think, regulators setting low expectations about accountability. Facebook could have solved that problem, but they had no incentive to solve the problem. They could have automated compliance with all of these rules, but they had no reason to do it because their regulators didn't expect it. And so I think it's hard to automate legal reasoning, automate compliance, if those who are responsible for enforcing the laws don't care whether it's happening or not.
Thanks all. And I think in the financial systems world, as you said, we're much better at enforcing compliance and risk and being able to audit the right parts of the system, especially after the global financial crisis. I'm going to riff on something each of you said. So, Homan, you mentioned you use agents and you check your agents with zero-knowledge proofs. And I'm going to ask you about that later in the panel, but and Danny, you also mentioned there's the parts of the law that, like, the law has to be easy to interpret, the law has to be clear, and so on. So, to disabuse my naivete and maybe the naivete of people in the audience who might be thinking, you know, can I just wait for mythos to come around and take the U.S. Code of Law and have Mythos index it and formalize it all, what would you say to an audience member who would be thinking that?
Again, I want to divide it into sort of two parts. One part is the part of law that actually is very susceptible to formalization, parts of the tax law that are heavily computational. The other is that even in the code, there may be some ambiguities. And I would say for the parts that are heavily computational, I'll just say that people for a lot of years have been saying to me, well, right around the corner, a computer is going to be able to do this. And I will just say, great, I'm really looking forward to seeing that happen when it can happen. I can say that right now, this isn't something that agents can do to the level that one would need it to be done, which is very, very close, even the computational parts, which is very, very close to just, if you're going to use a formalization of law, you need to be very, very close to totally accurate. So even if you can, the recent research I've seen by various measures, even with the heavily computational portions, you're getting to like 60, 70%, which is like impressive, but also you also then have to have a person sit down and get you to the last 100%. Doesn't end up being much faster. So I'll just say with respect to that part, great. I'm super excited to see it when it happens. Let me know. With respect to the other part, though, I do think there's aspects of the law that really aren't going to be usefully formalized. Those, at least the statutes aren't going to be particularly usefully formalized, that you could formalize it in a way where you have an input, but the input is like the whole game. And for that, I don't know, even the U.S. code itself, it is, well, it's only part of the law. We also have regulations, we have rulings, we have court decisions, but in general, my response to people who say that technology is right around the corner that will be able to do this, I say, I'm very excited to see that technology. Let me know when it happens. People have been saying that to me for at least 9 years now, and I will say to my great frustration that if people had just sat down with humans and done the formalization by hand, I think probably with a not giant team, at least for the tax law, we could have been done in a few years. We would have long since had the first cut. Instead of people saying, we're not going to do it by hand, we're just going to wait for the thing that's just around the corner when the computer is going to be able to do it. If we could just sit down and do it, we could probably get it knocked out in not very long. So that's the only reason I find that response a little frustrating, because I think it's impeding somebody just deciding to go ahead and take the step and get this stuff formalized in a way that's computationally accessible. Other countries are going ahead and doing parts of their law in sort of modern programming languages that are computationally accessible. They're doing it by hand with pair programming, and they're kind of zipping through it. So to the extent that the computer can do it right around the corner is preventing that from happening, that part, it's kind of a bummer.
Homan, do you want to add something to that?
Yes. From our perspective, for the narrow focus we have, there's not a huge problem in translating natural language to formal language, because we only focus on, sort of by definition, the types of rules that can be relatively easily converted and translated. And those are rules that govern how agents behave. So for example, we want to tell an agent not to spend more than $1,000, not to spend it with too risky of a seller that's on the OFAC list, and that type of thing. So you can give like 10 rules to an agent. Those rules are relatively narrowly defined, and therefore we use AI to translate those rules. And as AI gets better, the fidelity between what you want the agent to do between those rules and what the formal model does is very close, and already is. But we never use an AI to check those rules, and I think that's the important part, is that we use a deterministic checking method, which is not susceptible to all the problems that large language models are, that I think a prior panel alluded to or spoke about, which are things like prompt injection, hallucinations, or just not being accurate for whatever reason all of the time. Because we think that when you give an agent money, you have to be confident that the agent is going to spend it correctly. When you give an agent an important task like financial compliance, and we have demos on that. You have to make sure that it actually follows the rules of compliance exactly. So when the agent says, yes, this person can accept money, they are a person who is not on a sanction list, and you can run the verification that that's correct. So my startup, we led Circle's first ever live stream on what we call trustless agents for their stablecoins, which is basically saying, look, if we want autonomous finance and commerce and agents to do that work, we have to be able to wrap them in zero knowledge proofs and also be able to prove it externally to the world.
Let me follow up on that. I want to know more, and I think people in the audience as well. Can you tell us more about ICME Labs and the technology, and how is this technology being adopted by businesses? Is it reaching households? So this is a complicated stack of zero knowledge proofs on top of AI. And how is this being used right now by your clients?
Yeah, right now it's being used in the context of just making sure agents do the right thing in a broad sense. More specifically, to make sure agents follow the policies that you want them to follow, the rules or guardrails that you want them to follow. So we're certainly not expressing judgment about whether those are the right rules, whether those rules are truly compliance with the laws. But at least in the narrow sense of you write these rules in plain language, natural language, and then they can be translated into formal language, and that can be proved as correct. And yes, people are using it now primarily in the business-to-business sense or the commercial settings to do things like make sure the payments go where they're supposed to go and at the right amount. That type of thing, as well as just more mundane agent security, AI security purposes to make sure data is not deleted, it's not leaked, and whatever other rules that people want agents to follow from a basic security and safety and are my goals being achieved perspective basis. So it really runs the gamut, but certainly financial services is one of them, and payments where you want things to go according to plan.
Thanks, Homan. Danny, I have a question for you. You mentioned accountability and the Cambridge Analytica scandal, and we bounced a little bit on even in financial systems, we don't have the kind of accountability mechanisms that civil engineering or medicine have. So what's a way in the next 5 years to get, or it could be 5, could be 10, to get from where we are now in financial systems or in privacy systems, which is your specialty, to something closer to what civil engineers do?
So the performance that I think we should be aiming for in all digital systems is, as you alluded to, the kinds of expectations we have of traditional engineered systems. That is, you build a bridge, it's supposed to be able to support a certain number of pounds of vehicle at a certain wind velocity and everything else across that surface. That's something that we have some engineering science. This helps us figure that out. And we also test quite aggressively to make sure that system, namely the bridge, is actually working the way it's supposed to. And we test it throughout its life to make sure it's still working. We collect evidence. We spend money and resources collecting evidence to make sure that systems that we depend on actually function according to specifications. As you mentioned, I think the most of the financial world is pretty mature about this. We're relatively confident that money that flows around in various parts of our financial system actually gets where it's supposed to, preserves the value it's supposed to, et cetera, et cetera. Neha talked about some of the leading edge challenges of that, but that's all against the background of the kind of baseline expectations we have in our current financial system. When I think about, and the question that animates really most of our research is the question of how to get information to flow around digital systems with the same degree of certainty and reliability as we have in traditional systems, engineered systems, financial services systems. We've been working on a protocol for information accountability that provides for traceability of personal data. And we have really one very simple goal. We want to make sure that when personal information is used, when someone does something with your information, you're able to get a receipt as associated with that use of data. And that receipt ought to present you evidence that whoever used the data about you, the data controller, had the legal right to do it. You can investigate where that right came from, whether all the rules were followed. One of the, I think, big differences between financial systems and general information systems is that most financial systems, in one way or the other, have some kind of a clearance process or another, whether it's through a clearinghouse or some other kind of after-the-fact assessment mechanism to make sure that what was supposed to happen actually did happen. And as all of you know, the vast majority of the times, those clearance systems are unnecessary because everything actually did happen the way it was supposed to happen. But we have clearinghouses, other mechanisms in the financial world to make sure that the right things have happened as the value has flown around amongst a number of unrelated parties. I think in the long run, we actually need that kind of mechanism, that kind of certainty for personal information as well. I don't think we are going to get that from clever application of cryptographic protocols alone. I think we actually have to build institutions that provide us evidence that the right thing has happened with data, whatever that means. So that requires both having the proper formalization of rules for that data and also generation of evidence about what's happened to that data and some institutional process that actually checks that the right thing has happened with some institution actually accountable to make sure that that worked out right. I don't think there's any shortcut from, there may be cost savings from more computational mechanisms of accountability, but I don't think we ever can have accountability without institutions, without legally accountable institutions involved at some point in the process. And that's where I think the real opportunity is going forward.
I'm going to follow up on that if you can answer in like a minute or two, but to me, it sounds very far-fetched to go from Facebook is showing you to millions of advertisers. And so are you getting 1 million receipts? Like how would that work in practice?
Oh, it's not far-fetched at all. The people who pay for those advertisers have a very accountable process in place. If you're an advertiser, you know exactly what ads you paid for and exactly how many people were reached. We have accountability for various parts of what are actually very complicated digital information flows. We just haven't decided to do it for individuals who also have rights in that system. So there's nothing hard about it. It does require some resources, and whether we need it in the case of sort of simple digital profiling, maybe not, but we certainly need it when individuals are depending on these systems for more sensitive uses like employment decisions or credit decisions or things like that. And so we actually know how to do this. It's just a question of deciding to do it.
Thanks, Danny. Sarah, I have a question for you. So can you tell us more about the Catala language? And so you've done some work on it, but also where you think it will be useful in the future.
So Catala is a domain-specific a programming language that is designed for formalizing statutes that have a particular structure, that have the structure of being written as general rules followed by exceptions. And as it happens, that is how the United States Code is written, as a bunch of general rules followed by exceptions. And it turns out that's also how a lot of French law is written, as general rules followed by exceptions, maybe other types of law as well. So Catala is developed by a team of computer scientists at INRIA based on this idea that statutory law is written as general rules followed by exceptions. That was some research I did about the tax law being written that way is what sort of led to the development of Katala. So Katala is also part of a formal method, so you can prove things about things that are written in Katala. It is, so it's good for formalizing. So one thing I mentioned is that the statute is general rules followed by exceptions, and it's particularly useful for formalizing law that has a lot of computation in it, such as the family benefits law in France has a lot of computation in it. The tax law in France, in the United States, has a lot of computation in it. So the idea is to have so part of it is the language itself, and part of it is, I would say, sort of cultural aspects of the language. Like, you will hear someone say that something is Pythonic or something like that. So what is the cultural aspect? So one thing about when you write Katala is written, the code is written using literate programming, which is to say it's heavily commented, and in the comments, among other things, is the actual text of the statute that is being formalized, and the code tracks the actual text of the statute. The other thing is that it's written using pair programming. So the way that you would formulate, that you ideally code something in Katala is you sit down with a subject matter expert, a lawyer, and a programmer, and together they work on writing the code, and that is a way to make it more reliable as well. So that it is domain specific, and so it's useful for these particular domains. And it also has compilers that compile to various languages, Python, other languages. So it's really only used for the part of the statute that is usefully represented this way. For example, Katala doesn't have strings because you shouldn't be using strings in that. You should be compiling to something else, and then you can have strings in your other language. So that is the basic idea.
Thanks. We have about 3 minutes left. I'm going to open it for questions from the audience. Okay, I do have a final question prepared. So, I mean, the technology is so much different from how it was 5 to 10 years ago. So in your modal view, I know none of us can predict the future, but in your modal view, what does it look like for this field of computational law and regulation to succeed in the next 5 to 10 years? What does success look like? Like what do you see us being able to do in 5 years that we can't do now?
From my perspective, it's using and trusting and feeling secure and safe and using agents to do a wide variety of things that right now we don't trust them to do. Just for an experiment, I was going to give an agent access to my checking account. But even I would have trouble doing that with our own system I'm telling you is 100% safe, basically, if you write the rules out correctly, because it's just that margin of error. You don't want to wake up and have an overdrawn bank account the next day. But getting to that place where we can really trust agents to do the sensitive work, and in addition to the important work and the work that requires, or that is best done without people, so it can be fast and all that. So I just see a world where we can really trust agents more to do more of the things that we would like them to do.
I'll make an optimistic prediction. I think that policymakers, regulators, enforcers will actually come to understand the important kind of high-level properties of computer and information systems better, and will write regulations that are more susceptible to being enforced and complied with in digital systems. And I'll give an example that if you look at, for example, aviation safety, aviation safety regulators have over a pretty long period of time gotten very sophisticated about what the right regulatory structure is to make sure that as few people as possible die in plane crashes. And it really has to do as much with understanding the kind of material engineering qualities of airplanes as it does understanding the psychology of pilots and others who work in the system. So we have rules like safe harbors for pilots who tell the truth about mistakes they've made, because we've realized it's better to know about the mistakes than to create incentives to hide them. Is actually a high-level observation about how to make aviation safer based on the fact that it's a very complex system. It took regulators a while to realize that. And I think we're really relatively early on in the process of regulating digital information systems. And hopefully we'll get better, if nothing else, because the people who are going to be the regulators will be kind of digital natives, as it were, themselves, and will just be smarter about it. I was one of the founders of a ACM conference on computer science and law, because we believed it was really important to develop the scholarly discipline of lawyers and computer scientists working together, the sort of work that Sarah has done long before the conference. But I think gradually we'll get better at this intersection, but it will require the intention to do that.
So what success would look like in 5 years, I think, in the sort of sub area I'm working in, is there would have been a lot of high quality formalizations written, carefully by people who are very knowledgeable in this area, that are totally transparent and available to people, that formalize the parts of law that can be usefully formalized and don't formalize the parts of law that can't be, and that those formalizations would be public, transparent, and that anybody working in this field could use them as tools, could refine them, could develop them, that people would be willing to sort of like sit down and put in the, maybe not glamorous, but actually, from my experience, kind of fun work of getting this stuff written into code that then everybody can use going forward, right? That getting that foundation of the law written down is a base for people to develop all kinds of tools and products and insights on top of that formalized base.
Thank you. Let's give a big thanks to all the panelists.
Thank you all for this insightful panel. So we now welcome Megan Lindgren, Legal Counsel at the Federal Reserve Bank of New York, for the panel Policy and Regulation, Implications for Digital Assets and the Financial Markets.
Hello. I'll let our panelists sit down as we get our set change here. But I want to thank you all for being here today. You don't always want to hear from the lawyers, but hopefully we'll keep this interesting and fun and relevant for everything that's happening in digital asset policy today. So I'm Megan Lindgren. I am legal counsel for the New York Fed. I focus on accounts and financial services that we provide to both domestic banks and foreign institutions. And that does include the fun work we do on innovation and digital assets. So over the past 18 months or so, there has been a major shift in digital asset policy. I think we've all seen that, from a more cautious approach, regulation by enforcement, to the goal of removing barriers and really promoting U.S. leadership through private sector-led innovation. The crypto industry began the Trump administration with a sense of optimism, and now we have the passage of the Genius Act as of last July to create the federal framework for the issuance of payment stablecoins. But there's still debate over many issues, including the Clarity Act, which aims to more clearly define the jurisdiction of the SEC and the CFTC over digital asset products. There's still debate about how to compromise on the payment of yield for payment stablecoins. Some banks have expanded into the space. They are expanding their digital asset custody services, working on tokenization, especially as certain federal agencies have affirmed banks' ability to engage in digital asset activity. Others are opposed to the space or are concerned about the encroachment of fintech companies or non-traditional players in the space. So in this panel, we are going to explore how policy is shaping digital assets in the financial markets and the critical role that both the public and the private sector play in supporting innovation and stability. So today I am joined by 4 policy and legal experts. They have a wealth of experience across both the public and private sectors and traditional and emerging institutions. So I'll briefly introduce them, and then I ask them to each give a very quick 15-second overview of what their institutions are doing in the digital asset space. Some of you may be very familiar with their work already, and some not, so I want to help them lay the foundation for you. So first, to my left, we have Catherine Carroll, who is the General Counsel of OpenFX. We have Amy Kim, the Head of Global Crypto Policy for PayPal. We have Brent McIntosh, the Chief Legal Officer of Citigroup. And last but not least, John Melican, who is the Deputy Superintendent for Limited Purpose and Virtual Currency Trusts at the New York Department of Financial Services. Great, so Catherine, kick us off, what your organization is doing.
Great, hi. Thanks very much, Megan, for having us. Good afternoon, everyone. So OpenFX is a global financial infrastructure company. We help institutional customers move money cross-border, leveraging stablecoins.
I'm Amy Kim. Nice to see you all. PayPal is a payment services provider. We help digitize payments back in the 2000s, and now we see the digital currency growth and evolution as a next evolution of that process for us. We've been in the space enabling our customers to engage with some limited types of what we view as cryptocurrencies in 2020 and have a stable coin that we also offer on our platform, PYUSD, looking primarily through the lens of e-commerce.
Great. Thanks, Megan. Great to be here today. I'm Brent McIntosh with Citigroup. We are a bank. We sit right over there. And what I'd say is we do a number of things that touch the digital asset ecosystem. On the one hand, we are a banking partner for a lot of the premier names in the digital asset ecosystem. So we bank any number of them because they do need access to traditional financial rails. Separately, we have our own tokenized deposit system internally that we use for moving working capital and liquidity around the world in dollars and euros. We're rolling out a crypto custody pilot in later this year, and we're also working with a number of other banks on with the clearinghouse on a mechanism for clearing tokenized deposits across multiple banks, so that we can do that across the entire system, not just internally.
John Melican. I'm with New York DFS. We're a regulator, and we're located just down the block. New York DFS has been in the regulation of cryptocurrencies for over 10 years. We were one of the first regulators to roll out a framework for digital assets, and we've been very active in that space this entire time. My general focus is with limited purpose trusts, where we generally issue stablecoins. So we've been active in that space primarily since 2022 when we rolled out our first stablecoin guidance.
Speaking of stablecoins, let's start with one of the biggest developments over the past year, the Genius Act. So the Genius Act allows banks and non-banks to become permitted payment stablecoin issuers, and they can become licensed through a few pathways, both federal and state. So federal and state regulators are going through the rulemaking process now to implement the act. Earlier this month, DFS released a proposed regulation to build on the existing stablecoin regime and also make sure that it is, as required by the act, substantially similar to the federal framework. So John, kick us off. Tell us more about the proposed rule and how state regulators are thinking about the legislation.
Sure. Just on June 9th, Acting Superintendent Asro released the proposed rule. What we've really done is taken the existing framework that NYDFS has for issuance of stablecoins, and we've harmonized that with the Genius Act. This was particularly easy for us, given that Genius Act took many of the core principles and used our existing framework as much of the baseline for Genius Act. So some of the core values that we talked about before lunch in the presentation of redeemability, asset backing, asset quality, are all within that same framework. We've then accommodated some of or all of the prohibitions that Genius Act has or will, when it goes into effect, into the act. So we use this new proposed rule to point to many of the sections of Genius. So the prohibition on yield is referenced and included in the new proposed rule. I think generally we don't expect this to be disruptive at all for our current issuers and applicants, and we think this will roll out fairly smoothly. But all of the states, all of the regulators that do provide for issuance of stablecoin currently are going to have to go through a process of making sure that they are deemed substantially similar to stay in the framework to allow it for issuance to continue at the state level. And New York and many of the other states are, obviously critically interested in making sure that that happens. So we feel like we're in a very good space, and this is a step that we wanted to take to move forward to create clarity, harmony, reduce any potential friction for the market, for consumers to say, is there a difference between New York and the new Genius Act? Will there be substantial similarity? We think we've done the legwork to get us there. So this will roll out concurrent with Genius, so it will go into effect at the same time Genius does, and that helps with the conclusion of the proposed rules under Genius. Will come into effect, and then we'll have about a year for people to come into full compliance.
So we'll be going through the notice and comment period, so hope that all goes well. But I know we'll all be watching to see what other state regulators do, especially ones that are not as experienced, so they have to build from the ground up here. I'd like to get the market participant perspective, so I'll turn it over to Amy, because there are existing and potentially new stablecoin issuers that are in the process of organizing themselves in anticipation of the law's requirements actually going into effect. The OCC has recently given conditional approvals for several national trust bank charters, some of which plan to be issuers or otherwise support stablecoin activity. So how are these types of institutions actually navigating these different licensing pathways, ensuring they can meet these new requirements? And Amy, if you could talk about your experience through PayPal or the broader market reactions.
Sure. So for our crypto activities, we are a licensed state chartered trust with the DFS. With respect to our interactions with issuers and Paxos in particular, we want to see that they're meeting the requirements of the new rules as they come online. And especially, I think, because our interactions, making sure, just in the industry, making sure we understand the regulatory expectations as well. And so a lot of that is focused on the rulemakings that are coming out both at the state level with DFS and some others, and then as well as there's a handful of proposed rules that have been issued by prudential regulators, FinCEN, and others that we're actively engaged with to make sure that it's reflecting, not only that it's reflecting Genius and the spirit of Genius, but also that we can operationalize that in a way that brings out the best outcomes for consumers, businesses, and compliance and stability.
So speaking of the rulemaking process, so yes, many of the agencies implicated by the Act have issued proposals or in active development. Template all the provisions from applications, the reserve requirements, BSA, AML, and sanctions compliance, requirements for foreign issuers and certain other participants in the ecosystem, like digital asset service providers. So these regulatory frameworks, regardless of whether it's state or federal, they're generally intended to be consistent, of course, right? As John mentioned about the substantially similar requirement for states. But each regulator could have a different perspective, depending on the institutions that they oversee and their interpretation of the act. So recognizing that we're still in the notice and comment process, what aspects do you all think are the most important to get right to successfully implement the act and actually put it into practice? And I'm curious about what the various stakeholders need clarity on, right? It's not just the issuers, but it's also their service provider, it's also custodians, other market participants, so that they can actually make sure their activities are consistent with both the letter and the spirit of the law and the implementing regulations. So let's start. I'll give Brent a chance to jump in here,
Sure.
and then we can go down the line.
Great. Well, I think if you step back from Genius and just look at stablecoin regulation more broadly, you see there's a real convergence on the need for clear and harmonized rules. There's some amount of difference around the world on the substance and timing of those rules. So when I look at Genius, the regulation of stablecoins is not some magic domain that sits apart from the financial system, right? We know the set of risks that appear with financial instruments, and so getting them right as a matter of the regulatory environment, both for stablecoins under Genius, but more broadly for digital assets writ large, is critical. And that's things like consumer protection. It's things like evaluating the safety and soundness effects of an instrument. It's things like capital and liquidity. It's operational resilience and cybersecurity. All of these are things that we know how to regulate in the financial system, and it doesn't change merely because we're talking about a stable coin when we talk about regulating them. So there is, in some sense, we are learning the lessons of 200 years of experience regulating financial systems and now applying it to a new set of instruments that are innovative and have the possibility of real improvements in the financial system for customers having sort of always on, borderless, frictionless availability in the system.
Megan, I can just bring up a couple, kind of more deeper dive topics. I mean, the concept of rewards has been a big topic in the space. As far as Genius, issuers are prohibited from offering interest or yield or other benefits. The question now is, and we're seeing that a lot, with the Clarity Act and the debate generally, is how to, in our view, how to incentivize people to try this technology, to use it, to experience the benefits that Brent mentioned, how to engage with it, because it is a new technology. It's not something that everyone in this room is aware of, but there's, when you're talking about mainstream America businesses, how to get them to engage and to try it, because it is novel, but we do want them to experience the benefits, the speed, the efficiency, all of that. So that's one issue that's out there. There's been a negotiated language about that, and we'll see, how that kind of plays through the process. And I know that the OCC and the FDIC have addressed this with a presumptive, a rebuttable presumption, and there's some commentary about that and whether that's true to the spirit of the Genius Act. And then the second thing I would mention is with respect to the FDIC's rulemaking. There's in there they've raised the concept of deposit insurance, and the question there too is, when does deposit insurance apply, and when maybe does it not? Does it go beyond a legal relationship with the token holder when it's circulating on permissionless blockchains. So some of those questions, I think they're important to resolve because, Brent, like you said, like just having that clarity out there helps all players in the financial system be able to engage in this space.
I guess probably the only thing I would add is I think in addition to thinking about consistency between state regulations and federal, obviously questions around interoperability with other countries' requirements. It's a global payment system, more so every day. And to achieve some of the goals of making payments efficient and moving at speed, one of the really important issues will continue to be having alignment and having regulators working together globally to try to align standards so you don't further fragmentation.
Yeah, from a regulatory perspective, I think it's a different set of things to get right. But primarily it's just that I think what you both mentioned is making sure that there's harmony between all the various jurisdictions. We want to get protection of consumers right. That's going to be critical for us. It's been at the forefront of the department for some time. So we're very conscious of keeping that at the forefront of this discussion, but it will be interoperability. There shouldn't be advantages to going from one state to another. I think Genius does a decent job of really leveling that playing field so you can't go to one state and receive a different yield or yield at all versus another. Overseas will be a different, and I think longer discussion to see how those rules harmonize over time, if ever. I think we're always going to have a discussion about offshore issuance of US dollar stablecoins, and I think that's going to be one that the market has to sort out. But I think those are the key features.
I guess I might add one other thing, which is I do think that in this space, it's sort of intuitive and obvious, but even more so than in other areas of traditional banking regulation, things are obviously moving incredibly fast. I mean, I know in our business, every 6 months, there are developments that are changing how we're operating. And so given that the governments don't always operate at the same speed as the market, and as technology is now evolving, I think figuring out how to strike the right balance in a sort of principles-based versus prescriptive regulatory approach is going to be extremely important. And I think one would then lean naturally toward more principles-based approach and have to be thinking about rules that, whether it's mechanisms or just providing space for there to be evolution as things are changing that don't depend, for example, on congressional action.
I'm glad you brought up the consumer protection point, all of you. Obviously critically important. The Act was portrayed in many ways as a consumer protection bill because you have the reserve requirements, right? And that's critically important, but there are a number of legal questions still need to be answered in this space, and how do we actually get that right? We might need to let that play out a little bit. And one other area I want to bring up, I don't know if our panelists agree this is important, but one thing I've been thinking about is the insolvency piece, because the Genius Act does include certain provisions on insolvency of the issuers and the kind of regime that they will go through for, if they are banks, bank-like entities, they'll go through more of a bank resolution process. If they're non-banks, it would go through bankruptcy. But Congress has a very clear intent to protect stablecoin holders, and they do get priority, and that is a change to how the waterfall typically happens in these scenarios. So something I think many in the industry are thinking about, and one with there may be more work to come through the regs or through further engagement. So. Another key theme I want to touch on in the debates over not just stablecoin legislation, but also market structure, has been competition. And that is competition between the incumbent financial institutions and fintech companies or other new market participants in the digital asset space. But I want to press an idea, is this actually a zero-sum game, right? Are you just taking one customer and moving them to a new institution, or are you just switching what product they use? Or is it something else? And what are we getting wrong about this current debate and some of the tension that exists as we continue to work through the market structure legislation? How would you frame this?
I should have sat next to Brent so we could hold hands and show we're not enemies. I can start, though, if you want.
Great.
So we're not enemies. I think this has been a debate that's been going on, I don't know, 2 decades, maybe even, if fintech, 15 years for sure. I've done a lot of slide decks about fintechs versus banks from both sides of that debate. To me, I think it's pretty clear that this is not a zero-sum game. If you look at the last couple of decades of innovation, whether you're thinking about Square and point of sale, Revolut, expanding sort of quality retail banking, what Stripe has done in bringing more businesses online, expanding online commerce, I think it's pretty clear that fintech has been accretive for the financial services industry and for the U.S. economy generally. So I definitely think it's a matter of really taking advantage of the opportunity to grow the pie. And then within that, really, to me, it's a question of there are different players who have different strengths and different roles in transactions. We, at OpenFX, as Brent alluded to, partnering with fintechs, we partner with banks all over the globe. We partner with stablecoin issuers in stitching together a cross-border payment. There are a lot of different players that need to be part of any given transaction and service to a customer. So I think different players can play different roles very constructively. And similarly, in thinking about something like a tokenized deposit versus the role of a stablecoin, I don't think this needs to be an either-or, should not be an either-or. Again, different instruments are better suited for different purposes. So tokenized deposits seem to be well-suited for domestic payments, wholesale, credit-linked transactions, whereas for cross-border payments, stablecoins are more effective when you're thinking about wanting to have a programmable payment, 24/7 transparency into the status of the payment. So I think there is room and different use cases for different players and different types of instruments.
Go ahead.
You want
Brent.
the TradFi? So I completely agree. Look, innovation is good for competition. It is good for our clients. It is good for consumers. And so I would resist the idea that there is some bright line divide between sort of fintechs on the one hand and incumbent financial players on the other hand. I mean, if you looked at the amount we spend on innovating in tech, we are a fintech, right? We may not be a new fintech because we've been around a long time, but we are a fintech and we've been one a long time. So the divide, to the extent there is a divide, is often some of it is frankly a vestige of a lack of regulatory clarity around what some of the fintechs and digital asset players in the system do. And as that regulatory clarity is provided, there are some of those things that banks will also do, or that they will partner with fintechs to do, or partner with digital asset companies to do. That regulatory clarity is what we need to have a more efficient, more accessible, more varied, and larger financial system for all consumers, and that's a benefit to everyone if we get there. Eliminating the sort of regulatory lack of clarity, or in some cases regulatory arbitrage that happens in the space, is how we end up with a situation where we get rid of this sort of artificial divide that is people think of as sort of incumbents versus fintechs. It will ultimately benefit all of us once we get that regulatory clarity, because there will not be this sort of arm's length relationship with some of the players just because of a lack of regulatory clarity. There are going to be things that are permissible for banks to do. There are going to be things that are not permissible for banks to do. But the key is knowing what's what. And until recently, we haven't known exactly what's what in that space.
I don't want to take up too much time on that because I 100% agree. And ultimately, it enables consumer choice, right? If something is meeting their needs, like you had mentioned, they'll use that product, and if something else is better suited, they'll choose something else. And so, 100% agree that it's not a zero-sum game in any event, but competition is always good, and and we look forward to getting more clarity.
I do think it's an area where there the U.S. is still behind. And it's just really striking when you go around the world and talk to different regulators and work for an institution regulated as not a bank in advanced jurisdictions around the world. The U.S. stands out in a really strange way, not having a federal, whether we want to call it a payments charter or the e-money equivalent or payment institutions equivalent here at a federal level is just an oddity in the world, and I think doesn't make sense for anyone, including even, I mean, if you're a large bank and you're concerned about competitors not being subject to the same degree of rigor or regulatory requirements, and they might not be exactly the same, but for certain activities that competitors might be engaging in, it's also not in your interest to have large players, non-bank players in the U.S. financial system who are regulated, I mean, no offense to DFS, which is an excellent regulator, but by a sort of patchwork of 50 different regulators through the money transmission licensing regime. And so, that's still something we have to solve. Genius is helpful in creating a federal framework around stablecoin issuers that don't all have to be, IDIs. But there's still a lot of work to be done there, making progress with the OCC, making creative or broader use of the OCC trust charter, sort of trying to find a path to that fintech charter that dates back to John Curry's OCC and Brian Brooks being there, a lot of efforts to, whether through statute or through regulatory interpretation, create a path for federal regulation of non-IDI players. But there's still a lot of work to do there, and also on the master account access for non-banks, which was alluded to in one of the earlier conversations, but we can talk about that later if we want to.
Yeah, there is also the PACE Act. I don't know if a few of you may have heard of it, but there is a proposal in Congress related to some of these account access issues, a chartering issue, and moving towards a model of a payments charter, which doesn't exist today. But we'll see. There's of course debate on both sides, so that one is still very developing. Maybe next year we can talk about it. A few of you have already mentioned the cross-border piece, and I think you have a lot of expertise in this area. And I do want to hear from everyone on their perspectives on U.S. versus foreign jurisdictions, what we can learn from each other. Catherine, I want to give you a quick chance just to talk about stablecoins and what role they should play in cross-border payments, but particularly what kind of regulatory guardrails are necessary for that. You could talk about Genius Act or in foreign jurisdictions.
So I do think there's a huge opportunity for stablecoins to play a really constructive role in making cross-border payments faster, cheaper, and more accessible to larger numbers of people, institutions, globally. I think it would be hard to argue that the current cross-border payment system is working effectively. It may work well if you're trying to make a payment from one city customer to another, US to Japan, for example. But if you're a business in UAE trying to make a payment to a vendor or supplier in the Philippines, or to make a remittance sending money back home, those payments can take days. On the remittance side, I think the current estimates are that the average cost is about 6% for a global remittance payment, which is unacceptable, I think, from most people's perspective. And the current system of reliance on a global correspondent banking network, where a relatively small number of global institutions, like all payments get routed through those, is just not sufficient to support the kind of movement that we need, well, from a technological perspective, what we can achieve through the blockchain, but also in terms of the cost and the timing when you have payments that are moving through multiple intermediaries, each of which slows down the payment and also extracts a cost. And I guess to the earlier point about whether this is a zero-sum game or not, in the current environment, global banks are actually reducing those correspondent banking relationships. It's not like they're expanding with global trade, with global expansion. I think recent World Bank IMF estimate was that they're down 30% or so, global banking connections. And banks are also choosing to exit industries. And so, to me, I think there's a clear gap there that stablecoins and players other than that handful of large international financial institutions, global banks, can and should fill. So I think there's a huge opportunity there. I think the critical steps from a regulatory perspective will be regimes like Genius Act, MiCA, that can provide trust in the integrity and the ability to actually redeem, to maintain par, although we saw in the presentation earlier, it's not just all about there's an operational component to that as well, but, and the interoperability points I think will be hugely important as well.
So what other lessons can we learn then? Both the US learning from foreign jurisdictions or foreign jurisdictions learning from the US as they all continue to develop their digital asset regulatory frameworks, not just for stablecoins, but for digital assets more broadly. We know that the EU's micro regime is already in effect. The UK is implementing comprehensive regime for crypto assets. Japan is working on a bill to classify crypto assets as financial assets. So many, many other developments around the world. And I'll pass it over to Amy and then Brent and then John. I know you've had interactions with foreign regulators and can talk about how you're navigating this space.
Well, I mean, first, just to set the table as you did, I mean, I do think foreign cross-border payments are a key area where stablecoins can be extremely effective. And so from that perspective, the reciprocity or, that type of recognition that can be offered globally is a helpful piece. I think the US, well, I think DFS was the first mover in this space, but then we saw MiCA in the EU, and now they're going through the process of assessing MiCA to see if there's areas for improvement, and I think that's a helpful thing. And we do get questions: how is this going in the U.S.? What are the perspectives? And to kind of reflect on how the EU or the UK or Canada or there's some major markets around the world that are looking at this. So even though the U.S. wasn't a first or second mover, maybe as a federal level, I do think what they're doing today is obviously being noticed and assessed, and I think that's very helpful because they're not going to be exactly the same. We just know that, but getting them as unified as possible, or at least consistent as possible, I think helps that global payments landscape and helping to create those better alignments and especially B2B payments, for example, is extremely important.
I guess what I'd say on this is to add on to what Amy said, which I thought was really thoughtful. One of the key things here is not just the substantive lessons we can learn from each other internationally, but just the importance of harmonization. Because these instruments are inherently borderless. And so realizing that when you have gaps in regulation created by a lack of harmonization, you inevitably leave space for regulatory arbitrage, for illicit actors, malign actors. You leave space for the sort of bad acts we've been trying to get out of the financial system. And so realizing that in addition to settling on what we do, having some agreement on harmonizing the rules, I think is really important. And then in terms of looking at the different approaches, I think the US can learn from Europe to move quickly. And that a single standard is an important thing if you want the instruments to be useful all over. On the other hand, I think the US process, which is more chaotic, will have flexibility that I don't think the EU process will have. That's probably something you could say more generally about the governing philosophies of the two jurisdictions. And then I think, lastly, both the US and Europe can look at some of the work that's being done in Asia and see the sort of forward-leaning, thoughtful, innovative way that's being handled, whether it's by in Singapore or elsewhere. There is real thought leadership that's coming out of Asia that we can follow in terms of adoption and the rules we apply. So I do think there's a lot to be learned. There's a lot of work that can be done internationally on harmonizing through bodies like the Financial Stability Board. I was in government years ago and worked on one of these initiatives for harmonizing international regulation of stablecoins under the Financial Stability Board's aegis. And while that got a little derailed by a small global pandemic that you may have heard of, it nonetheless was an important effort and probably one of the first international bodies to recognize the proposition that the same activity presents the same risks, should have the same regulation. So a lot to be learned from watching international partners and getting together with them.
Just a brief shout out to the predecessors, or my predecessors at the department, and sort of the unique position that both the U.S. has with a both federal and state system, that whether it's chaos or how you want to describe that system that we have, it does breed innovation in the sense that before Europe, before much of Asia, New York had regulations around digital currency. Before any of those jurisdictions came up with stablecoin legislation, we had guidance out in 2022. So that innovation is happening on the state level, and for many good and right reasons, that's something that I don't think we necessarily want to quash, because it is part of our ecosystem of regulation here in the States. That said, at the same time, the department is a full stack regulator in this area. Money service businesses, trusts, and many forms of banks and ancillary financial institutions that are GSIBs and others. So we do see the full span of where digital assets are impacting, from moving money abroad through money service businesses to the issuance of stable coins, the licensing of digital currency exchanges, and into the banking of all of those forms of financial institutions by major banks here in New York. And this has been going on for well over 100 years. So we do have the relationships and do use those relationships internationally to both help educate the rest of the world on what we've been doing in this space. We also learn a tremendous amount about what the rest of the world is doing as they're doing it, because we're in those conversations. The acting superintendent just recently signed an MOU with the EBA. We've been actively working on a DFS exchange program where we bring in regulators from, we've had one recently from the UK, and I think we're now announcing another one briefly with another major European state to bring in their expertise on digital assets to New York. So we're constantly innovating both in our regulation and our guidance, and now in our regulation. But I do think it is part of that harmonization that happens. It may not be the most organized process here in the United States. I don't think anyone will accuse us of that. But it does happen on many levels, both from the international. We communicate very often with our state colleagues. So we're trying to get that harmonization. I do think that's critical, even down to the vocabulary, which is one of the first things we see, is just constantly referring to the same activities by the same terms and trying to get the regulations to reflect accurately what's actually happening in the space. And that's been incredibly difficult over the years. When we look back at our initial Part 200, things that weren't included, staking, it really focused around Bitcoin and Ethereum were the only two digital assets at that time. Stablecoins didn't exist. Yield was a concept when we rolled out stablecoins that nobody was thinking about. And that ability to innovate is going to be key. And so the harmonization and the innovation are really the aspects that I think all the global regulators are going to need to focus on in order to keep pace with the rapid change of this industry. It's the Industrial Revolution on, is being speed run in finance at this time. So we're definitely going to have challenges keeping up, and I think you're seeing that stress on the globe right now, and we'll continue to see it as they try to match each other with the varying regulations that are coming out.
So more work to come on the legislative side, of course. But in the meantime, institutions have to figure out if they're going to invest in this space, right? How are you going to change your business model? And I mentioned at the beginning how some banks have expanded their digital asset offerings, or at least are experimenting with them, working on proofs of concept over the last 18 months. So I'd like to have Brent tell us more about this process. What has actually enabled this activity? Is it the result of shifts in this regulatory environment that gives you the confidence? Is it updated guidance that clarifies what activities are permissible or not? Or are there other factors that you're considering, particularly from the management perspective, when you're saying, will we invest in this space?
Yeah, it's a great and very important question, because it does put the whole evolution in the space in context, right? As I mentioned earlier, we have a tokenized deposit service, Citi Token Services. We're doing crypto custody. We're working with the clearinghouse to create an interoperable, always available payment settlement system. But all of that it's enabled by regulatory clarity, greater regulatory clarity that we've gotten over the past few years. But regulatory clarity is necessary but not sufficient to drive the innovation. What drives the innovation is client demand. Clients want a system where they have 24/7, always on, a payment, atomic settlement, you name it. This is what, if you are a corporate client of ours and you're operating in 100 countries, you want to know that if it may be 5 a.m. here and 5 p.m. somewhere else, and you can still move money from one jurisdiction to the other. And you, all things considered, you'd like to do it with an institution you know and trust. So that's really, the regulatory clarity has been important, but to facilitate this, enable it, but it is the client demand that's driving the innovation in this space.
We've talked a lot about stablecoins and market structure already, but what are the other areas, particularly most urgent areas, where we need policy changes, or we still need that legal or regulatory clarity that we don't already have it for digital assets or tokenization? And if this is not being addressed yet, what do we actually need to do to both support this innovation and address any emerging risks to the extent they're not already being looked at? And this is for the whole panel. I think you can all really speak to this, but I'll just start with Catherine. We'll move down.
I would say, I think the next area that's going to come at us very fast that we're probably not really prepared for from a regulatory perspective is agentic commerce. I think we're going to see very, very quickly agents conducting a huge proportion of online commerce. And that's going to raise a host of regulatory questions that we're going to have to grapple with.
To that, I would also add tax. People in Congress are already, relevant committees are already starting to look at this. There's legislation that's been proposed to address that. Certainly, tax tends to drive behavior, and I think if we, now that the Genius Act passed, how we tax stablecoin transactions is important if they need to be used in e-commerce. Taxation issues around when, is there capital gain or loss if a stablecoin is bought and sold for $1? Should there be information reporting, a 1099, if there's no capital gain or loss, and is that helpful for the government and for business and consumers? And so kind of clearing up that. There's a lot of other more complex tax issues from our perspective, looking at the stablecoin side of it. That would be the next frontier to help achieve the policy objectives of payment stablecoins and enabling them in e-commerce.
Well, it's a bit of a brave new world here. We have, whether it's stablecoins or other digital assets, we have a number of new trust banks, charters, and other novel charters, some issued by states, some by the federal government. We have increased access to the Fed's payment rails, and it's going to be very important for regulators to thoughtfully think through the prudential regulation of the space with when you consider all these things jointly and together and the consequences of some pretty revolutionary moves. We shouldn't be in a world where those changes in access to rails and issuance of stable coins and things like that lead us to a world where we are blind to prudential risks, to safety and soundness. And so I think the obligations of the regulatory state to really focus on what does this enable in terms of flows, and what are the consequences for the safety and soundness of the system is going to be a challenge for the next few years.
I don't think it's really a place for the regulators to say what should be next in terms of what's needed. But I do think you just hit on one of the key points, which is finding ways to regulate somewhere between potentially the activity and the entity. What we're seeing consistently is this activity has moved from a discrete group of small first movers to the most or the oldest banks and TradFi institutions that exist are all entering this space. So we need to find a way to apply the regulations equitably, evenly for the entire market so that the activity can move frictionlessly between these types of institutions and not necessarily have a regime that only focuses on those who raise their hands and say, well, I'm a digital asset provider. That used to be the case, that they were more easily identifiable. And we're going to have to deal with the entrance to the markets that come into this space from abroad or from particularly nowhere. Jurisdiction and jurisdictional regulation is something that's very difficult. When an entity can be a DAO, it can barely exist in the traditional sense, and it can only be on servers probably sitting in Iceland or something. It's going to be very difficult to look across the regulatory landscape and say, well, who's got this? And who's going to identify the risks that this entrant is injecting into the market? Because it is going to hit all consumers at some point. And I think that's the next space that I think, from hearing from you and listening to the rest of the market, that we're going to have to start addressing.
You've already anticipated my last question for the day, and that's how do we balance promoting this responsible innovation with also maintaining financial stability, safety, and soundness concerns? That always has to be a piece of it. So what regulatory outcomes are going to indicate that we've actually achieved that appropriate balance, especially considering there's an increasing amount of interconnection between traditional financial markets and the digital asset space? They are not separate at all, as you've all explained through what your institutions are doing. And do we need any new approaches to deal with this? I'll go the other way this time. John, you can start as the regulator, and then we'll move down and close out for the day before a break.
Yeah, I'm not sure how to answer that question with any level of specificity, but I don't know what will be success. I think we will all know when failure occurs, when there's an event that happens and we're doing just that, so deciding how did this happen, how did somebody not spot this issue. It's going to be excessive leverage in the market that nobody saw. It's going to be a cryptographic failure that wasn't particularly regulated by anybody using those rails. Those are going to be the challenges, and I don't know what success will look like in terms of that, but we will be able to see that failure. And I think the history of, well, all things, but the history of finance has really been shaped a lot by failures, market events where things went terribly wrong. It's the goal and job of the regulators, I think, to try to mitigate that. I don't think we can prevent it without stifling innovation. And this department, this superintendent, is committed to innovation, and as I think I've overstated in this conversation. But yeah, it's that balance that we have to get right, and the indications are going to be usually problematic. But we'll have to get through that as an industry and as a global set of regulators, a national set of regulators.
I guess I'd say I think there are two criteria for success. One is that the regulation has allowed us to be innovative in a way that offers greater access and more efficient access to the financial system, to a greater group of people, and thus greater customer offerings. That's absolutely necessary. The second criterion for success is we get to a point where, to John's point, there will be occasionally problems in the financial system, but we don't want to be in a place where we look at a problem that happens in a fintech or a digital asset company and say, the reason that happened in that space is because that's more lightly regulated, and so this is a risk we know and we didn't do anything about it. And so having that sort of regulation where you don't think, oh, that space is so much less regulated that threats persist there and disproportionately exist there, while also not stifling the innovation, those two criteria together to me are what I would say is regulatory success.
It's hard to go after, after a few good responses, but I think what I would say too is just to say that, and just my personal experience over the years, is you do the best you can with the information you have, both on what's happening and operational today and what maybe is potentially feasible in the future. And then, we need to set guardrails to make that clear, the rules clear for all the different players in the ecosystem. And then, as we can see with the EU, they're assessing it again. We may need to make tweaks as you mentioned, like this space evolves very quickly, and we will certainly have to amend this, amend statutes in the future. But I think we just need to put together the best we can so that there is more clarity on what the expectations are, and that, where banks weren't sure what they could do in the space, that now they know, that those things are in statute, so that then the industry can move forward with some certainty and real investment, for the benefit of financial services space, consumers, businesses, the entire ecosystem.
Yeah, that is a hard question to answer. I would say first, it would be success if we see some, thinking about the global picture, some, for example, stablecoin issuers who have previously operated more outside, like a real regulatory perimeter, brought inside, which I think we're already seeing that happen as a result of MiCA and Genius here in the US. So I think that's a positive development. I'd like to see that brought to full fruition. Second, to Brent's point, which I agree with, about thinking about the safety and soundness risks presented by some of the new players who are getting licenses very, very quickly in a great accelerated OCC process. I think it would be success if 2 or 4 years out, we see a significant number of those new players, for example, those trust charters, operating without major failures and successful and contributing to the ecosystem. I think that'll be a success. And similarly, seeing more institutions receive access to Fed payment rails. Kraken was the first. Hopefully there'll be some more, but that the right balance will be struck if there are some and they're functioning well, successful from a business perspective, but also haven't caused issues. And then the last thing I would say, I guess back to the point I'm thinking about cross-border payments, there'd be some pretty clear, objective metrics about settlement times could come way down and costs could come way down. I think that's very achievable in the next 2 to 4 years.
Plenty of opportunity, plenty of work still ahead. I always learn so much when we're able to discuss these issues with market participants and our colleagues at other regulators. I've learned so much from our conversation. I want to thank all of our panelists for being here today and sharing their wisdom.
Thank you.
So thanks all. We'll now have a short break. Refreshments available again outside, and we'll start again for our next panel at 3:15 p.m. See you soon. Thanks. Welcome back, everyone. So our next and final for today panel is moderated by Leslie Connor Warren, PMI Policy at the Federal Reserve Bank of New York, focusing on digital asset value propositions for the financial markets.
Okay, well, good afternoon, everyone. Thank you so much for joining us today, and especially for joining this panel on the value proposition of digital assets. I'm Leslie Connor Warren. I work on the payment and market infrastructure team here at the New York Fed. And I'm actually kind of reflecting now that I've given this panel a very vague title, but I know it is going to be a really robust discussion on the business side of digital assets. We are going to dive deep in the nitty-gritty of how digital assets are really deployed in financial markets and to consumers. We're going to discuss the strategic choices involved in executing the business of digital assets, including the role of infrastructure and partnerships in meeting those goals. My hope is that our discussion today will close us out, but will also energize us for the reception. And I have a wonderful panel to do just that. Today, I'm really pleased to welcome Ryan Rugg, Global Head of Digital Assets at Citi Services, Julia Kuchman, Vice President of Commercial and Money Movement Solutions at Visa, and Rick Schoenberg, Head of Coinbase Prime. So thank you all for joining us today. Maybe we can just start with reintroducing yourselves and tell us a little bit about the businesses you lead. Go ahead.
Yeah, great. Thanks, Leslie. Appreciate it. And thank you for the opportunity to come. So Ryan Rugg, as Leslie mentioned, I work at Citi heading up their digital assets for their service business. Been with the organization almost 4 years, but have been in and around this space, Leslie and I, across spaces at R3 for close to a decade now, trying to build infrastructure for large financial institutions. And last year we launched Citi Token Service at Scale, which is our tokenized deposit solution. That we're live in 5 branches, processing, billions have hundreds of clients. So really starting to see adoption in this space, and it's a really I feel like we're at an inflection point, and I look forward to this conversation.
Hi, everyone. It's great to be here. My name is Julia Kuchman. I've been at Visa for about 10 years in San Francisco, London, and now New York. I lead our product team on stablecoins within the commercial and money movement solutions business. I spend most of my time on our money movement platform called Visa Direct and how we can make it more efficient and help our customers scale into stablecoins. But I also work closely with our global crypto team, and looking forward to this discussion to dive into those different aspects here.
Hi. Hello? Terrific. Thank you. My name is Rick Schoenberg. I work at Coinbase. I've been at Coinbase for about 5.5 years. And before that, I worked at various banks on the foreign exchange side. At Coinbase, I run our prime brokerage business, which also encapsulates our custodial business. We view that business as really sort of the institutional operating system for the crypto market. We partner with many people that from the outside, and something we'll probably discuss, might appear to be our competitors. We view them as partners, and it's a very active space for us. We have multiple products that have really, I think, found product market fit, starting with our custodial business, which opened with the help of the auspices of the New York DFS in 2018. We're now the world's largest digital asset custodian. More recently, we have launched U.S.-listed derivatives at Derivatives Exchange, which is now traded a few $100 billion of notional. And we also happen to be a supporter of a certain stablecoin, and we settle round numbers at roughly $1 trillion a year of stablecoin payments.
Okay, thank you. I'm going to start the next question by stating the really obvious fact that you each represent really archetypal firms in the financial markets with very distinct business models. And I think it would be nice to start with how you think your company's position within those markets, within financial markets, influence your strategy on digital assets. I'm curious, what are the specific use cases you're trying to address, and maybe in a forward-looking way, how you see volumes for those use cases becoming material compared to where they are today. Yep, anyone can start. Go ahead.
I'm happy to start. So, roughly 3.5, 4 years ago, we did a survey amongst our top clients at Citi about what was one of the real pain points within the payment liquidity industry, and it came up about real time. They wanted to remove all frictions within the banking system, if it was cut off, if it was weekends, to be able to remove money frictionlessly around the globe, and that's where we started. And then but they also wanted multi-bank strategies. They never wanted just one bank. They have hundreds, if not thousands, of bank accounts across multiple banks across the globe. So really focused on that, and we landed on blockchain technology because it connects disparate parties together, and interoperability has always been very important to us. So we launched with that, and we strategically targeted our largest money corridors. So we're live in the US, UK, Hong Kong, Singapore, and Dublin. We also targeted the largest currencies, so we're live in USD and Euro. Citi roughly moves somewhere to $4 to $5 trillion a day. So it was really important to kind of target the corridors that had not only the largest volumes, but also the largest frictions. Because if it's, right now it's 3:30 here in New York, it's 3:30 a.m. in Singapore. So traditionally, banks are closed and you're unable to move money. We wanted to remove that. So now clients can move money regardless the hour, the time. And also strategically, I learned from my early days in this space, obfuscate the complexity of the technology. Clients are not ready to host nodes, set up wallets, manage keys. So for the way that we did the architecture, as you mentioned, is it's fully embedded into our traditional solution. It's just a drop-down box or an API, depending on how clients want to connect, that they're able to move money. So completely obfuscating that. And I view that this technology will truly be successful if we're not talking about blockchain and tokens, just as we don't talk about on-prem or cloud. It's just the actually underlying utility of being able to move money frictionlessly. So the speed of money moves at the speed of data on the internet, and that's our aspirations, and also making it multi-asset.
I can go next. So I love this question. I think about this as sort of how we played a role as Visa in connecting the world to kind of innovations in global commerce. So what I mean by that is we service about 14,500 banks. We operate in 200 countries and territories around the world. And as new technologies come up, we often play a role of helping to set certain standards, set certain rules, getting folks comfortable in terms of how to kind of remove some of the complexity and come all together. And so we've started in a few different ways. Back in 2018 is when our global crypto practice started. And so there's three main ways that we've been operating today. One is on stablecoin settlement. And so that's how different financial institutions, issuing banks, acquiring banks are interacting with Visa. We are doing about $7 billion a year in terms of volume that gets settled on our network in stablecoins. And we've recently been expanding that into 9 different coins and chains. So giving more and more flexibility as we have feedback from our financial institutions that they want to be having kind of expanded ways to operate their treasury in their interactions with Visa. Another really exciting area has been around stablecoin linked cards. So you may know about these. This is if you have a crypto balance or a stablecoin balance, being able to spend against that balance anywhere in the world where Visa is accepted at our 175 million merchant locations around the world. We've seen that volume grow up to 7 billion as well as our latest run rate, and significant growth in our 160 programs there. And lastly, there's a focus on building out the infrastructure. So kind of similar points that you're making. We've been a design partner in some of the payment-focused blockchain initiatives, including Tempo. We've been a super validator on Canton as well. So I think it's a natural sort of evolution as there's new technologies coming into the fore. How do we make it really easy for consumers to participate in those, but kind of seamlessly interact how they might normally be using a credential?
So, I mean, I love these use cases because they're exactly what we as a firm have been hoping to see out of this industry. When Coinbase first started, they sort of took the bold mission of sort of, expanding economic freedom in the world. And we sort of have that as our compass point. And you think from an institutional perspective, if you do custody, staking, on-chain DeFi type work, and payments, how does that really help? But to the extent people can frictionlessly move money 24/7, you have full compliance, it's programmable money, the world moves ahead. We take those frictions out. I think one of the prior panelists referenced the roughly 600 basis points that people burn every time they move dollars into a foreign currency and send it to their home country. We exist to solve that problem. And in terms of what Coinbase is building, we're building the same infrastructure that was mentioned here. We're happy to provide that infrastructure as a full integrated solution for some clients, and other clients just want one component. Maybe they just want to use us for custody, and they'll build their own transfers and settlement logic. Or maybe they'll use us for everything, and then backfill and as they build their own technology, move on to their own kit. We are ecstatic to have everyone here succeed, and that's really our goal in what we do. We work with everyone, and because we're looking for the larger market to succeed, which again sounds a little weird, but in the way we see the crypto market or the digital asset market evolving, there isn't just one person who's succeeded, because that world doesn't exist. For success to happen, we have to have all the firms doing it. And I also believe, as Ryan said, we have to stop talking about all the technicalities and the cryptic things in crypto, because I think that's dead weight. It complicates things, and people can't engage as freely if they have to think about, like, what are the settlement rails, what's the nature of this token, how does this blockchain work, and looking for us to move past that.
Yeah, I think maybe expanding on that a little bit, I want to dig a little bit deeper, into the goals and the customers you're trying to reach. I think there's a broad sense of understanding, among all of us, that digital assets represent, potentially more available payments, trading, et cetera. But I'm curious if you could each expand on, what specifically you see driving client demand, especially compared to maybe other digitized products and services in the market today.
Yeah, happy to talk about the use cases. As I mentioned, the first, what we went after was like liquidity and payments and being able to make that widely distributed across the branches that we're live in. And so one of our largest clients, our heavy users, is an e-commerce platform here in the US that is buying goods all day, weekends, holidays, as small as a couple of dollars, as large as hundreds, and sending the money back to Asia real time. So think of the whole supply chain. We're not batch settlement, it's real time. Really being able to shorten the entire life cycle of supply management. We also have use cases in cap markets where, for instance, here, we had during Chinese New Year where Singapore was closed, we had typically this broker dealer would forecast what the US equities and bonds and margin calls they were going to have here in the US. Since Singapore was closed, they were unable to send money. Well, now they didn't have to forecast. They were actually able to send the money exactly what was needed when needed to purchase the bonds, equities, and margin calls. And the use cases continue to expand. Like we've seen it used for M&A activity, which is unexpected activity, or missed forecasts. We're serving large multinational is kind of the client base that we're focused on right now. That has money in numerous countries across the globe. We're live in Citi has 90 branches, 5 for CTS. Instead of having to forecast, they're able to send the money that's needed when needed into these different zones, regardless of holidays, weekends. And I think that's going to continue to grow. The various, again, liquidity was kind of the core in payments, and now we're starting to see in cap markets, assets really expand across the ecosystem.
Yeah, can I ask you a follow-up question about that? So, I think when you've given some examples about kind of shipping and kind of corporate treasuries and the value that those customers see in really real-time payments. I'm curious how you think about, the provision of credit for payments, or, you mentioned batch processing really isn't something that those customers are really looking for. Do you see this technology and these services also, being valuable to customers that do? And how do you think about providing kind of different types of settlement to different customers?
Yeah, absolutely. And the credit creation conversation comes up a lot, especially when you talk about stablecoins and tokenized deposits and the fractional banking system and being able to provide credit. And we partner with Coinbase on pay in, pay out. So being able to, as you mentioned, the infrastructure, we partner to be able to, we view this as an alternative set of rails that if and when our clients want to use it, we want to be able to provide the service. But the different type of settlement and different types of use cases out there and the need for credit, there are implications to this technology over time. And one of the reasons that we're focused on tokenized deposits is because it is client money, right? They're just moving the money that they currently have in one jurisdiction, regardless of the hour, to a different jurisdiction to be able to do that. But long term, could they reduce credit lines? Could they reduce overdraft? Could they reduce other things, especially with the whole programmability of it? Absolutely.
Thanks. And you're the bank, so I had to ask you about credit. Go ahead, Julie.
Back to the use case point, I'll kind of pick up on what Ryan was talking about around the expansion in use cases. I think that it's still a nascent space, but we're seeing a lot of acceleration in terms of prediction markets or on-chain lending. So I think we've kind of moved from a lot of dialogue around just business-to-business types of applications, or kind of this remittance one that you picked up on. I think that's still going to be where a lot of the focus remains. And I think the reason why is because there's still so much challenge in those sectors, right? Brian talked about banking hours. We can see cost is still a challenge. Traceability is still a challenge. So I think for invoice payments, for supplier payments, for treasury management on the business side, there's still a lot of opportunity to embed stablecoin solutions in existing workflows and within existing software in order to make those experiences better. And then similarly, we see a lot of remittance platforms leaning in to offer that as an extension to their existing solutions as well.
So I'll just chime in from a slightly different angle, but as stated, we do work with many banks providing services. And when people think of Coinbase and our prime brokerage business, people think of, oh, you service the ETFs, you look after big hedge funds, which is true. That is a core part of that business there. And that we could say largely has found product market fit and is succeeding. But I think for the larger market to grow, we need the stablecoin and the payment on digital rails to sort of permeate through. So I'm very excited about clients we work with like Shopify or Checkout.com, because now we have use cases sort of all the way to the end consumer. So we do some B2B, but we also effectively enable B2B to C. So as that whole chain comes through, we now have Visa cards with backed by stable coins. People can spend those at a venue to a merchant, and we can out the other end have that merchant paid in fiat. And now that the era of debanking is behind us, we actually have GSIB rails. We're able to get fiat very effectively out to those clients very quickly. And so the credit creation, I think the velocity of money and the shortening of time, where you don't necessarily always need to extend credit because you can have instantaneous payment, you can have certainty of payment, and you have the programmability, which isn't something that's really been fully leveraged yet, but it has lots of promise.
Yeah, maybe a follow-up for you, Rick. It sounds like, what you're saying is a little bit of what's driving demand, for Coinbase and, the prime broker space, maybe in particular, is this ability to kind of vertically integrate the types of payments and services that they want. Would you agree with that?
So we do offer the sort of the integrated service set, which makes it very easy for someone to come in and say, well, I want to get started in the digital asset business, or I want to enable USDC, payments from clients. I want to, we say, yes, we have a turnkey solution. You can take this now. They're like, okay, but I want to add this of my own. It's like, okay, you can do that as well. You can either build on top of ours, or you can, at a later date, take our solution and then add on to it. But the main driver of that is just general adoption. And I think the other thing, which if we sort of differentiate where we were perhaps 2 years ago, we sort of felt like skepticism was the highest friction point with some people. I think we've moved beyond that, where now the plumbing pieces, the infrastructural pieces are what stick people. And I think that's what we all here are solving. And like plumbing, if one part is unplugged but another part is still plugged, it doesn't quite run right. So I think that's why I'm sort of saying, I think we need to fix a bunch of places, and all of a sudden we will have success at a larger scale.
Well, I think that's a great segue to our next topic. We've discussed kind of strategy, goals. Let's move to execution. I think, infrastructure is a big part of that. I think for a long time in this space, the infrastructure conversation has really fallen along technical lines. Rick, you mentioned this a minute ago. Is our infrastructure going to be permissionless or permissioned? And I'm curious if you all think that those categories are really still the relevant ones when it comes to infrastructure, or if there are other elements you think that have risen in importance. And if you could also kind of speak more broadly around how infrastructure kind of plays a role in your strategy and execution. Yeah, anybody, go ahead.
So our strategy around infrastructure really is build, buy, partner. And I talked about Citi Token Service, which is an example of what we're building internally ourselves at Citi, partnerships like we have with Rick and team at Coinbase. And when I say buy, invest, we've invested in several networks out there like Fidelity, BVNK, and continue to invest in various networks. So I think technology does play a very important part in this, but it's not the only piece of the infrastructure that matters. When you're actually starting to build and scale this technology, like take City Token Service, for example. We're live in 5 branches. Every branch that we've rolled out, we work with our in-country regulators, OCC, FDIC, SEC, and so forth, but also with the regulators in the country. So even though it's on a private permission version of Ethereum, like we worked with when we launched Hong Kong, HKMA, when we launched Singapore, MAS, FCA, and so forth, I think it's extremely important to make sure that the reporting, the governance, the liquidity, everything that you're building with this new technology, meets the standards. And we started to see, legislation and regulation around this. And, I think that the ones that abide by these rules are going to be the ones that are going to start to scale. Because, we've had, fintechs come to us about stablecoins. They're like, oh, there's no stablecoin regulation in that country. You can move that trap money out. It's like, no, we have a banking license. We're not going to circumvent regulation just because the technology can enable it. It's more about that safety and soundness that we've been able to, give our clients. We're going to continue. This is just a new set of rails that we're viewing, but the rigor that we've applied to our traditional business, we apply to our digital asset business with even more scrutiny, to be honest.
I guess I'll jump. I don't think that the debate in the end needs to be permissionless, permissioned, this chain versus that chain. I think, again, those are those nerdy details that are so much fun to talk about, but we, in the end, add no real value in doing it. When you go to a regulator, or decades ago, you go to a regulator, they didn't ask which version of Sybase you ran on or Oracle. They just assumed that you had backups and everything else. So I think the attributes we're looking for are 24/7, low friction, regulated, so you can audit. And the aspect I like a lot is sort of what I call the T-minus 0, the instantaneous settlement. I think the speed really differentiates the digital rails versus the traditional rails. So as long as you achieve those objectives, I think the other attributes are secondary.
And I would agree that we've moved beyond the sort of permissionless type of discussion. I think that there's some very basic reasons why the field hasn't scaled as much as I think it will over time. I think one challenge is still commercial models. So a lot of the customers I speak with all around the world are still struggling with, is this really a pain point for my customers? Is this truly something that I need to lean into now versus other areas? So having real clarity in terms of the business problem being solved and the specific customer willingness to pay for that is one consideration. I do also think that trust is a meaningful one. So yes, there needs to be sound technology working behind the scenes, but fundamental things like, what if I send to the wrong wallet address? How can I recover funds? Or who do I contact if something goes wrong? Those areas, and having kind of rules and a framework around that will be, I think, aspects that will help to drive acceleration over time.
Yeah, I think I'm struck a little bit that, I think in each of all of your responses, I'm hearing that some of the kind of traditional things we think about in finance around governance, rules, are kind of moving to the forefront, and the technology beyond what it enables in terms of business features is, the categories themselves, or, what we call it, is less important and is maybe less visible to customers in the end state we're moving towards. But Ryan, you mentioned something around build, buy, partner, and I want to kind of pick up there. And I'm curious how you each see partnerships as also a part of the way you execute on digital assets. And, do you have a view on this kind of optimal mix of build, buy, partner? Are you partners with one another? How do you see kind of partnerships playing into your execution?
Yeah, I think partnerships are key, especially, and also when you think of the complexity curve, when you look at build, buy, partner, building is the most resource intense. It's the most, I would say, infrastructure, compliance, regulatory, legal, that you have to, really, because you're building it from the ground up. When partnerships, for instance, with some of the partnerships we have, we'll just do the fiat leg, or we'll just do the, the custody leg as we're starting to launch. So it really depends where it is, that you're focusing on the curve. And then buy, we're an investor, right? We're investing in these various networks or technologies for the future. So I think it really depends, but I think partnerships are key in this industry. And, I partner with all the, both my fellow colleagues on the stage, but with several other fintechs in this space. As we're getting clarity in this space, there's a massive opportunity for us to collaborate on even traditional banking services. In the past, there wasn't a lot of clarity, no pun intended, in this space. And what does it mean if, we were to work with, one of these issuers and their token was used in illicit behavior? How does that work? And, making sure that, but I do believe that partnership is key, especially as you're starting to get up the curve. But there's a massive collaboration across the industry where I think back in our R3 days, it was, all of these fintechs thought they were going to put banks out of business. Like that was what we were doing. We were building the future infrastructure and all the banks were going to have a business. That has completely changed. That whole sentiment is more about how can we work together? How can we scale? There's still the pain point of converting back to fiat in the crypto world. It still takes time. So Citi Token Service can service the industry as well on that side of the house.
That perspective resonates with me. I think you have to be very selective in terms of where you decide to build. How we're thinking about this is back to our sort of network of network strategy, which Visa talks about a lot. So we've started with the card network, moving into open banking, and have moved into sort of account-to-account payments. This is sort of a natural evolution. And so our role typically is on that sort of standards or building highly resilient technology that then an entire ecosystem can kind of flourish on top of, right? We want banks to be tapping into it. We want fintech and challengers to be tapping into it. And as Ryan said, we're all kind of working together. And I think that that helps us learn faster as an ecosystem. It helps to uncover unique challenge areas and to really kind of put the best and brightest minds on hard problems. And so I think that that partnership element will remain essential too.
Yeah, can you actually say a little bit more about how you see Visa's position in kind of a network of networks as you see it?
Yeah, so we've talked a little bit about how we're focusing in on settlement and on stablecoin linked cards. And so within that context, we're supporting a variety of different chains. We're supporting a variety of different coins. We're working with partners like Reap and Rain and Bridge, who are sort of stablecoin linked card sort of industry pioneers, right? So we want all of that activity to feel like they can make it really simple to reach the end customer. And so that's what I mean by sort of network of networks. It's helping to invite all of those different players in and create solutions that are compelling for merchants and consumers around the world.
Yeah, it's terrific. So on the partnership front, as I said before, obviously it's sort of a core part of our strategy. Our CEO loves to say, crypto, the water's warm, come on in reference to would-be or what people theoretically brand as traditionally competitors. And we do endorse that, and that's not just a funny little statement. But in terms of the partnerships, there are times when we go in and I pitch to all the big banks that they should use us for sub-custody, because custody is hard and it's very difficult to build and a lot of security, and no one wants to do that. Just they always want to build their own vault. They want to do their own thing because that's fun. And your engineers, they want to do it. And I just tell them it's hard, it's going to be expensive, and you're not going to kick off your custodial business to compete with us for a long while. Use us for sub-custody as a white label and bootstrap it. And that works sometimes and sometimes it doesn't, but that's generically our approach. And then in our prime brokerage business, we are an agency smart order router. So when a client wants to buy or sell a large amount of a digital asset, we don't just trade on our own exchange, we trade on all our competitors' exchanges as well. So we have partnerships there that are very solid. We're a top customer for all our competitors. And we do that to help our clients. And I'm super excited when one of my other venues gets a huge chunk of volume. They're happy, I'm happy. So I think the partnership is how we collectively succeed.
Yeah, I think that's a really salient example. Thank you. Maybe transitioning from execution, maybe pulling back a little bit to the market structure, market level view. Rick, you mentioned this, I think, in some of your previous responses, but really this is still a market under development. And I'm curious, when you think about the market structure as a whole, what do you see as still really under development or needed as to have the market kind of mature in the way you need it? Are there specific challenges that need to be addressed? I think Ryan, your colleague in the previous panel mentioned tokenized deposit clearing. I think that's maybe one example here, but you all can take this question in any direction you'd like.
Sure. So there are lots of topics in there. I think if we look back on the success of Coinbase, which predates me for sure, Coinbase made a decision early on to lean aggressively into regulation. Though obviously, over the last several years, we obviously sued many regulators and had lots of kerfuffles there. So leaning in is, I guess needs to be explained. We are very much pro-regulation. If we get, I'm going to butcher a word, clarity, but as we get clear rules and regulations, that's how we pave a future that's sustainable. And that's what we have been pressing for. And Genius Act passed, yay, waiting for the regulations to come out formally, which we can then act on. So that's in the making. And then there's obviously Clarity Act, which will be very helpful. Rules and regs around stablecoins and rewards and such, very important. But I think there's also another area around the tokenization of equities and other real-world assets, which other parts of the world are moving a little faster than the U.S. And at this point, the U.S. regulatory structure of an SEC, a CFTC, et cetera, sort of is creating tensions. And I know there's a panel tomorrow on prediction markets. There's one of our competitors that's suing their regulator, which makes me chuckle in the way in which they're doing it. But I think that's what we need. We need that sort of spotlight of clarity on that regulatory path so we know what to do and how to do it properly. And if we don't like it, we'll protest and we'll win or lose. We'll do a bit of both probably. But that alone is what we need to keep accelerating.
I agree with the sentiments you're making. I think that the root of that is really clarity in terms of how to operate. So if you're a financial institution, you can't really operate in gray without some risk. And so I think that it's helpful when the rules are kind of spelled out. I do think that this point you were making before around interoperability is a meaningful one. So we've seen a lot of activities. Stablecoins are launching all over the world. There's different types of assets, as you referenced, that are coming online. And that, I think, is healthy and great because that is what happened in the fiat world, right? But there needs to be some sort of way that it all comes together. That's a role that Visa usually tries to play because we're sort of naturally kind of at the center and want to make it really easy for folks to interact with each other around the world with a clear sense of what happens if something goes wrong, what are the ways that it should operate, right? But I think as that kind of fungibility across different types of assets becomes true, people will be more confident to use them and to invest their money in them.
And I guess just picking up on the interoperability piece, it comes up in every single panel that I'm on, like about interoperability, and it typically focuses on how coins interoperate with one another. But what I've actually found, like the bigger pain point and what clients come to us, like especially the large enterprises, is like right now where they are in their journey, they don't want to hold coins on their balance sheet. They want to be able to convert it back to fiat so that interoperability between crypto or DeFi and traditional world assets is so critical. And like that's how, building the infrastructure, we've made some very strategic decisions not to make this a standalone entity. Like Citi Token Service is fully embedded into our traditional payments, liquidity, trade, custody business that you can have full interoperability between traditional assets or traditional cash as well as tokens. And like that's where we're focused in like all the solutions that we're building. Like as I said, it's a drop-down box that you can choose FedNow, you can choose ACH, you can choose or Citi Token Service, however you want to send your money. It's really the optionality of the client. Like we're not pushing digital asset. There's multiple solutions out there that solve the real time, but like we do believe that there's some fundamental qualities in this technology, especially atomic settlement and DVP, that gives you that interoperability, to use the word again, between cash and assets instantaneously.
Yeah, I think that's an interesting framing around, interoperability is really another way of saying optionality and how that's really at the center of customer demand. And I think we're kind of coming to the end of our time, so I have kind of one final, more forward-looking question. I think an observation of the evolution of digital assets in the last few years is that financial functions are really being redistributed and dispersed across different types of firms. Banking, payments, trading are not necessarily provided by the same firms to the same customers as they were, 5-10 years ago. And this trend of unbundling, as it's called, I think has occurred in other industries like media. And using that perhaps as an example, media is also kind of headed back towards a reconsolidation phase after that kind of period of disruption. And I want to hear from you all how you see this market, which I think is pretty broad in its current form. You have a lot of different types of firms offering lots of different products and services. Is that kind of the end state, or do you see, specialization emerging, consolidation? And of course, I'm going to give bonus points if you can identify any parallel trends that you see as relevant here, like AI or prediction markets, as kind of a teaser for our panels tomorrow.
Tough one. In terms of bundling, unbundling, I think we're kind of doing both at once. So the ability to, just interoperability, to have money be frictionless and fast, you can move really quickly from, if you have your assets on one platform, you can move them to another. So lowering switching costs allows you to sort of move from one bundled place to another. Or if you want to use one provider to buy an asset and then you want to quickly move it to someone else to then store the asset, you can unbundle sort of the prime solution and you can have it that way. You take on certain costs and certain risks, but like you can either bundle or unbundle at the same time. So I think that changes a little bit. Now, in terms of your to go for bonus points, between you and cocktail, so I'll try and be quick. The AI element becomes interesting because at the same time as you have like agents doing things for you, you don't care because you're not really knowing if they're using a bundle or an unbundle. Probabilistically, they're going to unbundle because they can. And so the various solutions that people are putting out, we rolled out an SEC registered investment advisor. We announced it the other week. When that gives you advice or does trades for people, that's advice and trading together, but I could see where people have been using algos or agents to trade on Coinbase or other venues, and we wouldn't even know. So like we don't even perceive when things are unbundled or bundled. So I think the world is evolving in a way which is a little different. Sort of similarly to permissionless, I think the bundle unbundle thing is going to be murkier, not clearer.
I view it similarly. I think that it's going to remain fragmented because there's going to be high competition for this kind of pie that's available. I think that there's going to be specialization in types of service providers, but I do think I'll actually go back instead of going forward. I think similar to how payments have kind of evolved within embedded software, that trend is around providers of payment services. They don't want to work with 10 different companies. They want to work with a handful who can manage the complexity behind the scenes, or perhaps just one or two. I do think that there'll be some similar aspects here because you want to rely on one trusted partner to who holds kind of liability, who you're entrusting with compliance if you're not doing all the on-chain activity yourself. So it'll be lots of different providers, but some amount of kind of packaging into solutions that feel more consolidated or more converged.
And I guess to take a contrary kind of like
Please,
perspective on this, and I think about like Citi's traditional business, right? Where corresponding banking, payments, liquidity, banking, markets, wealth. The way that I think about this technology and like the rails, it's really going to enable all the businesses, like the custody business and the cash business have to work together. So businesses that had, traditionally been in treasury management or on the asset management custody side of it have to come together. So it's less of the unbundling. It's almost like bringing these together to add more efficiency and remove the latency from the industry. So I think that, if this technology is built correctly and wallets will be fully fungible if you're using it for your payments or if you're using it to hold your assets for custody. So I think it'll actually bring the industry together more.
Okay, so maybe partnerships on the front end, but fragmentation and unbundling behind the scenes. Yeah, okay. Well, thank you all for this wonderful discussion. Really appreciate all of the preparation and participation today. And thank you all for joining this panel. I know I'm pretty impressed that we finished right at 4 o'clock.
We're the only thing then doing cocktails, like we know that.
Yeah. Anyway, thank you all very much for your participation as audience members, and let's give a round of applause to our panelists. Thank you all.
Thank you.
Well, thank you so much, and good afternoon, everyone. I only have another 60-minute speech that I'm prepared to deliver. But beyond that, as we wrap up the first day of the New York Fed Innovation Conference, I want to express my gratitude to our speakers, our panelists, and all the attendees for making today such a success. We had a packed agenda. We had thought-provoking discussions on the future of payments, the role of central banks in innovation, and the potential of AI in finance. From the insightful keynote address to the lively panel debates, it's clear that we're all passionate about harnessing innovation to improve the financial system. And I'm thrilled to see so many experts from different backgrounds and industries coming together to share their perspectives and expertise. We look forward to seeing you all tomorrow morning for the second day of the conference. Breakfast and registration will be available starting at 8:30 a.m. At 33 Liberty Street in the same way that you came in today. And then for those of you continuing the conversation at our reception, please follow our colleagues down to the first floor. So we'll be where we had lunch earlier today. And the young companies that are out in the hallway also won't have the tables and demos set up tomorrow. So I encourage you to stop by one last time if you didn't have a chance today to learn about the interesting products and services they're offering before you head down. And if you have anything with you, please take it with you. So don't leave anything here, otherwise it will probably disappear. So again, thank you for a wonderful day, and we look forward to seeing you downstairs and tomorrow. Good morning, everyone. Welcome back to the New York Fed Innovation Conference. I hope everyone had a chance to recharge yesterday. It was a stimulating first day, and we're looking forward to another day of fascinating discussions and conversations. Today we'll dive deeper into the world of fintech, blockchain, digital currencies. Our agenda is packed with sessions including moderated discussions with senior leaders from industry and the official sector. As we explore these cutting-edge topics, I encourage everyone to think about the implications for the financial system. How can we ensure that innovation serves the greater good? How can we balance the benefits of innovation with the need for stability and security? Practicing what we preach, using good innovation principles, we're going to have a slight change to the agenda today. So Mariam Farboudi, who is going to deliver a research spotlight on transformative AI, was flying in from London, and due to the heat wave in Europe, her plane was canceled. So she's still coming, but she's just arriving a little bit later than originally planned. So at the slot that she was going to present this morning, we've put together a different panel on innovation in the second district, where we'll discuss innovation with the 5 startup companies that were presenting at the expo yesterday, and then Mariam will deliver her presentation slightly later in the day. So thank you again for your participation. I look forward to another day of inspiring conversations and insights. And with that, I'm now delighted to introduce a discussion with Kartik Athreya, the Director of Research and Head of the Research and Statistics Group here at the New York Fed, and Lynn Martin, President of NYSE Group and Chair of the ICE Fixed Income and Data Services.
So good morning, everyone. Hopefully you can hear me. Lynn, it's a pleasure to be with you today, and it was a real pleasure to just get to know Lynn for a few minutes before the event started, so I think this will be fun. I think the way I wanted to organize the discussion was first to learn a little bit about your path. I think that's of interest to a lot of people, including me for sure, and maybe frame it in an asset management frame, which is looking back, over your career, what decision would you sort of point to as having had both the highest payoff or return in the end, but also seemed the most risky going into it?
Yeah, no, first, thanks so much for having me today. It's great to be with you all, both here and virtually. Great question. So I started my career, which most people don't realize, as a computer programmer. I have a bachelor's degree in computer science and a master's degree in statistics. So I am a big fan of the stuff you do
Thank you.
every single day. I started my career with IBM writing code. I'm old enough to remember the dot-com era and this little project called Y2K. So that was what I initially worked on. And it was such an interesting moment in time because of the dot-com era, which has a lot of parallels to what we're going through today with the AI era. You saw businesses being transformed. And one of those businesses that was being transformed as a result of technology was trading, right? And the way exchanges operated. That led me to find myself with an opportunity after receiving a master's degree in statistics at a company called London Financial Futures Exchange. It was an exchange that had just been disrupted.
I see.
They were a floor-based exchange that lost one of their benchmark contracts due to the fact that they weren't quick enough to adapt to technology and technological innovation. So they did what any organization would do, and they looked for people who had the skill set, specifically programmers, who could also speak to clients about how to code to the exchange's matching engine. So that was a little bit risky. I was going from, IBM to a company that no one actually had heard of in the US, and a company that was going through its own evolution, forced evolution, because it had just been disrupted.
Doubly uncertain in that sense.
Absolutely, and it had just been disrupted, but that was obviously the greatest decision I made because that got me into the exchange industry. I was in that job for a period of time. I wound up becoming CEO of a futures exchange, started up a clearing organization in partnership with DTC, had the opportunity to start up and run our fixed income and data services business, and then about 5 years ago was offered an enormous opportunity and one I take with great pride, which is running the New York Stock Exchange.
That's fantastic. I mean, one just quick follow-up on that is that, you mentioned your education being in statistics and then before that in computer science. But a lot of the things that have made you super successful involve you. It seems like you've learned a lot of other things because there wasn't a class presumably on clearing and
no.
all the, yes. So, there is now, but I suppose maybe just say a couple of things about how you kind of decided, okay, I need to acquire a whole variety of other skills.
Yeah. So if you're in the right organization, a lot of the opportunities find you in a way to acquire additional knowledge. Be it if you're in a right organization, that organization is influencing change, it is disrupting, it is trying different things, and I can't think of a time more relevant than now where all organizations are doing that. Different subject matters are coming to your desk just as part of your daily work. So it's not as though someone said on the clearing side, oh, go take a course in clearing. It was more on-the-job training of understanding the derivatives markets, and one of the key portions of the derivatives markets, not just trade execution and pre-trade transparency, it's guaranteeing of settlement. So just being intellectually curious, it led me to acquire that knowledge on the clearing side of the business. Similarly with AI, I mean, it's something that we're all using every single day, either in our personal lives or in our professional lives increasing. So just being able to use the tools on the job, for lack of a better description, is how you wind up acquiring some of the best knowledge.
Yeah, and I think that's a great point that you make, including the first one that you made about the role of the organization in setting itself up to, reward curiosity.
Yeah.
So I think that's in some sense going to be make or break in a time of change, it sounds like. Okay, so pivoting to technology and market structure evolution, which is kind of what we've been talking about, if you, as the president of a very critical part of our financial infrastructure, one of the things that we hear about is tokenization.
Mm-hmm.
We hear about, trading in a 24/7 environment, and then we also hear about algorithmic trading, and these are all things that are happening. And so, for you looking ahead, what do you think is worth our attention or the attention of this group in the next several years or beyond?
So the way I think about all of the trends now is they're a continuation of the trends that led me to the exchange industry in the first place, and that's the adaptation of technology to democratize financial markets. Now, at the New York Stock Exchange just down the road, we're 234 years old. Technology wasn't a thing 234 years ago, and there were a bunch of people that stood around in trading pits and yelled at each other all day, every day. Now, the markets have become increasingly more transparent throughout those 234 years with technology. And the advent of electronic trading in particular, I like to say, is the great democratizer of all, because everyone, when interacting with an exchange's matching engine, has the same access, fair access. And no one's voice is treated any differently. Now, that evolution since I joined the exchange industry has had multiple lenses as well. Algorithmic trading being one, which is just a much more rapid integration of buys and sells and risk management tools. But when you think about 24/7 trading, 23/5 trading, whatever the time frame is, as well as tokenization, to me, it's just a continuation of that democratization of access to markets and transparent access to markets and making markets more efficient. When you make markets more efficient, a couple of things happen. Number one, there's a lot more transparency, but you're also freeing up capital for a variety of other mechanisms.
And so, okay, that's a very interesting theme that you emphasized. From your perspective as the leader, is a core principle sounds like one could imagine these innovations that we've been talking about in the unmanaged outcome advantaging some people and not advantaging others. And so it sounds like this is a deliberate kind of principle to say these technologies shall in the end serve the purpose of evening the playing field.
But I think it's really important how the technologies are applied, and that's where I think the regulatory frameworks and the role of the SROs and the roles of exchanges who have been battle tested are critically important. It's a theme that we like to call responsible innovation, because what we don't want is for shadow markets to develop. Shadow markets that are not part of the regulatory framework, one that has withstood wars, pandemics, financial crises, you name it, and has been refined because of those lessons learned for 234 years plus. Those are the types of markets that if you're applying the good technology to, you're applying the newer technology to, that's where the real innovation should come.
And so in this world where there is this, that as you just pointed out, the need for kind of some standard setting more broadly and oversight perhaps, that's, from your perspective, is that something that is on a good track going forward in terms of how you think we're positioned to absorb the technologies that are coming?
Yeah, I think the existing regulatory framework actually has withstood a variety of shocks, and the most technologically advanced companies, such as ourselves, are looking at how to apply technology. I mean, we filed for a tokenized platform earlier this year. We led the charge on expanding market hours to 23/5, which goes live in the traditional infrastructure in December of this year. And on that one, in particular, it comes back to what I said earlier about the regulated frameworks. The reason we moved forward with 23/5 is not because we really like staying up 23 hours a day. It is because we saw an issue and people got hurt. And that issue was when the Nikkei dropped a few Augusts ago. If you remember, it was like August 5th, 2024. There were a variety of less regulated platforms, unregulated platforms, where people were transacting on overnight because the exchanges were not open. Those trades got invalidated and those platforms did not reopen for 3 days. So people were on risk or off risk and they weren't quite sure where they stood. We felt a responsibility, quite frankly, to say, okay, we can do this. We can extend our trading hours in partnership with the clearinghouse to allow for this access in a regulated framework where you're guaranteeing the buyer and the seller both receive the transaction in their account.
That's great. And I think just on the theme of infrastructure and kind of setting yourself up for trading, from your vantage across the various sectors, equity, fixed income, data services, again, any thoughts on big opportunities that you see, and of course, big challenges that you see for infrastructure, in the coming years?
Yeah, I mean, big opportunities in terms of the role that data is going to play in an increasingly electronic world, an increasingly automated world. I mean, the greatest piece of IP that a company has is its data, when you think about it. And when we think about it from the data perspective, we think about the protection of that data to make sure that we understand how it's being used and that we understand how our outputs are being constructed to ensure that it's the gold standard that it has been for many years. The things that we're continuing to look at, though, is just the throughput.
Okay.
In an increasingly automated world, the amount of capacity you need to have in your system to deal with the increased amount of throughput on the inbound side and react to it on the outbound side means you need to have cutting-edge technology in place at all time with plenty of headroom in the most secure fashion possible. I mean, it's one of the reasons why we've always been focused on our own data centers. We've purpose-built our own dedicated data centers, and we don't run our matching engines in the cloud, so to speak, because we want to ensure that from an end-to-end perspective, we can guarantee performance both on the input side and on the output side.
Okay, and that's a very interesting observation. I mean, and just maybe on the theme of data, like I work at the Fed, so it takes a lot to impress me if a number is
You spend
big.
a lot of time with data.
But I mean, last year, April, you hit a record of processing more than 1 trillion messages in a single day. That sounds big, so the question is, are the things that you pointed out right now central? You talked about headroom, and volume, and so how do you think about organizations that need to manage data that has these kinds of features in a market?
Yeah, the fun thing is you can plan to a point for a 1.2 trillion incoming order message day, but when volatility hits the market, you really can't plan for it. Our approach has always been to have a flexible architecture, which allows us to seamlessly load balance when we have those peak days, such that there's always capacity available on demand, so to speak, when you have those bursts of volatility like we had last April in the market.
I see. Yeah, no, just listening to you made me think about physical metaphors like electricity utilities that also have to manage peak load. And just out of sheer curiosity, in managing those kinds of peak loads, are the levers purely technological, or are there incentives that you can put into place that you think about where you don't want a huge amount of crowding on a given day?
Yeah, I mean, it's actually an interesting point because especially with this continued evolution of automation that AI is promising to bring to to markets. There is, one school of thought that you don't want to just let the machines that are interacting with your matching engine run amok. Typically, what we do when we see an increased load from any one particular market participant, we'll call them.
I see.
We never shut people off,
Right.
so to speak.
I see.
But we will call them, and a lot of times you're doing that customer a favor
Yeah.
because if they're generating a variety of excess messages, they generally have a flaw in their code.
Interesting. I see.
So there's some refinement that they would need to do. So 9 times out of 10, maybe 9.5 times out of 10, they're like, oh, thank you, I didn't realize I was doing that.
Okay, that's a very interesting role that you play in market hygiene
Yeah.
in some larger
Yeah.
sense. Okay, fascinating. You mentioned in passing just now AI, and I think maybe that's on everybody's mind more or less all the time. Maybe just a few thoughts on the way that you're using AI, and of course, any thoughts that you have on really cutting edge AI that is out there that Glasswing, for instance, has been in the news for.
Yep. So we're using AI in a couple of different areas. We've been using AI actually to help us with our regulatory function for probably 7 or 8 years now. And different forms of AI, right? I mean, there's LLMs plus, and then there's, more generative AI.
7 years sounds like very early.
It was very early. It was more automation around a big data set.
Got it.
For lack of a better description.
Super cool.
So how do you apply the benefits of automation that AI brings against a big data set, especially parsing through a data set? In particular, it's quite good at looking at patterns within the data. And particularly spotting things like potential nefarious behavior. So it helps our reg team do that type of hygiene, which has been really helpful for us because of the more than 1 trillion messages we get. It's a human can't parse through that. So we're able to do the reg function in a much more efficient fashion with the same number of people. So we are enabling the humans to just be more efficient at their jobs. We're also using AI now as a code companion, companion with our technology staff.
So just to make sure everybody's on the same page, when you say code companion, what are the things that you want us to be thinking about?
It is really good at looking at systems with significant amounts of technical debt.
I see.
So I'm old enough to know how to program Pascal. I learned Pascal. There's not a lot of people that are my vintage any longer. Oh, there's one in the audience. That's good. I struck a chord. But if you think about COBOL, you think about Fortran, you think about some of these older systems, AI is quite good at helping someone who understands Java, even C, even some of the more modern languages, and how to do that work on that bridge.
I see.
So that's been quite helpful.
Oh, it's really a lot of economics is written in Fortran.
There you go.
Actually, I think now it's Python, but yes.
Now,
but
exactly,
it's
the Fortran to Python conversion, it's actually quite good at that. You mentioned Glasswing. We were just included in Project Glasswing, and we were quite proud of that because from our perspective, an initiative like that is a great proactive initiative to when you think about one of the potential downsides of AI, which is increased amount of risk and cyber risk. Something like a Project Glasswing allows us to get the early releases of Mythos and other models to spot vulnerabilities before they are available on the common market.
Excellent. We're close to our time today, so I'm going to actually pick one question out of a couple that I had listed. And I think you've talked a little bit, you started by talking about your own journey in terms of skill acquisition. How do you approach, I think, talent strategy in this kind of environment where technical skills are important, but market expertise, like you embody that transformation in your own career, but how do you get it to happen at scale in your organization? And what does for you, what does the workforce of the future look like in financial markets? Your thoughts there would be welcome.
So on the latter, the workforce of the future are going to have humans.
Okay.
So, like, there are going to be people who are going to be doing stuff. We're going to be interacting with machines. I mean, you look at every great revolution, from the invention of the light bulb. I mean, there used to be guys driving around in horse and buggies around here lighting gas lamps.
Right.
When the light bulb came, that evolved into a different job. Jobs are just going to change as a result of AI, but there are still going to be humans doing work. They're going to be very technologically versant, conversant, able to interact with technology just as part of their life. And I see that with my own kids, the way they interact with technology. It's just second nature to them versus some of us who are still, trying to spend some time learning some of the newer technologies. We at NYSC and at ICE like to give people exposure to different businesses. We're a very flat organization, which has its definite benefits in that the younger generations are able to, or the newer people in the organization, the more junior people in the organization are able to approach anyone from the CEO on down, and they will get a response from any of the business lines. So we tend to employ intellectually curious people.
Excellent. Well, I think that brings us to the end of our time, and I've really valued being able to speak with you, and I hope...
Thank you.
Yes, thanks very much, Lynn. Yeah.
Thanks for having me.
Hello, everyone. Thank you for waiting while we did our quick scene change here. And thank you for Lynn and Kartik for that very insightful discussion. So we now welcome economist Michael Lee, moderating the panel on the rise of prediction markets, a new financial market layer. Thank you.
Well, great pleasure being here. I'm Michael Lee. I'm a financial economist. A lot of my work thinks about financial architecture and how we think about information, the plumbing, and the institutional framework for us to actually have efficient markets. So it's a really big pleasure because experts and academics have long touted the value of having prediction markets to create a marketplace where we forecast the future. And up until very recently, that was more of an aspirational goal. In the last couple of years, we've seen something else where real money is now expressing views on real world outcomes, and where we can now dynamically observe prices on how the market perceives the likelihood of a variety of different events that go beyond the traditional forecasting events. And so it's really isn't a better time than now to have a serious discussion on what the potential for prediction markets are as a new financial layer. Also take a clear look at where we are right now, and then chart out the path through which we can actually allow this potential to be realized so that the financial system can actually aggregate and pull together this new financial layer. So I'm really happy to have an excellent set of panelists today who have joined us in order to discuss this from a variety of different vantage points. I'd like to maybe go down the row, and if each of you can take a moment to tell us who you are and maybe like a short description on how your work touches prediction markets.
Okay, thank you, Michael. So I'm Itai Goldstein. I'm a finance professor at the Wharton School of the University of Pennsylvania, now also the chair of the finance department and director of Wharton Initiative on Financial Policy and Regulation. One of my main topics of research over the years has been information in financial markets, and Michael took a course where I spent quite a lot of time on that. So trying to understand how markets aggregate information and what are the real effects of this information. And I'm going to go into more details later.
Hi everyone, my name's Nicole. I work at Kalshi. It is the world's largest prediction market. It is a CFTC regulated derivatives exchange, so that is the connection to the prediction markets panel here. I wear two hats at Kalshi, so I write the contracts that we self-certify with the CFTC that form the rules for the contracts and the markets that you see live on our platform. And I also lead Kalshi Research, which is our academic and institutional research arm.
Hi, and my name's Brad Peterson, and I run global technology for NASDAQ. I've done that for 13 years. But Michael and I thought probably I'm going to draw upon my experiences. I was at Schwab during the original online trading, and there's a lot of similarities to the connection and the cultural experience that Kalshi is having, certainly with the World Cup and elections. And I was at Schwab twice. I then was at eBay, and I'm glad that NASDAQ didn't think about getting into eBay, because they probably could have been eBay, and eBay wouldn't have existed. But there's even more similarities to, it was a meme. The Nemo fish were bought on eBay, in the movie. And there were a lot of things that eBay could have become. And so we're going to maybe talk about the future and what are some of the things to anticipate on how the leadership choices at Kalshi and the other prediction market companies are going to need to be prepared for unforeseen events, because they're so popular and so mainstream. And I guess the last thing I'll say is I really think that I've always been intrigued by the wisdom of crowds, and we know polls are usually unfulfilling when we find out what they were predicting. So I think this is really an exciting technology to improve, and also I think on the risk side. So it's quite amazing what's going on, in addition to the World Cup excitement you guys are locked in with.
Hi everyone, I'm Asaf Meir, the co-founder and CEO of Solid Slabs. I also think I'm the most academically inferior person on this panel, so I'm humbled to be here. I'm a practitioner. We work in the trenches to make sure that anyone who is trading on any trading platform, as well as frontier markets like prediction markets, is safe and sound. So that's what we're doing. We're going to double click into our work into that space.
Fantastic. And before we move on, also, I just have to mention your socks are incredible. So if you haven't seen them yet, take a good look. Okay. Well, we have to really start by thinking about a huge component to prediction markets. Earlier I mentioned, really it would be a dream to have a system where we can forecast the future, not just for financial assets, but for a variety of different outcomes. And so I think it's useful then to maybe have a framework to think about how informations are more generally related and integrated into financial markets. Itai, you didn't mention it in your introduction, but you've spent decades thinking about the potential for information in financial markets and its broader implications for the real economy as we think about it, separating financial markets from actual real-world decision makers, including policymakers and firms taking actions on investments and different types of strategic choices. Can you maybe tell us a bit more on the kind of the foundation for how information is directly related to one of the important roles that financial markets play? And tell us more about this idea of real effects.
Sure, I'm very happy to do that. So I don't know about decades. I guess 2 decades. Yes, I've been working on this and thinking about it. When I got into finance academia, one of the main things I was fascinated by is the price system, the financial market price system. In finance, we spend a lot of time thinking about market prices. But to me, they were interesting in the sense that they were aggregating information about the underlying fundamentals. And the power of markets, I think, is very strong because you have people coming from all different corners of the world and the economy. They have opinions, they have sources of information, they have the best incentive in mind to trade on this information. And at the end of the day, the outcome of all this trading shows up in the price. So you look at the price, you get a sense of what people think about the underlying fundamentals. Now, if you take it a step further, and this is where I did a lot of my research, then you would expect that people who sit in the real side of the economy will take advantage of this information. So let's say that I am a CEO of a firm and I just announced an acquisition. And now the announcement goes out and the market doesn't like it. So I'm basically getting a very strong negative vote from the market on what I'm intending to do. What will I do? Well, some of us will say, you know, I know better than anyone else, so I'm just going to go ahead. But not everyone is so confident, and people sometimes revise their expectations. And when they see that the vote from the market is very negative, they will cancel the acquisition. An acquisition is just one example, but you can think about many other examples where managers are going to put something out there, announce some step that they're going to take, and then they get the reaction from the market and they can choose whether to go ahead or not. So I've done some empirical work testing these ideas, and indeed, against, I think, what many people would expect, we did find that there is quite a significant real effect of financial markets. So there are all sorts of empirical strategies to tease that out, but you can basically see across different settings, different methodologies, that when prices change, real decisions tend to follow. And here I'm just talking about managers, but it doesn't have to be just managers. It can also be regulators. It can also be creditors. It can be employees, customers. There are many decision makers out there who can update based on market prices. And it doesn't mean that they don't have information themselves. It just means that the market can provide some angle on the situation that they did not have access to. And that's where the power of the market is coming from. Now, there are also complications that come along with that. And we explored them in our research as well. So one complication is, the market has both information and noise. So if you have people out there in the real side of the economy learning from the market because they are trying to extract the information, naturally they will also sometimes end up following noise. Now, you might think about that and say, well, that's a very bad thing, so we shouldn't have any learning from the market going on. And I would say no. Overall, the effect of the market is positive, but the positive does come with some negative. And we did show how noise in financial markets can also propagate and have some implications on the real economy. Other complications that come with that is that it's not always easy to tell exactly what the price is telling you, right? Let me give you an example. Again, going back to the acquisition that I just mentioned. So suppose that you announce an acquisition and the price doesn't move. Now, you might say, well, the market is indifferent and I think it's good, so I should go ahead. But maybe the price didn't move because the market already anticipated that the acquisition will be canceled, and as a result, there is no movement in price. So you're looking there at the price, and it's a little hard to tell what exactly is going on, right? We see it also with political statements sometimes that a politician would go out and say something, market thinks it's bad, but the market doesn't move because there is an expectation that this is going to be eventually canceled, okay? And I think this is where prediction markets come in, and this is what I want to highlight at the end of this opening remark, that I think prediction markets can help us get another layer of information that is not necessarily available in financial markets because they focus on a particular question. So, if the market tells you something about the fundamentals of the firm, and prediction markets can tell us something about whether an underlying event is expected to take place or not, you combine these sources of information and you get something more powerful. So this is why I think prediction markets are quite promising, and now we are doing some ongoing research to try to understand a little better what are the spillovers from information in prediction markets to mainstream financial markets, and maybe eventually also to the real economy.
That's fantastic. And I think that echoes perhaps why academics thinking about how information is aggregated are so attracted to this idea of having prediction markets, where you can more precisely signal the market view on the likelihoods of different events, separate from more aggregated reflections that are typically shown in financial prices. Actually, I think that's a great segue, Nicole. We had conversations before this panel, and one of the lines that I think really stuck with me is that you said, as a matter of fact, well, most people come to Kalshi and never place a trade. And I think that this is something that kind of reflects this idea of kind of the informational value. Can you elaborate on this? Maybe tell us more about event contracts and how it changes the calculus for how information can be useful to a much broader set of participants.
Yeah, absolutely. I think the big thing to note is that prediction markets aren't just useful for the people that go and trade on those prediction markets, but the incentives that drive the price discovery on those prediction markets lead to such high degrees of calibration and accuracy that the information itself in the price is valuable to the participants on the other side. And the way that I might speak about something like that is we think about how valuable the information coming from prediction markets is through a concept known as calibration, right? And the idea here is like, okay, if our markets are pricing something at 60%, right, 60 cents, does it actually happen 60% of the time? Or does it happen 100% of the time? Or does it happen 0% of the time? And the reason that calibration of the model is important is because if you have a prediction market that is giving you a 60-cent price, but actually the event happens 100% of the time, it is a bit of a noisy signal. And so we've done work internally at Kalshi Research to go back through all of our markets and look at what that calibration looks like. You can imagine that there's a 45-degree line that you could draw, and I won't draw it because I don't have a pen, but you can imagine my arm is this 45-degree line, right? Maybe it's facing the wrong way for you. We are very, very close to this 45-degree line. The way that we quantify the error or the margin of error from that 45-degree line is known as the Breyer or the Breer score. An excellent forecasting model, so one that meteorologists would use, one that would lead the world in forecasting ability, would have a score of about 0.1. We're hitting scores of 0.03, right? 0.04 at a week out from the release, for example, of economic information, right? 0.08 3 months out from an election actually happening. And so what you're beginning to learn is we're constructing the world's best forecasting model with prices that have value to the participants that are going to be consuming them, right? And you can imagine that those participants are ordinary people that are making decisions. So you can imagine that, you're a small business owner in New York and it's projected to snow a lot this coming weekend. And so your foot traffic is going to massively suffer. Or maybe you might want to close because you don't expect customers to be coming in. Or maybe you want to hedge that out in some other way, right? Maybe you're a financial institution and you want to know what the likelihood of the election of a certain candidate is. Or you might want to do an event study on the information to see what moved the market. It's not just necessarily the price at any given point in time that is valuable, but it's the trajectory of that price over time that is also valuable. And so you can think about, we did this study, we looked at Mamdani's rise to power. This was the second research study that we put out. And we basically said, let's track it and let's do an event study on the things that move the market the most. And what you can find is that prediction markets serve as a credibility layer on an otherwise very noisy political landscape and a very noisy news-driven landscape that gives you a wide variety of answers to a singular question. And what prediction markets do, and what they have a unique ability and incentive to do, is cut through that noise to give you some accurate pricing. And so you can see what kinds of outlets are people listening to? What kinds of information tends to move the market? Does it matter the first time that Trump talks about tariffs, or does it matter that he's mentioned it 12 times this week, right? What is actually driving policy? Understanding that positioning and the way that market pricing changes is hugely informationally valuable to the participants that sit on the other end, and it never requires them to place a trade. So outside of the studies that we've done, that the Fed Board of Governors has done, research is there to show that our markets outperform consensus estimates on traditional macroeconomic indicators. Across all of our markets, the information value is significant to participants. We see many people use the price as the ultimate product that Kalshi is offering, as opposed to the trading that we also offer, of course, as an exchange.
Let me kind of double click on that. So you've offered some examples where your studies show that there's more better forecasting power, and I think that's really showing us a glimpse of how it could be used. You have a unique view because you examined it across all these categories, and some of them overlap with existing categories, some of them don't. Where do you see the most maturity today in terms of the informational value being projected in your categories?
Well, I would actually say it's pretty mature across all of our categories, right? So macro financial markets are a really good example, but I would say that, Kalshi markets are calibrated by the incentives of participants who are in those markets, right? And that isn't necessarily linked to having millions of dollars on a market, right? We're finding actually that the value that you get from a market is highest when you have a few tens of thousands of dollars on that market, not millions. And the reason for that is because when you participate on a prediction market, you make money when you're correct, and you don't if you're not. And it's a binary payoff and a binary option structure, which incentivizes people to be right, which is not the same incentive that exists in other ways of sourcing information. So for example, polling that reflects what people say that they're going to do, as opposed to what they think that the outcome is truly going to be. And so I think that across all of our markets, we see that level of maturity. But of course, if you're talking about, where do we see the most attention paid to our markets in the way that the market might be expecting or watching, macro, financial, and political markets tend to stand out. Because unlike other market signals, it's a continuously updating, but also distributionally rich signal. And that distributional richness is important because if you're doing something like projecting inflation, like I, for example, used to be a short rate trader. And so I would think a lot about what inflation would be in countries around the world, in developed countries and in emerging markets. And it didn't just matter what interest rates were going to be set at, it also mattered what the cone of uncertainty around those interest rates were going to look like. And that distributional forecast is available through our markets because they're directional, right, for many of those indicators. And they're also offered in mutually exclusive form if you want to take a more direct position. And that distributional information is also very important and otherwise, generally speaking, unavailable in parallel financial markets where they do exist. And in for some macroeconomic indicators like unemployment or GDP that aren't traded, are the only source of the information that is going to be continuously updating in that way.
Great. Actually, Jason, I'm happy that you could join us. We've already done introductions. Can you give us a quick 30 seconds on who you are and how prediction markets overlap with your interests and work?
Absolutely. Sorry for being late. There was a little snafu on scheduling on my end. But better late than never. Jason Urban, I co-run the digital assets business at Galaxy Digital. We are active in, I would say, while we were primarily, when we started, a digital assets business, we've kind of pivoted into AI data centers. We Forrest Gumped our way into that, which was very fortunate. And we try to do the innovative things that we're seeing inside of the financial ecosystem. And so prediction markets are a very important part of that because there is this intersection a little bit with blockchain and prediction markets, and we do have a number of clients who are very focused on those specific events that affect ways that they express their views in the market broadly. So,
actually, so we were just discussing the kind of potential for the informational value that prediction markets bring to the table. From your standpoint, because you have clients who are looking to use these as a tool, where do you see the prediction markets as a source of information through their prices and through the information that they aggregate actually become actionable?
So I mean, one of the things that we did that was kind of public and that was out there and caught a lot of attention, we had a client who was very focused on the Clarity Act and the impact that that would have on their business. And they approached us and said, we can buy a bunch of puts in Bitcoin and ETH and other things, but that isn't really the view that's one way to express the view that could be very expensive, right? The carry on that through the end of the year on a 40, 50 vol asset is exceeding.
or we could make a one-time targeted bet or hedge on what we think. And so they were like, if Clarity passes, it's very good for our business. If Clarity doesn't pass, it's very bad for our business. And so they were like, if we were able to hedge our portfolio with puts or hedge our portfolio with a Clarity view, that Clarity view was a more targeted and less expensive way for us to do that. And so while there's information embedded in what we're seeing in prediction markets, there's also that information could be somebody trying to hedge a broader portfolio. Now that's a digital assets focus, but if you're Cargill, if you're Cargill and you're worried about the Brazilian election and what impact that's going to have on exports, soybean exports, you can now manifest a view that way that's actually probably more capital efficient and targeted to how you're viewing your business than you would if you just went out and bought a bunch of soybean puts or bought a bunch of soybean calls. And so it is a financial tool. I know that it gets a lot of, are we going to bet on who wears the red dress at the Oscars, or, is the U.S. going to give up a goal in extra time last night, or whatever it is. But really the reality is, for the people I think in this room and where it's relevant, it's for those producers and multinational firms that have exposure to these things.
That's fantastic. And I think it kind of represents one of the core functions of financial markets, which is to not only speculate, but actually hedge future risks in a way that protects your interests and allows you to manage the broader financial risks that institutions, investors are willing to take. So we've heard a lot about the potential for information to be aggregated through these markets, allow for a more surgical, more precise way of tracking and learning about kind of different types of likelihood of events, and eventually actually even monetize on that. I think that kind of brings to the forefront the fact that at the same time, the sheer expansiveness of what can be traded also poses a lot of challenges. And there's a lot that we need to figure out in order for these markets to actually operate and provide that type of efficiency for activities that we highly value, such as hedging. So Asaf, your company has been working on providing intelligence and research across multiple platforms. Tell us more about the work that you've been doing, and in particular, what we want to understand is the potential gap that we see between the real potential that these markets have and where we are right now.
Yeah, happy to. So similarly to Galaxy, we're also born in the digital assets and crypto space. We're ultimately to solve for market abuse in the crypto space. If I have to bubble it up for like a one sentence, I would say that you have to solve for a high degree of fragmentation, where you essentially have institutional investors as well as retail investors, agents as well coming up that are trading a new net set of basically asset classes. These could be either smart contracts or today event contracts under prediction markets in a new kind of market format, whether these are liquidity pools or whether these are kind of prediction markets, in a new velocity that's 24/7. So essentially that attack surface is combinatorially expanding at the moment, and bad actors are able to take different and new ways in order to manipulate it. So when it comes to information, as Itai mentioned, that investors are making decisions on, a lot of that information could be manipulated, and there's false narratives and perception that can be created if you know how to go about that and manipulating the market. We've done a lot of research on that. We've, for example, we've monitored about 27 days prior to the 2024 US elections. We monitored about, I think it was about 8 million executions, which mounted to about 1.87 or almost 2 billion in notional traded. And what we found out that about 250 million worth of volumes were washed. That's about 15% of all participants on Polymarket. And by the way, it's important to put an asterisk here. I'm saying a negative, but it's out of a positive because it is a decentralized open source venue where you can actually look and see what's working, what's not working. And so we kind of monitored that and saw that there were also new ways to wash, trade, and manipulate that they don't really exist in the traditional space. So generally speaking, if you want to wash trade, kind of wash trade for dummies, you basically, buy A, B, A, basically buy or sell the same asset. And what we've seen in the prediction markets, there's new ways to go about that very hard to detect unless you're mechanically kind of aligned towards that. And so the way you basically wash trade in a new, sophisticated, nuanced way in the prediction markets is by basically buying yes Trump and yes Harris. So it's the same side, different outcomes. Generally speaking, you wouldn't really detect that in a normal wash trade in the kind of traditional, I would say, derivatives or equity space. There's different reasons why that might happen, by the way. We kind of always entertain reasons for why anyone would try to manipulate election markets in that regard. But it's very clear, the evidence is there, we're able to see that. And then you also see a lot of evidence of insider trading across the board on multiple type of event contracts. Not just, actually when it comes to sports markets, they actually tend to be much more robust, and the trading behavior there is much more like strong. It has a very strong kind of curve. Early on, participants are basically placing bets, and you're expecting to see a pretty healthy market. When it comes to mention markets, whether or not someone's going to wear a red dress in the Oscars, you're actually seeing a much more kind of J-shaped trading, where towards the end there's some information asymmetry and potential some leakage that can indicate something for someone to trade, and then you start seeing everyone trading on that. And so also when we're talking about prediction markets, I think it's very important to differentiate within prediction markets. You have kind of sports, contracts, you have mention markets. Both of them, generally speaking, operate very differently, and the type of manipulation you can see in both is very different. I would say that's really, a lot of the discussions we have today with public sector regulators and enforcement agencies that we work with have to do with that. Essentially, who might have traded ahead of time on possibly sometimes national security matters. And then in terms of markets, ultimately, if you want to, usher in institutional adoption, institutions have to know that the market they're seeing is essentially has a level playing field, and that there's good price discovery and no information leakage. And I think that's really what we're trying to inject into the markets, a good portion of market integrity.
I think, just from the description you've provided, we're already seeing that a variety of different traditional market manipulation and market regulations are being broken here, thinking about the way in which we trade, which is through wash trading to manipulate the public perception of particular types of markets, going all the way into ways in which investors can actually monetize on their private information in ways that are legal. Having done research on this, we know that there is, when there is a path and there is a will, yes, they find their way into markets.
I would also say two more things. What we're seeing also on-chain, at least, in kind of the world of decentralized kind of offshore venues, is that it's, generally speaking, somewhat sophisticated players. You have multiple kind of wallets that are working in cohesion and trying to obfuscate their path of funding or then offboarding. And I think that also that relates to the CFTC recent, so about a month ago they had an advisory letter, and just recently they had a new rule, proposed rule, essentially recognizing the fact that prediction markets have a level of sophistication around one individual or a group of individuals to affect an outcome of any singular event contract. And so they are going to essentially, when they're evaluating, by the way, that's very much in Nicole's kind of alley, when they're evaluating whether or not they have a jurisdiction to block this or other kind of contract, they're going to, one of the gating kind of reasons they might block it is whether or not indeed one individual has oversized way to influence an outcome of a contract. And it's something we're seeing time and again.
So I'm going to put a pin on that because I think that speaks to something that goes back to some of the ideas on, the double-sidedness of information, and especially when you start to have a much broader set of events. Brad, actually, one thing that you already alluded to is, beyond your current role at NASDAQ, you've actually been a part of the conversation for building marketplaces where in the advent of the internet and different types of ways to connect buyers and sellers, we had to chart through and find and navigate new rules, whether at the platform level or even at the regulatory level, for what is permissible, what is not, and how we govern them. And so can you speak a bit about your kind of experience building up platforms that connect finance, retail, and digital in order to facilitate these types of transactions, and what the natural challenges are? Because I think there's a really strong parallel, and there's an element where as people building out this space, we need to recognize what it takes to really make it a safe foundation.
Yeah, thanks. And eBay actually is a great example because it was Pierre Omidyar who founded that, and he pretty much, you would call it, he vibe coded it with Perl over Labor Day weekend in 1995. But he was an efficient market, really. He just wanted to prove a point about efficient markets, and he had a social view that people are basically good and trustworthy. And in the long run, it proved out that people are basically trustworthy. What he didn't account for, and this is what I think you were talking about, and I think what we're going to see, is just the asymmetry of if someone is not acting trustworthy and is exploiting the system, it can undermine the integrity of that market. And it doesn't take that many people, because if there's an opening, they're going through it. If there's an opening, they will exploit it over and over again, and it will be a multiplied effect on all the goodness. And so that's one of the things that happened with eBay. The second one is globalization. You get inconsistencies in the level of honesty and trustworthiness, not necessarily within their culture, but to other cultures. So someone face-to-face may be very trustworthy and honest, but if it's someone that's over the internet, if it's kind of an anonymous relationship, it degrades significantly. So we saw really inconsistent treatment. So eBay, if you remember, instituted the feedback system. So it was really great innovation where you get good feedback on, is this person reliable? Are they doing things consistently? That innovation went a long way. PayPal went a long way when we ended up buying PayPal, because PayPal did a lot of KYC. And what is different between what Kalshi's doing and what eBay did is eBay had zero friction on the onboarding. They just wanted anyone. You could be Donald Duck on there. And so what that led to is you had accounts that were manipulated. And we see this still with the AI, OpenAI having these accounts that are just scraping to distill models. So you really have to take the overhead of that onboarding friction. It goes a long way. So you guys are doing a great thing. They didn't. PayPal did. And Max Levchin, who founded Affirm, he was the great architect of security on PayPal. But eBay did not do that. So what you saw is people were manipulating the price. And we said, hey, wait a minute, that's your IP, that's your computer. Oh, you can see that? So you need to instrument it. Then it was like, well, how come all your friends seem to be on your auctions? Well, they figured out, well, I can't have it on my IP, but I'll enlist all my friends. And so they were absolutely manipulating this. And in a very thin market, which many of these things are, it doesn't take much to manipulate it. And then the final one is really professionals. And there was a term called sniping. If you're too young, you don't know it. But if you were around, they were the tools that you could never win as a human. So it became so professional that it really wasn't fair. And so all this innovation was not expected. And Pierre was very disappointed in that. But if you don't build the protections, if you don't build the systems, if you don't close the gaps, they will be manipulated over and over again and exploited, and it will potentially undermine the integrity of that market. So I think this the beauty of what eBay became is very much what is similar to what prediction markets are. They have a promise. eBay became a global, garage sale, bazaar, swap meet, collectibles, consignment. And we didn't even talk about all the great, it wasn't going in a dump, right? Something had value and it got resold and reused. But all that goodness far outweighed, and I think you said the goodness was it's only a small percentage that's getting manipulated. So all the goodness is much better, is greater than the bad stuff. But if you don't really invest in rooting out the bad stuff, and it's going to be all brand new stuff too, because every market you would be amazed at the innovation of the bad side, even though they're small.
That's fascinating. One thing that I want to kind of build into this is, as a platform, you had to make choices in terms of how to facilitate different types of categories, not so unlike how a lot of these prediction markets and other platforms are making these choices. Can you speak a little bit on the choices that were being made, and moreover, as a steward of kind of building out these marketplaces, what it takes to try to instill more confidence and integrity into these markets?
Yeah, and this really was coming from the leader. Meg Whitman made an early call. You could make a lot of money. Collectibles is a legitimate thing. It was one of the most popular categories, and we had categories of, like you have events. So there were a lot of Civil War guns that were traded, and she just said, we're just not having guns. And if you think about it, that would have been we could make a lot of money with guns, Civil War guns, but also real guns. And there's a big market for that, a secondary market for it. And she just said, we're just not having guns. And thank goodness, because we probably would have been the place that the Columbine high school student would have bought their guns. And can you imagine if that had happened? So we were lucky. We had closed that down. And we also said, and we were in Germany, we bought the German, so everyone had an eBay knockoff. We ended up buying them all. And so, of course, what were they selling? Nazi. And we said, we're just not selling Nazi collectibles. We're not selling guns. And she also added in, we're not doing porn. And Craigslist at the time those were, hookup. Craigslist was a hookup site, really, in San Francisco, and it did furniture if you had a new apartment, and eventually jobs. But we just didn't do that, and it was really important. Those were the best decisions, and we had to, you wouldn't believe the challenges we got. So we had great lawyers going after, well, how can you make that determination? They're splitting hairs on it. But some of these early decisions are just, then you have analogous ones on events that you're just drawing a line, and it's going to serve you well if you draw that line well.
I think what resonates there is kind of a human element to how we're building out this, and separate from the legalities and regulation, there are some key decisions that various different stewards of these platforms and other types of market participants need to make in order to see the broader picture of what it could be. Separate from kind of the financial opportunities that exists in the immediate future.
And those are usually the hard decisions, because those
hard.
are oftentimes the most lucrative early markets.
I think so.
Just one point, by the way, to kind of piggyback from what you said earlier, where something we start seeing, which is quite interesting. You mentioned if there's an opening to manipulate, it will likely happen. Something interesting is where we're starting to see more and more agentic trading being introduced, different platforms. And then there's an interesting question here, and I'm but a humble engineer, not a legal expert, but let's say you've tasked an agent to just create good P&L for you. And the agent determined that in order to do that, you should pump a certain event contract to then have good exit liquidity. The intent of the person versus the execution of the agent is also becoming kind of quite blurry. The human never intended to kind of manipulate the market, but the agents are, and what if it's agent versus agent? So we're starting to see pretty frontier use cases with some of our kind of client base asking us about how do we even monitor these agents? They're going to find the opening, forget about even humans. And so I think there's an interesting evolutionary step here worth recognizing.
Well, I think that's maybe like a point where, Nicole, I know that you just mentioned that you also are part of the team that is building out and designing these contracts. Can you shed some light on what goes through that process and how you guys, like, what is the criteria and the factors that determine, whether you want to entertain creating a category event, and then how you actually implement this?
Yeah, absolutely. So let me take you through the journey of how we think about contracts. So for context, Kalshi has a lot of contracts. We have certified, I think now over 2,600 with the CFTC. So if you were to read one a day, you'd be reading for 7 years. Maybe today is a good day to start if you wanted to do that. But even with so many contracts, there are certain things that we don't list. So when we get recommendations or ideas for contracts, we think about a few things, right? We source those recommendations internally, externally. Our team, for better or worse, is, I would say, chronically online. So they always know what's happening in the world, and they're always communicating that in terms of what's relevant to list. In terms of what we choose to list, so there's the regulatory aspect, right, which is the CFTC lays out under the Commodities Exchange Act, Section 4011, what is and is not restricted from listing, right? So this is a big point of difference between an onshore regulated US exchange and an offshore unregulated exchange. We don't list contracts on things like assassination, terrorism, war, anything contrary to the public interest, and then of course gaming, right? So we have bright lines on things that we will not list on our platform. They're subject to additional restriction. They're not strictly banned, but we don't list them and we don't pursue them. In addition, we have our own moral guidelines that come above and beyond that, right? So for instance, we have markets on hurricanes, right? On where they will make landfall, what category they will hit, because these are relevant questions, right? Like, people suffer substantial property damage as a result of hurricanes. Insurance can be very expensive. Prediction markets can be a good way for that parametric insurance to manifest for an individual person or for a corporation. There are also other weather events that we don't list. So for example, wildfires destroyed a lot of California recently, but we didn't have any markets on those wildfires. Because on our end, we think a lot about incentive construction. So underlying every market that we have, we think, will this incentivize someone to take an action that we would think is morally reprehensible or bad, right? We would not want to encourage someone to do arson, to go and start a fire and take a position out, right, on a contract that we had, right? That would be a really, really big problem for us. That actually isn't something that is at all explicitly prohibited by regulation. We could list markets on that. That's a choice that we make for markets that we don't want to list on our platform, right? And that's just one example at the grandest scale of weather, right? But of course, like, there are many other examples that we make much more granularly on the individual level. And when you're dealing with any of our contracts, we have provisions in our exchange rulebook also which have to do with the death of an individual, right? Or the disruption of an event due to violence. We would never want, for example, for an election market or for any other market that we have, to incentivize someone to go and commit violence against an individual to make economic profit. I think that's morally reprehensible as a thing to do, and the platform, of course, agrees. And so, in those cases, we resolve to a last traded price from before anything even remotely started to happen. So a good example of that is, in Iran, with the action that happened against Khomeini, it was always in our contract that we certified with the CFTC that we would resolve that contract to last fair price. We ended up resolving it back, rolling that contract timing back to before the first airstrike came from the US, right? So before there was even any rumor of violence happening in Iran, and hours before Khomeini was dead, right? And so I think that putting in those guidelines as a platform that go over and above what is required from us from a regulatory perspective is really important, because we take that incentive construction very seriously. And I think, at the end of the day, to some extent, and I hope that this applies to finance more broadly, I like to come to work every day and think, am I doing a good thing for the world? Or am I doing something that is actively really, really bad? And if the answer is I'm doing something that's actively really bad, maybe I wouldn't be so keen to come to work every day. But I don't feel that way. And so I'm very excited to come to work every day. And I think part of that is we spend a lot of time thinking about all the different ways that our contracts could cause people to act in certain ways, right? Even for our sports contracts, we don't list contracts on player injuries, for instance, because we wouldn't want to incentivize someone to go and injure a player. And this is a multi-billion-dollar industry where there are many other incentives that exist for competitive success. And so what I'm trying to say here is there are many discussions that happen before we list anything with the CFTC. So even though we have lots of contracts listed and they're robustly listed, we think a lot about what we do and do not choose to have on our platform, and have an economic justification, of course, for everything that we have live up there.
I think in some ways your answer also shows how nuanced some of this can be. In terms of the nature of the events, we don't oftentimes have conversations that involve outcomes being determined by airstrikes and assassinations. And I think that shows, going back to the question of where does the value lie when you want to hedge positions, and versus kind of regulating this and managing this in a way that avoids the situations where you have these negative spillovers and actual real actors trying to manipulate the outcomes as well. I think that also speaks to, maybe the potential challenges as we look forward for broader institutional adoption. And Jason, you kind of alluded to a recent contract that got a lot of attention with Arca which is a firm that is long crypto and wanted to hedge their position by using the Clarity Act. One thing that I find super interesting is the way in which you executed, which also maybe shows the current limitations of actually executing this on a platform and why they're seeking these alternative arrangements in OTC. Can you tell us about why or why not it's necessarily compatible and how you structured it and what informs that, and perhaps maybe that is also a useful way for us to understand what is lacking for us to get to that point where we can have deeper markets and deeper price discovery.
Yeah, I think that one of the things is the depth of market, right? I think that professionals who are large financial institutions or people that are well versed in these things are going to be thoughtful, and there are ways to express views that don't necessarily, we won't do sports, we won't do assassinations, we won't do things like we're truly just financial outcomes. But there are ways to express that. You can say regime change. There are things that you can do that don't have to have the pejorative attached to it that still accomplish the same thing. In regards to the liquidity issues, that is a big concern. If you look at the Clarity hedge that we did, or that the client did, the life of the contract to that point had traded $2 million total notional both ways. The client wanted to do, 10 or more $1 million. And so because we're a swap dealer, because we deal with, we trade under ISDA for most everything that we do, we are a publicly traded company and probably, if not one of the most regulated firms in the digital asset space. So we take compliance and regulation very seriously. And so we traded that under swap. We traded it bilaterally. We were a dealer in a lot of ways that way. So one of the advantages is we can take these things down on our balance sheet. We have the capability to do that. And so we were able to trade and satisfy our client, and then on the back end, try to go find ways to hedge our exposure at that point, because we don't necessarily just want to be taking the other side of every bet that shows up in our door, whether that's crypto or TradFi or prediction markets. And so we then went and hedged away on both lit exchanges as well as with other market participants bilaterally. And so trading that under swap, there are mechanisms like we see in crypto and like we see everywhere else. There are TradFi mechanisms that satisfy both the spirit and the letter of the law, and I think that that's very important, that we all recognize that all of these things are going to happen. People will do them anywhere on the planet. We are truly in a global world these days, and so I always make the case that it's better to do this under a regulated umbrella through the rules that we have or the rules that we're going to make, because that allows for these things to happen at least out in the open and not in some, dark corner of, some place where you're like, well, they're going to trade it. I'd rather them trade it here in front of us. And so we used existing rails and existing tools at our disposal.
Yeah, and if I can just expand on that from the institutional side, I think that that's something we've thought a lot about, right? Because this liquidity question is really important, and to some extent, liquidity begets liquidity as institutional players continue to onboard onto platforms like Kalshi. So, as an institution on Kalshi, you can now trade, of course, through the order book that you see on the front end, also through our RFQ system where you have a market maker on the other side. And then additionally through block trading transactions, right? Block trading requires, I think, a minimum of 25,000 contracts to be traded at any point in time. But we have market makers on the other end of that willing to stand up 8 figures immediately, right, on an individual basis to facilitate those block transactions for our largest institutional customers. And that's a very recent development, right? Because, you know, a year and a half ago, we were suing the CFTC to be able to list election contracts. Now there are firms that want to put ETFs on those contracts. So this space is moving so incredibly quickly. And I think what you're saying also is very important, you know, in the context of being on a regulated US exchange, right? Because from our end, you know, that institutional trust and that credibility is fundamental to everything that we do. I think, you know, markets, and we talked about insider trading before, markets where insider trading is rampant are not valuable and they're not interesting to trade, right? They scare off market participants that don't have that asymmetric information. So that's why Kalshi, of course, like bans insider trading, but also goes really far to police it, adds trading prohibitions to all of its markets, proactively blocks people from trading certain markets, requires employment information for trading our KPI markets, you know, collects KYC, knows where you live, has your social security number, right? If you're going to pick a venue to go and do insider trading, Kalshi would not be the venue that you should choose to do that insider trading, right? I think that would be a stupid thing to do. And when people do choose to do it, we're really good at catching it, right? Like when a politician, I think, put $100 on his own election, we find him like a ridiculous amount of money, right? Like, and that came out very publicly. That must have been extremely embarrassing, you know, as a thing to do. So I think that, you know, for us as an exchange, we take that very seriously, and we understand that there is almost asymmetric concern about insider trading on these markets. So of course, like, prediction markets didn't invent insider trading. This happens on all financial markets. It happens in all regulated exchanges that we would consider to be traditional financial exchanges that transact equity products, for instance, where you have a friend that works at an M&A firm that tells you to put some money on Apple because they're about to acquire a company or they're about to release a new product, right? And you put $1,000 on it because you think that's a great idea, and the SEC never catches it because it's too small an amount of money for them to care about. But on our platform, where you're trading questions very directly, you're able to take those, you know, the way that those users are trading and police it. And I think those integrity measures that we're continually building out are really important, you know, for institutional trust to come onto our platform. And I think that that's what's led to date to the institutions participating that we've seen.
So I just wanted to follow up and say something about manipulation. So there's one type of manipulation where you are an insider, you can trade, and then you can take an action that is going to affect the outcome. I think there is another type of manipulation that is a little more tricky, which is you're trying to affect the outcome through the price. And this goes back to what I said before about the real effect of financial markets and the real effect of prediction markets. So let's say that there is a trade out there that predicts that a firm is going to go bankrupt. In some sense, that can become a self-fulfilling prophecy, right? You're not an insider, you're not taking any direct action. But if the market suggests that this firm is going to go bankrupt, then other people who are taking the action might do something that is going to push it towards bankruptcy. And I think this is the kind of thing that we need to be aware of and be careful about. You know, you can think about sort of meme stocks as the other side of it. There are trading that push up the price of a stock, and all of a sudden the firm is doing better than it did before, and that kind of becomes self-fulfilling. Now, we know these things exist in financial markets. I think they become even more tricky when it comes to prediction markets, because here you're really focusing on an event, and if the price of this contract is going to point in a given direction, this might lead the real outcome.
You know, it's funny. Oh, sorry. We see this concern a lot. I just want to quickly address it. Well, so first of all, right, the bankruptcies example is a good one, right, because it's like the bank-run dynamic. We don't list contracts on that for the incentive construction reason that I mentioned earlier. But even outside of that, right, when you're talking about, say, political markets where people, you know, and that's the most common example used, where people might want to buy up the order book for a candidate, right? Fundamentally, we see price correction happen near immediately across all of our markets when we see that happen, because the incentive construction is such that you would be motivated financially to do so. Like, we, from our internal research, and hopefully this will be released in the next few weeks, have found no evidence of this at all. And historically, there is no evidence of this happening in parallel instruments either. So it's an interesting area for future research for sure, but it's not something that is an active concern.
So, you know, I think that, you know, there is a body of academic work that shows even in traditional financial markets that there is this feedback and self-fulfilling prophecies that we're always concerned about from a financial stability standpoint. And it just kind of shows that as we expand on the set of things that are tradable, we do need to be mindful of the potential for a much broader set of informed participants to use that to their advantage, or to also orchestrate different types of attacks as well. At the same time, I think that the excitement is around the potential, despite the fact that there are these challenges to navigate through this and to make this a safe market. Unfortunately, we are running out of time, but I did want to do a quick lightning round, and just by saying, for each of you, if you have, is there an event or a category that you think we should know about, or that could actually be incredibly unique or life-changing for you as we look towards the future and think about kind of either as a participant or a consumer of information on a particular event?
Okay, so I think there are already many events that are traded in prediction markets. I don't necessarily want to add more events. What I think that we need to maybe focus on is how to fine-tune these contracts to give us more useful information. So let me give an example. So let's say that there is a contract on whether firm X is going to buy firm Y. Okay, so this is on an acquisition. Now, suppose you're looking at the price of this contract and it suggests that there will not be an acquisition. The question is this useful information to the decision makers? When they see that the market predicts there will not be an acquisition, they might think, well, the market thinks this is a bad idea, or they might think, well, the market thinks this is not going to go through. So in itself, it doesn't tell them whether this is a good idea or not. So you could add another contract. The other contract could be, suppose that the acquisition did take place, will the price go up? Or you can phrase it however you want to kind of ask whether this is going to be a profitable acquisition or not. And here the combination of these two can actually help you make a useful decision. So that's the direction I will think in.
Fascinating. Nicole?
Compute and AI, I think that seems to be the thing that everyone is talking about these days. I think that those are going to be the next frontier of expansion for the markets that we have live on our platform in terms of category.
Oh, very interesting.
So I have an app that says it gives me my days left. And so it helps me live my life, fully. And I did it with my 94-year-old dad, and it said 0. And so I'm like, oh man, this model needs to be improved. So I think longevity, life expectancy events.
Oh, that's awesome.
I'll actually take it from what we did internally at Solus at the beginning of the year. We had a company kickoff, and we actually had internal prediction markets where each team lead and team member gets to predict how well will their product or feature or initiative for the company is going to work out, which also create good competitiveness. So I think at some point creating actually internal for companies prediction markets could be an interesting way to create culture and KPIs.
I'll be a little bit of an iconoclast and say maybe some more micro-structured transactions. And when you think about, is my neighborhood going to flood? And then you can use that as a replacement for flood insurance or things like that, where people can start to get efficiencies of the broader market, and you have more eyeballs focused on specific events that can actually help and improve the end consumer and people's lives. So that'd be one thing that I would, it kind of goes in the face of, do we want to have, I have fire insurance for my home. Do I want to encourage people to, come and light a fire? But it does, potentially lower costs for the end user.
Well, I think all of these answers showcase how much more work is needed for us to get to that point where we have deep liquid markets with all the information and all the safeguards. Thank you so much for joining us today. And this was a hugely enlightening discussion.
Thank you.
Thank you, Michael and panelists, for that exciting discussion. We'll next have a panel moderated by Per von Zelowitz, director of the New York Innovation Center here at the New York Fed, which will focus on innovation in the Second District.
Thank you, everyone. And this next panel, you may have noticed, was not originally on the agenda. And again, applying our principles of innovation and being agile and pivoting, we've decided that there's a great opportunity to present a bit more of a spotlight on innovation in the Second District. So we had the opportunity to invite representatives from the different companies who were in the expo outside the hall yesterday to now discuss a bit more specifically about the work that they're doing and also their work within the Second District. So when you hear me reference the Second District, some of you might wonder, what is that? You'll see it on the New York Fed emblem or sign when you come in the building, but it might not be immediately obvious what that is, but it's the geographic area that the New York Fed covers, which consists of New York State, parts of Connecticut, parts of New Jersey, Puerto Rico, and the U.S. Virgin Islands. So I'm still waiting for my transfer to the Virgin Islands, but that hasn't happened quite yet. And these companies that are here today, who will introduce themselves in just a minute, all have some strong connection to the Second District. So either they're based here or they're doing much of their work here in the Second District. So it's an opportunity both to learn about what they're doing, but also their relationship with this important area. So with that, what I'll ask our panelists to do today is briefly introduce yourselves and also spend just a couple of minutes delivering your elevator pitch. So what is the problem that your company is directly trying to solve? What's so critical about that problem? Why is it an important problem? So I'll start with you, Ben.
Thank you. Thank you guys for coming in on a day when the trains might shut down because of the World Cup again. My name is Ben Coleman. I'm the founder and CEO of Reality Defender. We are a deepfake detection company scanning hundreds of millions of phone calls, video conferencing, onboarding, and online media to detect whether something is AI or not. If you're a JP Morgan customer, we scan your voice. If you use Zoom and Teams, you could use us to scan for different faces on a video conferencing call. We are based just a few blocks north of here in New York City. In a previous life, I worked at Goldman Sachs, where I saw the first kind of use of AI to commit identity fraud. And it took a few more years to really ramp up, but in the last year, it's really expanded about 20,000% in terms of not only access to technology, but the use to commit identity fraud at scale.
Hey, thank you for having me. My name's Simon Mile. I work at Superstate. We are a technology tokenization platform. We will take traditional assets and put them on the blockchain to add utility for the issuer and for the holder, right? So you can do all kinds of cool stuff, 24/7 trading, peer-to-peer transfer, collateral use cases, really increasing the velocity of money, velocity of assets on the blockchain. It's not to replace the traditional system, it's to add to it in terms of distribution and utility. We do this for regulated, registered assets on the shore in the US. Important to say they're natively issued as opposed to some of the wrapper models where they'll just buy assets, wrap them, and trade them. We are working with the issuers, Galaxy Digital, who just left the stage, Invesco, Bitwise, Coinbase Asset Management, to tokenize their assets and add them to the blockchain.
Hi, my name's Ethan. I'm the co-founder and CEO of Allium. So what we do at Allium is quite simple. We take the world's blockchain data to help people understand what's happening on the blockchain. And there are three key themes that we normally track. Number one, it's if you want to understand anything with stablecoins, cross-border payments, we have a lot of all that data tagged and already formatted nicely. We worked with Visa on a public stablecoin dashboard like a couple of years ago on that. If you want to understand more on prediction markets, for example, as well, we have all the data on that, like checking like anomalous activity and understanding like how to, for a lot of funds, also trying to market make on top of that. And then the third category is we track all the tokenized assets as well. You know, like you want to find the net asset values, track who's buying the tokenized equities, what are they doing with it, like who's transacting in it. So I think the TLDR is at Allium, anytime you need to understand anything that's happening on the blockchain digital asset space, like we got you covered. So, and I'll hand it over to Spiro, who's one of our partners.
Thanks, Ethan. Spiro Antonopoulos. I'm the Global Head of Advisory and Investigations at Solidus Labs. Our founder and CEO, Asaf, was just sitting here talking about prediction markets. We are a market integrity platform, originally for frontier markets, so originally in digital assets and crypto, and now in prediction markets, in tokenized equities, and of course in traditional equities, futures, and commodities. We cover those markets as well. The problem that we set out to solve in 2018 was that capital markets, as they were forming, in the kind of very fragmented regulatory space that digital assets was back then, lacked any tools for understanding price and volume manipulation, insider trading, different types of market abuse that traditional capital markets have determined frameworks and guardrails to cover and to monitor for. So the challenge to do this in digital assets and frontier markets is that the data sets are different. The markets are on decentralized venues as well as centralized venues. They're global. The order flow looks very different. You have to map traditional order books and analyze that data to the blockchain data that Ethan was just talking about. We have, at this point, 70 clients across exchanges, broker-dealers. We are the trade surveillance provider for the European Securities Markets Authority under MiCA, the digital assets legislation, and we work closely with the SEC and SDNY on market abuse enforcement matters.
Thank you, Spiro, and it's really interesting to compare this panel to many of the others where we don't have a single connecting theme necessarily on this panel. So all four of you are working on very different problems with very different products, but what is consistent is that these are all very important areas of work. So these are all needs within the financial system in some way or another, and it's a real opportunity to understand the diversity of approaches to trying to solve the huge range of problems that exist out there. So Ethan, I'll go back to you and get a perspective from Allium. And you mentioned in your opening remarks some of the work that you do around blockchain data. Allium is really all about data in many ways. And I wonder if you could help us understand what can you see in the blockchain data that's really not visible in traditional financial systems today. So what should the banks and regulators in this room be paying attention to relative to that sort of insight?
So, I mean, there are many angles, but I'll start with a very simple and clear example. So about 2 years ago when we embarked on a partnership with Visa. So Visa is a payments company. You know, they care about any blockchain stablecoin volume related to payments. And I think the headline number, if I'm not mistaken, is like 63 trillion in stablecoin volumes. And the work we did with Visa was to understand what constitutes real payments, right? And what it turns out, it was less than 1% of the total stablecoin volumes that constitutes real payments. And so, and a lot of that came from the initial, you know, like the headline numbers maybe 3 years ago, you know, like let's say blockchain volumes have overtaken Visa. You know, you see those like clickbait headlines, and a lot of the work that we had to do was to kind of like decipher, like, okay, this is bot activity, this is trading activity, this is wash trading, and then how do you get down to that number that makes sense, that you can make decisions on? So that's like one very simple example of how this is the type of, the data is pretty messy, right? And a lot of it, you have to go and understand, like, number one, clean all the data, and number two, also tag all the different wallet addresses to understand like what the use cases are. And then just to follow up, so then we took that one step further. About 3 months ago, we launched a partnership with BCG, Boston Consultancy Group. They wanted to take that one step further, and we wanted to break down the different stablecoin payments for, you know, is it a consumer business? Is it a consumer or business or B2B payments? And that's a lot of the work that we did. And so it's a very nuanced question because I know everything is data, and a lot of it is that we work very closely with our partners to answer their question. Yeah.
Thank you. And that's one of it's an interesting area, and it's one of the interesting problems relative to blockchain data also, where much of the promise of blockchain is its transparency and the ability for anyone really to have visibility to the data that it contains. But the flip side of that is that it's also not always obvious what to infer from the data that's easily accessible.
I like to joke this ever since I started a company about almost 5 years ago. Like blockchain data is public and transparent, but there's like 100 layers of glass between you and the data. So even if you want to try and you can see it, but for you to use it, you have to chew glass all the way to get to the end, and that's the reality of the space. It's transparent, and then the other part, it's because blockchains are permissionless and decentralized. There is no standard. So someone has to go in to standardize the standard, right? Because everybody is coming out with their own standard, right? That's always a joke. If everybody comes up with a new standard, there is no standard, right? And so that's a lot of our work to kind of reconcile everything and make it in a nice, clean semantic layer.
Thank you. So now I'd like to move over to you, Spiro, and we heard a little bit in the earlier panel that Asaf alluded to this issue. And I'd like to see if you could expand on it, where today banks clearly have very sophisticated trade surveillance capabilities. So this is a huge area of investment for a large number of banks. Substantial staff working on these problems in the banks. It's oftentimes cited as one of the major operating expenses they have. And I wonder if you could help us understand a bit more about what manipulation patterns exist within digital assets today that you would imagine might slip through conventional surveillance systems. So again, we heard on the earlier panel that there are always new opportunities for exploitation based on the new models, the new technologies that are being used, these sorts of things. So if you imagine from the perspective of a compliance officer trained on FINRA rules, what might that compliance officer miss relative to the risks that exist today relative to some of the traditional risks?
Yeah, it's a great question, and it's one of the questions that I spent a lot of time in 2023 and 2024 talking to regulators around the globe about. This was their one question. They said, what is the delta between, we have a markets surveillance team that is surveilling our licensees. We understand capital markets in traditional finance. Tell us, everybody says digital assets is different. We see all the headlines. What is the actual delta? And the answer is quite broad, and it depends on the nature of the trading. But I like to break it down into 3 primary categories. The one is the market fragmentation, and so a lot of the patterns are the same. Spoofing is spoofing, wash trading is wash trading, pump and dump is a pump and dump. We had small cap penny stocks 25 years ago. They still exist in APAC markets pretty extensively. But when the liquidity is spread across hundreds of venues, and some of those venues are autonomous smart contracts, and some of those venues are lightly regulated exchanges that have very different controls, and you have no ability to see that it's the same entity that's on your exchange that's also executing or providing liquidity on these other exchanges. That creates lots of blind spots. And so then it becomes a data question. Is one reason we partner with Allium is to help with some of those pockets and really marry all the traditional data to the blockchain data to then the data that doesn't have to do with trading at all, but is very informative for understanding trading behavior. So market fragmentation is one. Data is really the second, which I kind of touched on. The third area is, what are those new manipulation patterns? Because, as I said, spoofing is spoofing, but there are new manipulation patterns. There are, back when we had DeFi summer and the kind of after that, in the panel so far, we didn't talk at all really about DeFi. But looking at the mempool, like you would look at an order book to understand where orders are being placed, what's being front run, what's being sandwiched, and distinguishing between protocol design, and which might be characterized as benign behavior or kind of intentless behavior, versus the front running or the sandwiching that has intent behind it. and is designed to be malicious. And there are debates in some of these autonomous protocols about, what constitutes, if it's built into the protocol design, is it market abuse? Those are questions that the regulators are grappling with. That's one. You mentioned FINRA. So FINRA 5310 totally breaks down. So this is the best execution framework that was promulgated by FINRA, and that all thousands of broker-dealers have to comply with. They have to show that they are executing their clients' trades based on their clients' instructions in the best possible manner based on prevailing market conditions. So it's a little bit more principle-based than the SEC's rules around best execution and establishment of a national best bid and offer price that they have to trade against. But the point is that now you have broker-dealers and ATSs that are executing through decentralized aggregators like Jupiter and 1inch, and the trades are settling on pools that have massive slippage that are basically outside of the regulatory remit of FINRA. And so for the compliance officer, the challenge is to understand what does price manipulation look like when it's happening in these pools that are outside of the regulatory remit, and also, do I have the tools and the data to actually monitor for these price and volume manipulation patterns? I'll stop there. There's lots more, but.
Yeah, thank you. Yeah, and it's perhaps unfortunate that there's lots more, because that indicates that the problem still exists and the risk is there. But one of the things that you mentioned was your work with Allium, and I think this is probably a characteristic for all four of you. But while your companies are focused on solving a clear, specific problem, you're not doing that on your own. So there's partnerships that are required to deliver your work. There's other technical assets, whether it's a data partnership with Allium or some other partnership. So I wonder if you could also just talk about that a bit. If you think about your own core solution, but what might be the few critical components that you need to include in your core solution that allow you actually to solve the problem, deliver the value proposition that you're focused on delivering. So perhaps you could just follow up briefly on that.
Yeah, so I'll try to be brief. Data is the lifeblood of trading, of everything, I guess. But so we have many market data partners, including ICE, and we also rely on the private data of our clients. Setting up the infrastructure to ingest 1.2 trillion orders a year in a performant way and have algos that run on top of that to detect market abuse in real time. We would not, we don't want to focus on sort of the hard problems of data cleansing, right? We'd prefer for ICE to do that for market data in traditional markets, and for Allium to do that in certain blockchain markets. And then there's other partnerships that we have with certain OSINT providers for the deep investigations that we do for some of our public sector clients. So yeah, I mean, partnerships are definitely the name of the game, as well as focus to understand sort of what's the real value proposition that you're bringing. And we focus on market integrity across markets, and that is our number one proposition.
Thank you. And before I go over to you, Ben, perhaps Ethan, if you could just follow up on that question also.
Yeah. So for Allium, where our core value proposition is that people don't know that if you sum up all the blockchains together, 150 of them, it's about 5 petabytes of data. Just to store that data would make most companies go bankrupt, I think. So that's the scale that we have to deal with, and that's why you talk about everybody partnering together in this ecosystem. So where Allium specializes is in the storing all the data, enriching it and making it very usable and easy to use for other people. So I think everybody has a role to play in this ecosystem here. Yeah.
Thank you. So Ben, I'll go over to you, and we actually heard deepfakes referenced in, I think, the first panel yesterday morning. There was a panel on AI, and while deepfakes were not the focus of the panel, it was brought up as one of the risks that could be introduced via developments in AI and more in general. So I'm wondering, from your perspective, we've seen deepfakes used to authorize fraudulent wire transfers at banks and for other other financial transactions as well. And as we start to think about how crypto is evolving, one of the characteristics of crypto also that's often cited is the irreversibility of change. So once there's a transaction that's taken place, you can't necessarily reverse it, even if the fraud was one of the reasons that the transaction took place in the first place. So I wonder if you have a perspective on how that really changes the stakes for the work that you're doing and trying to defend against that kind of fraud. And again, if you think about this from the perspective of a bank or another financial institution, what should the fraud prevention team there really try and think about or understand differently related to that risk?
Yeah, I mean, I'll first say I'm very much pro-crypto, but coming from the cybersecurity side, I think the irreversibility of crypto is obviously much more an advantage than a disadvantage here. I think with deepfakes and generative AI and just kind of agentic fraud in general, where it's really changed in the last 12 months is it's no longer the $25 million CFO fraud. You know, it's not these huge, monumental, wow, a CEO or a CFO or a big client or a government institution was deepfaked. What's happening now, because the technology is available to everybody, my 9-year-old son can make a deepfake of me. He thinks it's funny. Me as, I don't know, Tom Cruise. But obviously it's limited by your imagination of how bad you can make it. But because the technology now is available to run locally on a MacBook Air or even on an iPhone or an Android device, it means that deepfakes have moved into every single type of fraud in much smaller pieces. And so it might not be a wire transfer or a, trying to take over a crypto account or a wallet, but it'll be very small interactions that are in a much more complex, maybe state-level actor or other type of nefarious action that could go over many days, many months, many different people. And so it's a lot of things that might not seem nefarious, maybe just trying to figure out the kind of the topology of an organization, who reports to who, who's in the office, who's on a remote computer. So a lot of small things that are more traditional social engineering are suddenly back because AI does not work at human speed. It works at much broader speed. And leveraging deepfakes and AI for fraud, right now I think the best use case, unfortunately, for agentic is fraud. You only be right once. And so whether you're trying to create issues for the Fed or for a bank, it can work very slowly and diligently across a whole population and build up a repository of information to try and culminate in some type of financial or impersonation fraud. We're very optimistic, though. Tools like ours can be integrated into every layer of the stack, but it's very much a horizontal problem. It's not one single place. It's kind of like thinking about antivirus. Does antivirus apply to any one industry or vertical or horizontal? No, it's everywhere. And so anything you could see or anything you could hear can be deepfaked. And that's an opportunity for kind of better cybersecurity hygiene for every layer of your organizations.
Thank you. And could you also address the partnership question? So if you think about the core product that you have and the work that you're doing at Reality Defender, what are the other components that are required for you to deliver your value proposition? What types of organizations or other components are required to include?
So I'm sure everyone here is familiar with platforms that are doing kind of watermarking or leveraging hash values to fingerprint images or videos or audio. Deepfake detection is inference, so it's not, there's no ground truth. It's not comparing my face to someone else's face. It means that if you're leveraging it for a bank, for example, you don't need to upload any of your team or your client's information because a solution like ours is not detecting whether it's Ben or not Ben. It's only focusing on is there AI or not AI. And so thinking about not leveraging any PII, no biometrics, no voice prints, no face prints, means that a lot of the traditional vendor risk issues just don't apply here because we don't need any personal data. There also is kind of a theme in that it's headless, meaning that you don't consume us directly. We come in through the tools you already use. We come in through IVR and call center platforms you already use. We come in through Zoom and Teams, which you already use. And so the idea of it kind of being a kind of new point solution does not exist. You don't need to add another vendor. It comes in as a signal on top or in line with all the tools you use so that if, for example, Ben Coleman, my face, my voice, my social security number, my unique device ID says it's me, we will then say yes, but the real-time voice is AI with 99% confidence, meaning that it doesn't prove that it's me, it just proves that somebody has my information, and it is a bad actor or a hacker or C-level group trying to impersonate me to break into my crypto account or my employee account with a help desk password reset or some other kind of nefarious online impersonation.
Great, thank you. So Simon, now over to you and Superstate. And Superstate has brought a regulated securities product on-chain. So I wonder if you could share with us a bit about what surprised you most about translating traditional regulations to blockchain rails. What worked and what was harder in that process than you might have expected?
It's a very good question. I think it's getting people comfortable with the utility that you have on chain and what can happen to assets and what can be done with them. And then I think it speaks to this whole panel that everyone's trying to make the marketplace more transparent and more easy to do transactions. I think rug pulling and all these nefarious transactions early on is just human nature. I think the industry's come a long way. What we need to do is get the regulator comfortable with that, so they're happy for us to issue these assets on chain, and they know that Superstate technology can make sure only people who hold these assets can do that. And that's kind of where we're up to at the moment. So getting them comfortable with the structure, getting them comfortable with the participants is super important. And then getting institutions comfortable coming on blockchain as well, because that's where the business gets going, when capital markets really start forming. Yeah.
Thank you. And I'll ask you the same question as the others also. If you think about the products that Superstate is bringing to market, what are the critical partnerships or other assets and resources that you need to bring to bear to deliver your value proposition?
I was actually thinking about that. I think it's the guys who are all sitting next to me here, right? You've got to get people comfortable transacting on chain, right? And how do you do that? You make it more transparent, you make it safer, you make it more institutional. We succeed when institutions come on chain. We succeed when the regulator is happy with what's going on chain. And that only happens when you have safe identification, a ton of information, and all the stuff that supports the traditional capital markets are now on chain, and they're actually better because of the technology, but they're there now. And it's just that human nature market cycle where you have the people early on who are the chancers who take advantage of the inefficiencies or the newness of the market and the market structure. We've developed so much in the last few years by the nature of this event and the people here that we've just made a huge amount of progress, and it's thanks to all the partnerships across the board.
Great, thank you. So I'd like to ask you all one final question. And as we started off, the focus of this panel is on innovation in the Second District. And even if you're not a basketball or Knicks fan, if you're here for the parade, or if you watched it on TV or saw some videos of it, you realize the energy of New York City and the community here. And you're all connected to New York in different ways. So I wonder if you could just reference briefly how your proximity to New York, how your work here in New York City, being close to Wall Street, regulators, other technology firms, sources of finance, the general community here, how that has shaped the work that you've done, how it's shaped your products, what you've built, but also how it's influenced your go-to-market. Are the traditional institutions that are here or the other institutions that are here your customers? Are they your competitors? So a little bit of perspective on how New York has influenced the work that you're doing, and I'll start with you, Ben.
Yeah. We started the company during COVID, and we had a choice between building it in California or New York. It was very obvious to build it in New York, not just because all of our clients are within 15 minutes by subway or taxi, but more importantly, the financial service institutions and the proximity to regulators has created a phenomenal funnel of new hires who are very well trained in exactly the types of problems that we're working to solve. So we're not trying to, poach people from the banks, but it's a fantastic training ground. I mean, personally for me, I could not have started the company at the stage that we did and the speed that we're working without coming up through financial services in New York City.
You could probably tell from my accent that I'm not a native New Yorker. I moved here 12 years ago from London, and on a personal level, I think it's the best city on the planet just for the hustle, for the opportunity, for the people who are here and the ability to get stuff done. And that's kind of why I haven't left after 12 years, and I'm very happy here, and I don't see myself leaving. And that all translates to setting up businesses and the opportunity here to meet people and get stuff done. And I think with the crypto space, it was maybe West Coast, it was maybe Miami, and then New York just became the complete hub. And if you're not in New York as a crypto company or a blockchain company, covering the US domestic market, you're missing out.
So yeah, for me, I used to live in the Bay Area, San Francisco, for many, many years, and I moved to New York because I love New York. Like I think it's like the intersection of like finance, you know, like and tech and like legal, even advertising, fashion. I mean, I get to wear a tie. If I wear a tie in San Francisco, I think my friends would be a bit perplexed. So I like ties, as you can see here. So I mean, for me, but more seriously, I think it's amazing for us because, especially as Allium, we serve a lot of all the financial institutions. We work with regulators. But also like a lot of the builders, like in the blockchain space, are our office in Soho, and I would say within a 15-minute walk, not a train ride. Within a 15-minute walk, there's probably like 100 companies around us, startups around us that we also help a lot of the builders with the data problems. So for us, it's like just being at that intersection. It's been super fun, and yeah, I love it here. I'm here to stay, and I'm originally from Singapore, so I know what cities are like. So, yeah.
Am I allowed to pass? Because I'm from Boston originally.
No passes allowed.
No, I think maybe on this suit I got beer spilled on me at the OG Game 4 at a bar in Brooklyn. So I definitely, as much as I hate the Knicks, I got caught up in the energy. And similarly, so I've been at Solidus long enough to go through a number of digital asset booms and busts. I don't know if we had 3 or 4 licensed entities of FTX as clients. Which is funny because like market integrity, right? Which shows you have to have controls in place beyond just tools. But the Soho crypto sort of node was powerful during those years, and now it's changed. And the value of being in New York is that we are talking to all the institutions that we know and love, either as clients or prospective clients, and an introductory call can turn into, let's turn this into, we're 4 blocks away. Let's come and do a whiteboarding session on your plan for tokenization and the risks you have. And it's so exciting to have that, and to have that in such proximity and density in New York. So, and our 2 of our founders are ex-Goldman alums, from, down the street. And so, being here is a very natural fit for us.
Well, thank you. And basketball affiliations aside, I think it's a great example of the diversity of work that can take place here, but also how the environment here evolves over time. So saying there was a significant crypto node in the Soho area was probably not a discussion 5 or more years ago in the same way that it is today. So there's really this incredible ability to, I think, identify talent, build capabilities, build businesses here, and that's just a great example of how quickly that can happen, but also I think the value that's created here. And also the diversity of this panel, again, is a great example of how you can start all kinds of different businesses targeting different problems, different opportunities, different value propositions in this market. So please join me in thanking our panelists for this fantastic discussion. Thank you.
Thank you, pair and panelists, so much for the discussion. So we'll now have our lunch break and a few points of logistics. So going down for lunch, we'll go back to the elevators and go down to the first floor. And during lunch, we'll have a moderated discussion. So Frédéric Véron, the Chief Information Officer and Head of Technology Group here at the Federal Reserve Bank of New York, will be leading a discussion with Caitlin Nasro, Acting Superintendent of the New York Department of Financial Services. So that will start around noon, so you can calmly head down to lunch for that. And so far, all signs are pointing towards Miriam being able to arrive in time for her research spotlight. So we will target to return here in the auditorium for her research spotlight at 12:20 p.m. Enjoy your lunch. Hello, everyone. Hope you've been enjoying your lunch. You can continue eating, but we'll start our moderated discussions. So Frédéric Véron, the Chief Information Officer and head of the Technology Group here at the Federal Reserve Bank of New York. Over to you.
Good afternoon, everyone. It's my pleasure to welcome Caitlin, who is the Acting Superintendent of the New York State Department of Financial Services. NYDFS plays a unique role in our financial ecosystem, overseeing banks, insurers, and virtual currency firms, while helping shape the national conversation on cybersecurity, operational resiliency, digital assets, and increasingly artificial intelligence, AI. You bring an equally distinctive perspective here. Prior to the NYDFS, Caitlin served at both the Federal Reserve Board and in San Francisco Fed, not New York Fed though, focusing on innovation, policy, data governance, financial inclusion, and emerging technologies. At the New York Department of Financial Services, Caitlin established and led the Research and Innovation Division, helping the department navigate the opportunities and risk presented by rapidly evolving technologies, which has been the topic of the past couple of days, been with us here. Today, we'd like to explore how regulators can continue to foster innovation while preserving trust, resiliency, and consumer confidence in what is becoming an increasingly AI-enabled financial system. So Caitlin, thank you very much for joining us. And on behalf of the group here, I've prepared a number of questions that will probably animate our conversation here. You've got a unique path to this role, right? From the Reserve, the Federal Reserve, to the Research and Innovation Division, where you helped oversee the New York's virtual currency framework. As you stepped into the acting superintendent role, how has that background shaped your priorities for DFS and your approach to responsible innovation?
Yeah, thank you. First, thank you to the New York Fed. Thank you to Frederick for having me. Despite not having worked at the New York Fed, I always consider kind of coming back to the system as a homecoming of sorts, so I appreciate being here. As you said, I've had the opportunity to kind of look at financial services from a number of different vantage points. I actually started my career looking at international development, introducing new financial products to markets. So kind of looking at it from that perspective, doing a lot of advising of early stage fintechs as they were developing products, and then, in the supervisory landscape at the Federal Reserve. And now at DFS, both as an executive deputy and now stepping in as acting superintendent. So I think throughout all of those experiences, consumer protection and then innovation have been, I would say my cornerstones, which I'm continuing to bring forward into this role. I will also say a lot of what is guiding me in this is just that commitment to public service. I think, for those of you who work here at the system or in other kind of regulators or public service areas, it's a hard and, rewarding time to be in this work. So I'm very focused on that. Research is also something that has been with me throughout. So really unpacking things in technology and innovation and, kind of thinking about how to do it responsibly.
Yeah, which is a key word there, do that responsibly. So with that, looking ahead, like if you were to kind of get us there in the next year or so, what do you think your top priorities are for the New York DFS?
Yeah, when I transitioned, so I had spent 4 years at DFS, head of research and innovation, and when I had the opportunity to kind of step in as acting superintendent, my first priority was first DFS staff. So, all of us, again, in the regulatory community have seen a lot of change at the federal level, but also at the state level. And so the first thing I thought about is how can I just kind of keep the staff steady in everything that we've experienced, a lot of change over the last 4 years, a lot of uplifts. So that was my first priority. Next, kind of related, is general stability, which, I know this room can appreciate, but the macro environment, as we know, is very dynamic right now. And so for our regulated institutions, for the market as a whole, kind of knowing my background, where I come from, I thought would be good. So that's another priority. Affordability, right, is a topic that is weaving throughout both the political discourse, but also just our communities here in New York. So DFS has been very focused, if you're following kind of the New York budget cycle, the budget that the governor and the legislature passed around auto insurance prices, which fall in DFS's remit. So thinking a lot about how do we balance costs to consumers with our solvency and soundness responsibility as a regulator on the insurance side, but also the banking side. So navigating that, and then of course innovation will continue to be a priority. Everything from third-party risk, cybersecurity, as you mentioned, crypto, the movements at the federal level, AI, agentic AI, mythos, all of those things. I'm also thinking about new ways in which data is interplaying with spaces that I'm newer to, like insurance, so looking at telematics and things like that.
So it's quite a busy agenda, right? There's a lot there going on. And you've been seeing innovators kind of everywhere in your role. What opportunities really stand out at you at this point in time? What's the kind of the top thing that you have in mind there?
Yeah, I mean, I will say, the thing that's, a focus area, I think, for all regulators and kind of everyone right now is, of course, AI and this Cambrian kind of moment that we're having in introducing the systems into businesses and kind of seeing, I will say, where they stick, where they're really creating that lift. I will say, if I use myself as the test case, which I typically do, my use in a personal capacity of, our LLMs versus now has really changed for me. And so, very focused on AI and its applications right now.
So I'm glad you picked AI because I had like a number of questions and I didn't know which way we were going to go, digital currency or this, that, fintech, AI. But okay, AI could be maybe the topic we can focus on a little bit. So with that in mind, and much of your earlier work touched on data governance and open banking, as agentic AI systems begin acting on behalf of consumers and businesses, do you think today's open banking frameworks are sufficient? Or do we need new concepts around delegated authority, consent, accountability? Or how do you think that's going to evolve?
Yeah, I mean, I know that, right, the kind of open banking framework that we had under the prior administration may be changing. So, I won't comment on kind of what that structure is or is not generally, but in terms of agents, I think we have been very focused on them, and there's a lot of similarities to the work I did previously. Where does liability sit? How do we maintain those essential consumer protections and the payments flow in our financial system that we've had for a very long time, and now you layer this new opportunity of kind of data and consent onto it. So I think we're thinking about agents in the same way, right? Agentic commerce, agentic payments, the idea that a transaction can self-execute is a little bit, jarring for a regulator, right? How do I make sure that the consumer is protected throughout? So, the opportunity for us is we really have an amazing research team that is focused on AI generally, and there's still a lot of other applications, of course, beside agents that we're looking at and considering, but focused, very much on agents right now and consumer protection around that.
Can we dig a little bit there? So that research team, who are they working with across the ecosystem, across the economy, the industry, to kind of have kind of a good, views of what's possible and what's coming up?
Yeah, this is a lot of the work that I did at the Federal Reserve, at the Bank of San Francisco, and at the board was really thinking about how do we kind of embed researchers, staff, and this was, my prior role, who are really kind of digging into innovation, digging into the new technology, and making sure that the supervisors were kind of armed with what they needed to have going into the banks or wherever it might be. So I've created a lot of that at DFS. So we have a dedicated innovation policy team that their job is really to think blue sky and to think about, where do we need things without kind of overburdening the supervisory teams who, right, are going from exam to exam or doing kind of their MRA follow-up or whatever it might be. So that team is kind of embedded and always trying to think around the corner, but also trying to kind of integrate with the supervisory teams in such a way that they're not kind of top-down telling them what the risks are, but engaging in what they're seeing in exams. So right now they're doing a lot. For example, in the insurance space, we passed Circular Letter 7 about the use of AI and external data sources in underwriting and pricing in insurance across all insurance types. So there, of course, we were worried about biases, discrimination. We have guidance and detail on input testing, output testing, transparency for consumers, and that innovation team is now sitting along the insurance supervisors, looking at their first day letter questions, helping them develop them in, I'll use the banking terminology, but, developing those first day letters, reviewing the information. Then we also have DFS Exchange, a program that is similar to, what many at the federal level had of, office hours, innovation hours, folks coming in. And this is, separate from supervisions, definitely separate from enforcement, where early stage innovators can come in. We've done roundtables here in New York with some of the incubators that are run to kind of then hear kind of what are the new use cases. So we're getting input from this team, from the supervisory side, from the exams, from those points of contact, from our regulated entities, getting input from early stage innovators, and then of course our desk research.
Great, because I was going to ask, it's great to paint the blue sky, but you need to ground that into reality and have a feedback mechanism. So it's great to see that actually all these different dots, you're trying to connect them through the process. Talking about AI, concentration risk. Financial services have learned to manage concentration risk. Well, maybe are still learning to manage concentration risk in core banking providers and other things, right? And more recently, like cloud infrastructure and technology of that nature, right? Are we entering a world where frontier AI models and their underlying infrastructure become another form of critical financial infrastructure?
That's a big question for me to answer kind of in this moment, right? There's a lot of, on the political side, on the regulatory side, folks looking at the frontier models. If I take a step back, I tend to take the approach, right? Like, what does regulating AI mean? I think for me, it's not all one thing. It's really about the use cases. And I think banking regulators, insurance regulators, markets regulators all have a responsibility to look at the particular use cases and have their supervisory overlay there. In terms of larger systemic risk, that's something that we have the opportunity now at DFS to look at through the RAISE Act. So the RAISE Act was passed last year by the governor. So that is us looking at, for New York State, frontier AI models, looking at the particular risks, getting those reports. And I'm, of course, we're doing it as a kind of role for the state writ large because we have this expertise in DFS. But I'm, of course, going to take advantage of it as a financial regulator and say, what are we seeing? What can we learn from that? And how do we apply it on that more systemic risk side? I'll say, right, the kind of role of different service providers, especially in the technology space, I think have to change our view of what concentration risk means and what complexity risk means in this space. I think, I've been very interested in third-party risk throughout my career, and I think those dynamics are just changing, right? The power dynamics, the information asymmetries are just different now.
Can we take actually getting out of the AI discussion, go back to that third-party or nth-party risk? Can you actually share with us kind of what's your latest thinking on that topic? I know as the CIO here at the bank, I deal with that every day. Any good advisory advice you can actually share with the team here?
Yeah, so we, as I said, it's an area that I've been fascinated with, and probably every place I go, I try to figure out, how to map all the interconnections that all of our banks, our regulated entities are kind of experiencing, and again, where we have, of course, concentration risks on the major cloud providers, now on the major frontier models, but kind of what to do about that is a different question. So we actually put out one of my first pieces of guidance stepping into this role as superintendent was third-party risk guidance on cybersecurity. And so what we saw, again, using our own supervisory experience for feedback, we saw in many of our exams. So to take a step back, as many of you, I assume, know, we have Part 500 in New York, which is unique. DFS implements it in that we actually have a cybersecurity requirement that cuts across all of our entities, check cashers to our largest banks, to our largest insurers, to a small money transmitter. And we do exams on every single one of these entities, embedded in our other exams or specific to cyber. And we saw, again, just basically, not as much engagement as we would expect on those third parties, and they are a key cybersecurity risk. So that guidance is really nothing new in terms of requirements for our entities, but I think the first tenet is, be very proactive, right? The entities, the third parties are constantly changing. The number of times where there's now, AI capabilities actually embedded in the third parties when that was not what you originally sought is key. And they're changing their system, so continuous adaptation. We went through a detail on kind of doing your risk assessments, and also thinking about the third party throughout the life cycle. So it's not kind of just the moment in which you have already signed the contract and you're in process, but it's really from your kind of strategy of bringing in the third party to your vetting, to your identification, to your implementation, to your wind down planning, and then your offboarding.
Yeah, there's still quite a bit of work to do there. Indeed, so I actually think about third party. Working right now on potentially using AI and AI models to actually identify interconnections around those third party. Brings me to a question that I had prepared, similar to this or kind of nexus to this. We spend a lot of time discussing on how supervised institution should or should not adopt AI. What do you think about the supervisory agency itself? I mean, are you using AI in your day-to-day job? I'm assuming you are.
Yeah.
So what type of projects do you have there to better leverage AI in our day-to-day operation?
Yeah, in addition to what I heard someone say, I now have kind of an AI chief of staff in my personal life, which has been very useful. But I do think in addition to making sure that we have that embedded kind of research team in our supervisors, I've been very focused on applying technology ourselves and making sure that is a way to learn. So absolutely. So I passed, again, when I stepped into this role, our first AI use policy at DFS. This builds on the ITS, so the statewide IT system has, for all government agencies, has a AI policy, but we built upon that, right? We have specific confidential supervisory information. We have specific steps. So we put in place that policy. We have an AI governance committee. So there's a process in which any staff can submit forms, submit requests. It goes to the governance committee. Of course, it goes through our CISO and goes through those checks. So we have now a handful of approved cases, and we actually had to stop cases first, right? We kind of did a reset. We found a lot of places where AI was embedded. So we stopped that, and we went through this governance process. And I think it's positive because really, when we go in to supervise, again, my goal is that I don't want an examiner to hear about a technology or hear about a use case for the first time on an exam. I want the exam to be focused on how is that entity preparing its own risk approach, and my supervisor to be in dialogue with that, not kind of learning on the job about the technology. And so now they can also bring that experience of, okay, I submitted a request, it went through a committee, and then they had these questions. And so when an entity talks about their governance framework, there's a reflection back and a conversation.
And the other thought that I had was, how do you actually assess and distinguish organizations that are getting it right versus the ones that are maybe not ready or moving too quickly? That balance between the responsibility aspect and the innovation aspect, how do you deal with that within the DFS itself or with the supervised institutions you're working with? How do you guys measure that?
Yeah, I think this goes back to kind of there's no one way in which AI are being applied, and there's no one way to kind of do it right. That being said, of course, there's a lot of ways to do it wrong, which is, again, not having systems, not having governance, not having kind of that thoughtful approach. So I think it depends, right? And I mentioned, our work on Circular Letter 7, that's talking about kind of, again, a more traditional machine learning model, ingesting a lot of data, looking for patterns there. I'm going to be very focused on biases, transparency, rights for consumers, for your customers to be able to question data, decisions based on data. And then when I look at LLMs or chatbots, there's a lot of conversation there about, and we've had in some of our guidance, right, escalation opportunities. You can escalate to a human. There's a human in the loop verifying what is being put out by the chatbots, by the assistants. I read an interesting kind of court case in Germany. I don't think it's here yet. But we'll see as the courts decide, right, actual liability being placed in an entity for what a chatbot got wrong, I think in a medical case. So I think that'll be really interesting on the LLM side. And then agents is this new frontier of liability. So it really depends, again, on the application, on the use case, on the particular flavor of AI we're talking about.
Actually, you mentioned Germany, right? Can you tell us also what you're doing at the international level to try to capture some of the experience people have overseas and other places?
Yeah, DFS has obviously an opportunity being kind of this global regulator alongside our federal counterparts in, some of our GSIBs on the banking side. Insurance is inherently global. I was just visiting with colleagues in Switzerland on some of our largest insurers and supervising them. And then we've been very, very active on the crypto conversation and making sure. So we just released an MOU, announced an MOU with the European Banking Authority. And we've done exchanges actually with the Bank of England, and we're developing an exchange now with ACPR, the French regulator, to learn from each other on stablecoins and actually exchange staff. So we've been very active pulling together roundtables. The discussion on stablecoins and then innovation more broadly always comes up, right?
Okay. Changing maybe tack a little bit, New York DFS is sometimes perceived as a demanding regulator. Yeah, I don't think there is a non-demanding regulator that I know of. They're always demanding, particularly in areas like cybersecurity, you mentioned that before, digital assets. What is the one misconception that people still have about New York DFS and its approach to innovation?
I will say, right, I think the agency is, I'm excited. The agency is actually celebrating its 15th birthday as its combined self. So actually the banking department of New York State, the insurance department go back, I think almost 200 years, 190 something from the 1800s. So as we're celebrating this birthday, kind of that legacy of DFS, having supervised, in some of our institutions, they've been with us since really the 1800s. So that's amazing. But DFS, was merged together post-financial crisis, and it still has that, I'll call kind of M&A legacy of systems needing to combine and people needing to combine and cultures needing to combine. So that's why, again, I'm focused on the staff. So I think the misconception is, that DFS is one thing and one, hard regulator or not hard regulator, or whatever it might be, enforcement focused versus supervisory focused. I come from an innovation background, so I'm going to focus on that responsible piece, pushing forward, making sure we're open and in dialogue with our entities. And then, coming from the Federal Reserve, growing up in supervision here, right, I tend to take that approach. If I can prevent the bad thing from happening, I'll always have my enforcement team ready to go, but I want to start with supervision.
Okay, all right, that's pretty good. And maybe we can talk about also, we talked about international, but I'm thinking here state. What role should the state continue to play as federal frameworks are developed, right? Thinking about Genius Act and other things of that nature. How do you work all together?
Yeah, so I'll start with crypto and then happy to talk about kind of, our continued partnership, of course, on the federal side with the Federal Reserve and beyond on the banking side. But on crypto and Genius, DFS, I think will continue to have a strong role. So we've been doing this work for over a decade. So 10 of the 15 years that DFS has been in existence as its current form, we've been regulating cryptocurrency. So that's, ancient in virtual currency speak, especially on the regulatory side. The guidance that my team actually wrote when I was executive deputy was our stablecoin guidance in 2022. And that was really the foundation of Genius. We've been providing technical assistance to the federal legislature throughout that time as, now the next iteration and Genius came into being. So we are very focused in continuing to have that pathway. Of course, we monitor the Treasury rules as they came out. We find them to be very prescriptive, not necessarily the intent that we would read into Genius, which we thought was more principles-based floor that states could go beyond. That being said, we just released regulations, really doing another step to kind of tick and tie and codify our stablecoin framework into regulation. So there is no question on substantially similar as that certification comes online. So I think that just shows, but we don't expect anything to really change for our entities in terms of compliance. It's ingenious, it's what we've been doing already, but this just shows kind of our commitment to the entities who want to stay in New York and be regulated with New York. And we see that same commitment from our entities. So we have, yes, we've had a few charter flips, but we've had more stay. Some are taking both paths. And I think, again, we've developed the expertise. We have the strong systems here, and that's appealing to entities. And we want to keep having that state conversation, as well as with clarity, of course.
Great. I don't know, Per, by the way, can we open the question to the room there if people want to ask questions? Is that okay? Or I don't know if it was... I don't know if you have the mic, if it's okay with you. So I would like to turn to you guys, if we can take maybe one or two questions, if you're interested in doing that. And if you're not, that's fine too. That's completely fine as well. All right, so maybe what I'll do is I'll ask kind of the last question. We're speaking here with a room full of bankers, fintech leaders, policymakers. We're shaping the future of financial services from different angles. As we close here, what's the one thing you want them to think about, to walk away with today from this discussion?
Yeah, I think for those who know me and I've worked with before, the key thing to leave with is, again, I want to be kind of open and transparent as a regulator. So the dialogue is essential when we think about where's the next piece of guidance, where's the next regulation we need. I need that feedback from stakeholders, from my fellow regulators, from industry. And we will continue to kind of be available there. And also just the core knowledge that we're going through all of these transitions, all of this macro kind of volatility alongside you.
All right. Change is a constant, right?
Yes, yes.
And, and thank you very much, Caitlin, for your time here. I felt like it was a rapid fire question. You have like so much to cover, but thank you very much for joining us today, and enjoy the rest of your day.
Thank you.
Thank you.
Thank you, everyone.
Thanks, everybody.
Thanks all, and a small change of logistics. We will stay here in the dining room for Miriam's research spotlight. We'll get started with that in just a moment. Oh, perfect. Okay, we can get started now. So thank you so much, Miriam, for being here. So Miriam Farbuti is Associate Professor, Massachusetts Institute of Technology, and she'll be presenting her research spotlight on Do Markets Believe in Transformative AI? So thank you so much, Miriam, for being here.
Thanks so much for having me.
Yes, we know it's been an odyssey, so thank you. Thank you.
So is there the slides? How do I put them up?
Oh, for changing the slides?
Yeah.
Just 1 second.
Do I see the slides anywhere?
So the TV is there. I guess if you want, you can take the microphone.
Do I need a microphone or a shaft?
I think the microphone's probably better for the room.
So, okay. No, not at all. Okay. That's fine. So it's okay if I leave this? Yeah. Okay, great. Okay. So, sorry for being unusual, and thanks so much, everybody, for accommodating my crazy schedule. There was a heat wave in London, and my flight yesterday was canceled. So, hold it by your arm. Yeah, on? Okay, great. Sorry. So I arrived at 10:30, but I made it. So thanks so much. So and thanks for Pablo for inviting me. And so this is joint work with Isaiah Andrews at MIT, who's my colleague at MIT, and we ask a very, very simple question. The question is, do markets believe in transformative AI? Can I have the slides? Okay, great. Okay, so I guess given the kind of what is going on in the conference, I don't need to argue for you that there seems to be a lot of hype about AI. So it is, I think, a fact that AI has been an extremely fast-moving technology. And at the same time, during the very short period of time that AI has picked up so quickly, there's been this intense and divergent speculation about its implications. So for instance, some people think of AI as machines of loving grace in the industry. Some others think about it as if everyone builds it, everyone dies. So it is really, it's as extreme opposite each other as it can be. And I guess, you would expect, maybe you would expect this from the media, but it turns out that the economic predictions by the economists have been kind of likewise divergent. So there is a camp that think about AI as bringing about unprecedented prosperity. There is a different camp that thinks about there is little, if any, growth benefit, and the main implication would be widespread unemployment. So in this paper, we're going to ask the simplest question ever, that when we embarked on this, we thought like 500 people have answered this. Okay, but they have not. So the question is, what do investors think? Okay, great. Oops. Okay, so to answer this question, let me, because AI is a word that means 500 million things. Depending on who talks about it, people mean different things. So let me fix ideas a little bit. When I talk about transformative AI, I'm focusing on the possibility that AI, when I say transformative, it means it leads to a large and sustained impact on living standards. For instance, it can be through a dramatic increase in consumption growth, or it can be like through existential risk. Okay, it might be that we all have so much that we don't care, or it might be that we all die. Okay, so I don't need to tell everybody in this room that if investors think that a transformative AI in this sense is possible, asset prices should be impacted. So there is a long literature working on thinking about impact of investor beliefs about growth prospects and how that is reflected in asset prices. So in this paper, we're going to focus only on the bond yields, okay, especially on the U.S. Treasuries and TIPS, okay. A little bit on, if I have time, I'm gonna show you a little bit about corporate bonds, but it's all the same, okay. Why do we choose? I mean, someone might say that, oh, but stocks are a lot better because, some companies are impacted differently and some are not, okay. That is a different issue, but what we are really thinking about is that there's this huge literature that argues using consumption-based asset pricing models, okay, that the risk-free yields are basically one-to-one, move one-to-one the expected discount, stochastic discount factor of investors. So if I want to understand how investors believe about how they should discount future changes, my best instrument is to look actually at the bonds, not at the stock. And it just to fix ideas a little bit of the discussion that I mentioned above, like here, it turns out, okay, and this is something that theoretically other papers can show, I have shown, you can show relatively easily, that whether you think the expected growth is going to be very, very high, or you think we're going to die, all of us are going to die, we both discount the future a lot more. Why? Because if the growth expectations are very high, it means that you have to pay me a lot to cut my consumption today and instead eat something tomorrow, because I know that tomorrow there is abundance, okay? And if I die tomorrow, then basically no matter what you pay me, I'm not willing to cut my consumption. So in both cases, I'm gonna discount future tomorrow, so both of them would raise interest rates. I would need a lot more compensation to save. While the impact on stock prices is a lot more ambiguous, I'm gonna show you in one slide, just like argue how it's gonna go. Okay, so what we're gonna do to again fix ideas is we're gonna look at changes in bond yields among around the major AI model releases. For the time period, it's going to be from release of ChatGPT 3.5 in November 2022, that like everybody started paying attention, to the end of 2025, okay, which is when we released the paper. So for all of this audience, let me first show you a plot, which is the raw data, okay? It's like we have not done anything with the data, okay? To tell you, so what is the question? When AI event is announced, what is AI event? It's a new model release. How do US Treasury bond yields respond, okay? So you might, I guess, when I asked Jeremy Powell, he told me, we don't move the bond rate. Why would it change? Well, we don't move the interest rate, so it should be flat, okay? A lot of people would argue, some other people would argue that, okay, when new AI models come out, they should they're good news about future growth expectations, so the rates should actually go up. And we haven't heard of, and so when we embark on this project, we thought we were going to either see nothing, which means we have to shut down the project, or we're going to see a movement of the rates up. It turns out, it turns out that no matter what treasury yield you look at, I mean, the long yield, the short yield, I'm going to tell you it's less clear, they're going to fall. And they're going to fall significantly. So as I said, this is raw data. I'm going to show you a lot better identified results. Okay, but let me tell you what this is. On the x-axis is day 0 is the day that the new model has been announced. Imagine like GPT-5, okay, Opus 3.5, okay. Then this is 30 days before, that is 30 days after, okay. Each plot is the mean change in yield, okay, across 3 days, 30 days, okay, of the, here this is treasury zero yields, because I don't want to think at all about coupon payments, okay. And as I said, we are averaging over the major AI, Gen AI new releases between ChatGPT 3.5 to the end of 2025. Each color is one maturity, okay? And and the Fed for the zeros, these are what we can like easily get from Fred, okay? So 1, 5, 10, 15, 20, and 30, okay? That's what I'm gonna show you all across the talk. I'm gonna focus on this, plus the tips. Tips have different maturities, okay? So for instance, just to give you an idea, look at the purple, which is 15-year treasury, 0, okay? This guy, okay? You can see that it has fallen 10 basis points, okay? Per announcement, okay? ChatGPT 4 comes out, Fed, the treasury 0 falls 15 basis points, 10 basis points. Are you crazy? Okay, this number is, in the sense that this number is huge, okay? And this is what data says. I have nothing to do with this, okay? This is like raw data, okay? The other thing that I want to point out, and we have nothing to say about it, is that you can see that there is an anticipation. So the fall starts before day 0. All we have is that we know that a lot of these models are not secret. So they've been discussed by people like on social media from like a week before, okay? But so that might be one of the reasons, okay, but I don't know. I just want to say that before 10 days, there's really parallel trends, then it falls by a lot, okay? Then right now, you can say, oh, there are like 500 million. This is like a time series event. Okay, 500 million other things have happened in the meantime. Who says this is the impact of the AI major release? Okay. Plus, I mean, these movements, who says these are significant? Okay. So the rest of the talk, my goal would be to convince you that these are two things, that these are the impacts of major AI releases. And the impact is that the bond yields fall. And my argument would be that they fall significantly, okay? One thing that I want to be clear about is that these are all, if you want, long yields, okay? What I'm going to show you, so I'm not talking about like the short maturities at all, okay? And in fact, when I take out all the other reasons, the 1 year would actually become almost insignificant, which is very consistent with what you would probably all expect, because the 1 year maturity yield is very directly controlled by the Fed, okay? All right. Whoop. Okay, so let me first, why doesn't this thing like me? Okay. No, so can we go one slide back. Okay. So can you go one slide? Okay. So as I said, I'm gonna focus on the newses, on the new model releases. So what I say a new model, it's a new flagship model. A lot of these labs, AI labs, have many different models like vision and stuff like that. I'm gonna only focus on the flagship models, okay? And I'm gonna focus on this date, as I said, November 2022 to December 2025. And my unit of account is dates, okay? Meaning there are some days, there's actually one day that 2 models are announced on the same day, that counts as 1, okay? So there are 3 model releases, okay? Then from which labs? There are many, many labs that work on AI models, and we have to use our, we have to basically use our judgment call, which models we use. So there is this website, LM Arena, okay, which ranks where different AI companies, how often they have been in the top 5%, how often in the top 10%, and what is their best rank, okay? You can see that there is whether I draw the line, there is a clear break, in the sense that the 4 AI labs that are above the line have been in the top 50% of the time, and they have at least in 1 week reached rank 1, while after this, the best one is like 4%, okay? So clearly, the first 4 organizations have been a lot more dominant in the quality or perception of the models that they release. And they are the companies that you would think about. There's OpenAI, there is like Anthropic, there is Google, and there is XAI. Then in the paper, we also do all of the stuff, including Meta and DeepSeek. Okay, it doesn't change anything. Can you go to the next slide? Okay, now the data is as plain vanilla as possible. Everybody can go download it because we wanted this to be really replicable. So for the financial market, we are gonna get the Fed zero lower bound treasuries. So we're gonna use 2 things. One is that we are gonna use the constant maturity zero coupon treasury yields, which are nominal returns. Therefore, maturities 1, 2, 5, 15, 20, and 30. This one, the zeros exist publicly, okay? Then the second is zero coupon tips, because we wanna, this was a time where there was a lot of inflation movements, so we wanna take care of that. For the tips, the maturities that are publicly available are 2, 5, 10, 15, and 20 years. So that's what we are gonna do. Then there's many other concerns, okay? Since we've presented this, like everybody has come up with their own idea of why this happens. So we have, and one big concern has been inflation, that is easy. Another big concern has been risk, okay? So to control, to alleviate the risk concerns, I'm gonna show you corporate bond indices and corporate bond spreads, trade weighted US dollar index. I think the most convincing to me is US sovereign CDS, and I'm also gonna show you volumes, trading volumes, okay. Next one, please. Okay, so now the core of the paper is the methodology that it uses, and it's a methodology that is not common in finance, but it's very common. It's common in econometrics, and that's why Isaiah Andrews has got the Clark Medal for theoretical econometrics, and that's why he's on this here, because I can swear on whatever he says it's true. Okay. And the whole point, we think the reason that this has not been done before is that the time is very short, okay? So the number of observations is extremely short, okay? So how can you make any statement about significance of something with so few observations is questionable. So let's start with a common event study methodology. So there is an event date, which is one of the 30 dates, okay? What are we interested in? We are interested in the change in bond yields between B days, B trading days, and it's trading days, B trading days before to S trading days after, okay? For most of what I'm gonna show you, I'm gonna make B and S, in the tables, B and S are gonna be equal, okay, but in the pictures, it's gonna be from minus 30 to plus 30. Then there are 30 days in about 2.5 years, okay? So a lot of these event windows, and there's 2 months around each of them, so they overlap, okay? To take care of the overlaps, we're gonna use, especially in 2025, we're gonna use regressions, okay? How are we gonna use it? So let's take delta YT is the change, daily yield change, okay, from tomorrow to today. Now, for each single day in these 2.5 years, I'm going to regress the yield change on a constant, okay, and on an indicator of its distance to any of the days that a release happened if it is within 30 days of it, okay? 30 days before or 30 days after, okay? Then, if I add all of these coefficients, okay, then my test statistic would be the aggregate impact of basically how much this particular event changed X days ahead, okay? Where the, H days ahead, I should say. And H starts from B days before to S days after, okay? And B and S at the maximum are minus 30 and 30, okay? So next slide, please. Okay, so now this is just a normal regression. You would say, okay, what are the standard errors? Those are useless in this way, model, because there are only 30 events, okay? So we need to do a small sample inference. So this is very interesting to me because this is like thinking about impact of big data using small sample techniques. So imagine, for the sake of it, that the beta hat, that the impact that I measured was not zero, okay? It's positive or negative. How can I say that this movement, that is different from zero just by chance, okay? Or for some other reason, like Fed announced something, or like the, I don't know, like the employment response, the employment numbers came out, so all of these things can move these aggregate responses change, okay? How can I say that this difference, this response, is not due to randomness or other reasons? And beyond that, how can I say that it's even significant, okay? I cannot use t-stats. I cannot use standard errors, okay? So we're gonna instead do 3 things, okay? The first thing, which is the simplest, and the pictures that I'm gonna show you are all based on that, are called permutation inference. The second one is a time shift inference, which is a permutation inference that does take time series correlation into account. And the third one, which I'm not going to talk about, what is in the paper, is called rank correlation across events. Okay, so I'm going to tell you about the first 2, and I'm going to show you almost all the pictures that I show you is going to be from the first one. In the tables, I'm going to show you both. Next slide. Okay, so what is the permutation inference? This is an extremely simple idea. So imagine there are 30 model releases, okay? So assume, for the sake of it, that the timing of model releases within each year is as good as random. Meaning in 2023, if Google announced its model in like April 5th, it's the same as December 21st, okay? And then assume that the bond yields do not respond to model releases. That's what the benchmark would be, okay? So then, if the timing of the model releases are as good as random, then the test statistic would have the same distribution, okay, among the actual dates of events than if the dates were chosen as random. Okay, so let me construct the permutation inference. What it does is that it constructs that distribution, nothing else. So how do we construct this? So let's fix a year. Okay, let's say 2023, 4, or 5. Then I'm going to count how many days are in that year. Let's say 10 days are in that year. Okay. Then I'm going to draw 10 random days, construct a statistic from them, and I'm going to repeat this 5,000 times. From the 5,000 statistics, I'm going to find the distribution of the statistic. Okay. Then I'm going to look at, and that's called placebo distribution, because I constructed it from choosing the days randomly, right? Now, I can look at where my actual test statistic lie in that distribution. If it lies very much in the tail, if it's below 2.5% or above 97.5%, then that means that it's significant at the 5% level. Because that means that there's a less than 5% probability that if you draw randomly from this distribution, you're going to see that. Okay. So this is, instead of t-stat, called p-stat. Okay. And what is important is intuitively in all the tables, when you look at them, unlike t-stat that we think should be big, okay, p-stat should be small. Closer to the 0 means it's more into the tail. Okay. So can I go next slide? Now, you would very reasonably argue that who says these events are random? If Anthropic releases a model, it's a lot more likely that XAI wants to release one right after, okay? Or want to basically front run it, okay? So that is a relatively strong assumption. There is a way to relax that assumption, okay? So the assumption in permutation inference is that there is no time series dependence of model releases. And that's the assumption that I want to relax. So the observation that I assume that there's no time series dependence allowed me to choose the days for the distribution at random, okay? Now, if I relax that, I cannot do it. So instead, what do? I take the year. Imagine there's a ruler on the days of the year, and some of the dates on the ruler are crossed out because those are the days that the models released, okay? So I'm going to fix those dates on the rulers, and I'm going to move the ruler, are they backs and are they forward, okay? So basically, the series date is the distance, the time series distance of the dates are fixed, the start changes, okay? So now this is going to be a valid test if the model releases are even time series correlated. There is going to be there's no free lunch, okay? To get that, what you need is that the yield series is time stationary. If the yield series is not time stationary, okay, then this is not going to work. The second thing is that actually there needs to be a quantile adjustment for significance, which makes this test very, very conservative. Okay, almost the p-value is going to double every p-value. Okay, so it's a lot harder to satisfy this test. Sorry. Okay, so one more. So now let's give you the context of what we are looking at. Okay, I'm looking at the risk-free coupon yield, right? So risk-free zero coupon bond pays at date t in horizon h pays 1 and only 1 because this is zero coupon at date t plus h. Okay, so the price of this instrument is the expected stochastic discount factor of whoever is the investor who prices this instrument, who's the marginal. So the yield, annual yield is minus 1 to 1 over h of 1 over the SDF. Okay, so this means that, and this is what's called discount factor effect, right? So when investors are less concerned about the future, for instance, they know that they're going to die, they cannot do anything, okay? Or they know that they're so rich that they don't care anymore, okay? That means that their stochastic discount factor is lower, okay? And so the yield has to be higher, okay? So this is exactly what we are looking at. So what we are seeing is that the yields, what I showed you is the yields are lower. So for some reason, the stochastic discount factor should be higher, okay? Next slide, please. So, okay, so this is exactly what I said. So let me contrast this here by equity and tell you why we are not using equities, okay? Because think about equity and imagine there's a first order stochastically dominant shift in the payoff of the equity in some day in the future, okay? There is going to be two effects. One is that there's going to be a discount rate effect, okay? Because tomorrow I know that I'm going to be richer, so I discount future more, so the bond has to go up. On the other hand, the bond is now a claim to more payoff, okay? So the cash flow effect pushes it up, okay? And they go the opposite effect. I don't know which one's stronger. The good thing about bonds is that because there's zero coupon, okay, and they pay 1 unit, there is no cash flow effect. So by focusing on, that's the reason that we use bonds instead of equities, because with bonds, you only have discount factor effect, okay? Thank you. Can you go to the next slide? Okay, so there's gonna be 500 of these, I mean, I don't have too much time, so, but there's gonna be 50 of these pictures. Let me just show you what they are. So each panel is one security, 1 year, 5-year Treasury 0, 10, 15, 20, and 30. The blue is always the test statistic, okay? From 30 days before to 30 days after. 0 is the date of the model release. Black line is the mean of the placebo distribution that I constructed. Do you remember? So if you draw 5,000 times 10 events and take the statistic, take the average of the bond change, and the mean of that distribution would be the black. And the dashed lines are the black is 10% p-value, 10% significant, then 5%, and then 1%, okay? What do you see? You see that the 0, when you correct for this, the 0 treasury yield, the very short yield, does not move. I mean, it does, so every yield falls, okay? The 0 treasury does not fall significantly. The long treasuries fall extremely significantly. You see that they're all significant at 5% level, okay? Some at 1. Can you go to the next slide? The same is true for tips, okay? Can you go next slide? So now I'm going to show you another one of these pictures, okay? So on the in the rows are the different maturities. The 2 blocks are 0 treasuries and tips, okay? So each block has the permutation test and the time shift test, okay? You can see that the permutation test in both treasuries and tips are, and single star is at 5%, as 10%, 2 stars at 10%, as 5% significant, 3 is at 1% significant. You can see that the permutation test in both treasuries and tips is generally significant. Unfortunately, the time shift becomes becomes a lot more significant, okay? So it loses a lot of its significance. And that's what we are gonna try to now, that's where we stopped. Now, and the rest is kind of new. Can you go next slide? Okay. So let me first distinguish 2 things quickly. As I said, there might be that investors think there's going to be this huge event happening tomorrow. We're going to be extra rich, or we're going to all die, or they might think that the future growth process will change. They both are going to move the yields in the same direction. So they seem indistinguishable. Can you go next? The fact is that they're not indistinguishable. Why? Because if we all die, we don't care about inflation, okay? But if we just think that growth rate is higher, we do care about inflation. So if you think about the change in the ratio of price of bond of treasuries versus a yield versus tips, that change should be 0 if we only care about the extreme event probability. Can you go next slide? It turns out that that ratio, the difference between that ratio is far away from 0. Okay, so this just shows you, can you go next slide, that investors do care about the growth process, okay? And then that takes us to the heart of it. So the question is, how does AI change future prosperity? How change investors' belief about future prosperity? The prices can only tell us about belief about the risk and consumption growth of the marginal agent, okay? Remember, if bond yields goes up, it's supposedly good news, meaning investors think marginal consumption growth has gone up or risk has gone down. Alternatively, if the bond yields go down, which is what we saw, investors either think risk has gone up or the marginal the consumption growth of the marginal investor has come down, okay? This does not tell us anything about whether model releases were good or bad about AI technological growth. Next slide, please. For that, we're going to look at an online prediction platform, which is called Metaculus, and we're going to look at this one question, okay? The question says, asks the people whether they think, or what is the date that they think artificial general intelligence will arrive, okay? Now, we look exactly as 15 days before, 15 days after, minus 15 days before of the release of the models, and see whether investors pushed back their beliefs, meaning before I thought it's going to arrive in 2027, now I think it's going to arrive in 2028, okay? That means the technological growth is going to be slower. Okay, if I brought it forward, it means I think the technological growth is going to be faster. So we're going to divide our 30 events into 2 groups. And now I'm going to show you the results based on the 2 groups, okay? There are 13 events where investors think AI news was bad for growth, okay? 17 that they thought it was good. You go next slide, and there I can actually end. Okay, so this is again treasury zeros. Each block, each panel is one particular maturity, okay? Now you can see that I used to have 6 panels, now I have 12. Because the top row is about when the news was technologically bad. The bottom row is when news was technologically good, okay? You can see that when news was technologically bad, the blue line, which is the actual test statistic, is very close to the mean of the placebo distribution, meaning bonds, when investors thought AI progress is going to be slower, it does not affect the bond rates. When investors thought the AI growth progress is going to be faster, then the bond yields fall significantly. And in fact, now they fall a lot more significantly than before. Can you go next and then again next? Okay, so this is the same table that I showed you before, except that now I'm only focusing on the bad technological news. You can see that on the bad technological news, regardless of what instrument I look at and what maturity, there is no change. Okay, nothing is significant. You go next slide. Now, but if I look at good technological news, when investors thought that AI is good news, now all the bond yields fall, and fall significantly even if I correct for the time dependence. So this is an extremely, extremely strong result. And you can do this for anything, and it's going to survive. But because I'm out of time, let me not show you. Can you go forward a couple? Quite a few. Go until the conclusion slide. More. Okay, great. One more. No, you went to go two back. Okay, so I want to finish by just saying that we talked about, okay, what I showed you was we have, when investors think that there is better AI, it looks like they don't think that AI will bring us prosperity across the board, okay? It might be either through inequality, okay? Or it might be through like a saving gluts or anything else. But in particular, this row shows you that when investors think that AI is good news, technologically, the bond yields drop very, very significantly. That's it. Thank you.
Thank you so much, Miriam. Again, thank you for being here despite all the travel excitement you had.
Thanks so much for accommodating my crazy schedule.
Of course, thank you. So we'll now make our way back upstairs to the auditorium on the 12th floor. So we'll see you there in a few minutes. Thank you, everyone. All right, hello everyone, welcome back. So now we'll jump into our next panel with Austin Campbell, adjunct professor at NYU's Stern School of Business and CEO and founder of Zero Knowledge Group, leading a panel on public blockchains, neutrality, and trade-offs. Thank you.
Testing. There we go. All right, now we're good. All right. One of the disadvantages of having students is that you kind of learn to give the disclaimers at the start for things so people understand where we're operating. So I'll throw a few things out for the group. One, if I've measured correctly, I think our understanding level of blockchains in this room is everywhere from I've probably heard of Bitcoin to, if Neha is still here, I have forgotten more about Bitcoin than any of you will ever know. So we're going to try to keep this relatively plain English for everybody and drill down on some of the main themes. But as a result, and I'm deputizing all of you in the audience in here, if we say something you really don't understand, raise your hand and yell at us. We will try to explain. Two, I think I'm very happy to have Robert and Kevin with me because we have people who are neither hysterics in terms of like hating things or hysterics in terms of loving things. So if we've done our job correctly, we're probably going to scare you and then make you optimistic and then scare you again and then make you optimistic again. So if we've done it properly, you'll end exactly where you started, except with way more knowledge about what is going on. So with that, Kevin, I'm going to start with you. And what I would like is first, can you give a little background on your experience in this space to inform us, warning you my next question is going to be, tell us what happened to Floating Point Group.
Oh boy. My name is Kevin March. My background by training is genetic engineering. So I'm coming at this whole world a little bit from the outside. Out of college, I founded a brokerage called Floating Point Group. And the goal was to help the fledgling hedge fund industry get into crypto. So this was the order execution tools, but it was a lot of like the wallet infrastructure and the sorts of tooling that you need to manage collateral as a hedge fund to trade across all these new venues. That business was founded in 2018. It ran its 5-year life cycle up until 2023. At peak, it was about 60 employees, 150 hedge fund customers, raised a few different rounds of financing. And these days, I'm out of the game, and I run a proprietary trading firm, and I'm no longer customer-facing in a brokerage seat.
And why is that?
Floating Point Group met its demise at the hands of a North Korean group called Lazarus Group. And the attack that they pulled off was a very sophisticated social engineering attack that across 6 months, they scouted and planned how to breach our infrastructure to steal a majority of our customer assets. The attack that they pulled off used our own infrastructure against us. There was nothing unique to crypto or to blockchain necessarily that enabled this attack. It was actually the opposite. They created an entity overseas that passed our due diligence. They stole identities. They used deep fakes to produce material that matched the identities that they stole. They had face-to-face video calls with our team members. They met our team members in person at conferences where they described this new hedge fund entity that they were setting up. They, throughout the onboarding process, they displayed information that qualified them to be a good customer of my business. Not fantastic, right? Like they knew where the limits are. They created a customer that made us excited to work with them for the future of where their business could go, but there were no red flags immediately that set off our alarm flags. They negotiated fees, right? They weren't willing to pay 2% per transaction. They needled us and they got a 10% discount on fees up front. They deposited clean funds. One of the huge benefits of crypto is that you can see where all of the assets that are coming to you come from, regardless of whether or not you have information from the sender, right? So if someone sends you Bitcoin, you can see exactly where that Bitcoin has been for the entire life cycle of that Bitcoin. And we have very sophisticated tooling from multiple vendors that we use to track all the assets. They sent us totally clean assets. They funded their account with about $10 million. With a bunch of different assets that they sent from various places. Through the 6 months, they traded daily. They integrated with our tech stack. They got to know our employees. They messaged our employees. They became friendly, but not too friendly. They never asked probing questions. And eventually, they had a very good understanding of what our organization structure was. Who was a manager, who was not a manager, who had administrative privileges, because they would make requests and find out who was the blocking factor in approving that request. And the second that person came online, they realized that was the person that had signing capabilities. Through this, they eventually befriended people where it didn't immediately set off red flags when they started directly messaging team members. That's when they struck. They sent a message to 18 of my team members asking them, I'm trying to integrate with your API. I want to start trading programmatically with you instead of manually. I know that would help both of our businesses and you guys would like that more. I can't authenticate with your API. There's something wrong. I can't figure it out. I know it's not your job, so I'll pay you $1,000. Do you mind just helping me get this code to work? And 16 of my employees said no, but 2 of my employees said yes. And they downloaded those scripts. They ran them on their work computers. That gave them a very clever backdoor access into our systems that was not picked up by endpoint security. And through that, they were able to sit inside all of our communications, all of our internal systems. They used that to spread their access where they breached many computers internally. And then they just used our own system against us with this beautifully automated system that had security checks, risk checks, multi-factor authentication. And when enough team members signed in and authenticated at once, they used the live session IDs that had been authenticated to trigger transactions to just withdraw all of our customer assets from the system to their own addresses. So this whole attack that they pulled off, like there was no breach of a smart contract, like there was no bug in the blockchain, like there's nothing unique about crypto that enabled this. The only thing that was unique was the capacities of this adversary and their creativity and their dedication to this 6-month attack that they eventually pulled off and breached our systems.
So part of what I find interesting about this story and why I asked Kevin to tell it is there's a couple of threads that now have started to transcend a couple of markets, crypto included. One is that the real vector that most people are breaching systems with is social engineering attacks. Like insider compromise is vastly more dangerous than most of the other things you're going to run into. Like I won't name names because some of them may be in the room, but all of the major US banks are currently having problems with this, severe problems. And it's created a threat space that is very different than what people are normally used to. The other part of this is you experience 24/7 markets with like RTP in any form are very vulnerable to this. If you look at like some of the security and related incidents, for instance, in Asian markets with actual 24/7 RTP and certain fraud like patterns, you see this.
They got us at 1 a.m. on a Saturday night.
Yeah, because they knew exactly when you would not be watching, right? Yes. And then the final thing that's very interesting to me about this is, ironically, in your specific case, we know exactly who did it because it was on a public blockchain, right? Like the great irony here is it adds some like salt to the wound, so condolences. But also at the same time, this is one of the few spaces where you can trace that stuff. Like I know a lot about this story because I am a special advisor to one of the intel companies working in this space and chasing people like the North Koreans and the Iranians and the pig butchering scammers around. There are sort of topographies to where things move and behavior in these attacks that is consistent. And so one of the things that I would raise to everybody here, and why I asked Kevin to be here is, you're going to read articles in the news. You're going to read reports by people who have not lived through it, talking about some of the risks of blockchain. And I will tell you, they often over-index on the ones that they're aware of and under-index on the ones that are actually happening. So the number one thing everybody should be thinking about as you approach this space is like hardening your systems, your internal controls, and figuring out how you would detect insider compromise. And that lesson will generalize outside of blockchain. That's going to be true for prediction markets. It's going to be true for 24/7 equities trading. It's going to be true for FedNow. I'll say that to the Federal Reserve people. Any 24/7 RTP push system, these sorts of things are a problem for. But I now want to come full circle after we've scared you. I'm going to fulfill the second part of my promise here. Kevin, you're still in this space after that happened. Like, why? What is interesting about it? What is making you still interested in working with blockchains?
I really thought about going to Facebook. I applied. I didn't get the job, and thank God.
Thank you, Mark.
When I dropped out of school to start building a business around cryptocurrency, it was based upon I had just read the Bitcoin white paper, and then I spent like the next 48 hours reading every piece, every publication, every research paper I could possibly find, and the idea that you can have an immutable asset that you don't have to trust anyone else to be a good person in order to have that asset is still a very powerful idea. And it's very powerful regardless of whether or not I built a business in the space and failed because someone took it from me. That promise is still true. From a capital markets perspective, for my current business, it enables a sort of efficiency that we couldn't have in any other space. We turn our capital over 30 times a day. And this includes, settling full life cycle of trades, moving between venues. The sort of efficiency that we can have on our balance sheet is unparalleled. We can never pull off this type of trading in any other asset class. Now, I'm not saying that crypto is useful because it enables trading. There are a great many things that crypto and blockchain are useful for, but specifically for my business, one, it allows us to have full control of our assets and of the life cycle of how our trades settle, without having to rely upon any other parties. We don't have to trust laws. Now, I would love law to be able to protect us, but it's the space that we're building in. When there's instantaneous settlement, it's irrevocable. The records are immutable. Inserting law helps, but law moves at 10 orders of magnitude slower than how fast the blockchain settles transactions. So from our perspective, it's the belief in the technology, and it's the way that the technology uniquely enables our business to run as a trading firm that brought us back.
All right, so speaking of assets on a blockchain, Robert, you have no small background with a number of these things, but I want to start that some regulators globally, even in the United States, have held the premise that actually partially because of some of the things Kevin has said, public blockchains are unsuitable for usage in institutional trading in like public markets. And you clearly don't believe that because that is the thing you were doing. So can you explain to us what Superstate currently does and how you do it? And then I'm going to hit you with a challenge, which is please tell everybody about all the securities you have ever lost control of or had misappropriated in this framework.
So I got my start by building one of the first, what's called a DeFi protocol on a blockchain. It was called Compound. It, enabled people to borrow and lend cryptocurrencies using, computer programs, otherwise known as smart contracts running on a blockchain. Widely successful. After that, I saw an opportunity to begin tokenizing securities. What does tokenizing a security mean? At a very high level, what it means is representing the ownership of a financial instrument as a piece of data on a blockchain. Why is this interesting? Why is this good? A blockchain in general is tamper-proof. The data on the blockchain, everybody can see in real time, and you can see the entire history of the data, and you can have very specific and programmable controls over that data. And so a blockchain, in a lot of ways, is a phenomenal place to record ownership in a way that there's fewer misunderstandings of the ownership, fewer disputes, and when done correctly, more programmability of the ownership. One of my formative experiences as a much younger man was in the 2007 to 2009 great financial crisis working at a bank when nobody knew what each other held. One of the roots of it was like you could be talking to someone on the phone and you weren't even sure, what their positions were, right? And it led to a negative feedback loop that most people here, that were around then probably appreciate. So Superstate tokenizes securities. We do this by, working as a transfer agent and partnering with a security issuer. That could be an asset manager creating a fund. It could be a public company issuing equity. But we basically step in as the official legal representation of that security. And instead of using a database, instead of using a spreadsheet, instead of using a stack of paper in a filing cabinet, we use a token on a blockchain, which is just tamper-proof data. And, unlike, floating point group, we've done this in a very straightforward way, and we have a absolutely, flawless operational track record of being able to control securities and being able to monitor securities and being able to, because of the computer program environment that exists on a blockchain, control compliance and control access in a way that is actually quite difficult to do with traditional, we'll call it like Web 2 architectures. And so, I come from the opposite view, which is a blockchain can be an exceptional control environment for an asset. It's difficult because in a lot of ways, all of the software that's comprising this environment is open source. It's public. It's available to inspect. One of the biggest advantages right now that most institutions have against sophisticated adversaries is everything is closed source. It's very hard, unless you're compromising someone's, code repositories, to know exactly how something works. A blockchain is the inverse of that. Everything is public. And so it requires significantly more upfront investment in security. It requires the expectation that you're operating in a more transparent environment, but there's advantages to that as well. So, I think a public blockchain can be an exceptional environment for assets to move.
So let me ask a question to then sharpen some of the differences between the two things you're saying. So if the North Koreans compromise somebody's system where they're holding Bitcoin, it's very easy for the North Koreans to just send themselves the Bitcoin, correct? But for instance, Superstate tokenizes the stock of Galaxy Digital. The ticker is GLXY, if anybody wants to look that up. So let me ask you the question. If the North Koreans were to compromise a participant, right, or somebody holding the GLXY token, Could they run off with it? What happens? Like, that's just gone, right?
So, in our approach to the tokenization of securities, everything operates within what we refer to as an allow list, right? And so what is an allow list? It's an additional compliance layer over an asset. So when you think of most assets on a blockchain, like Bitcoin or the token Ether or, an ERC20 token on the Ethereum blockchain or an SPL token on the Solana blockchain, all of these assets are simply, objects in a larger computer program. And for the most part, most of the assets that have been issued on blockchains are freely transferable and permissionless and anonymous. And that makes them wonderful assets to be able to steal because of a number of things. There's no reversibility. If you send Bitcoin to an address, you can't ask for it back politely. I mean, you could try, but, good luck. And there's, a level of anonymity to it. And there's no controls on whether the transactions succeed or fail. It's just one way and it's push. Anyone sends assets and that's it. Versus, because a blockchain is just a programming environment and you can write new approaches and new programs and new, approaches to compliance and new anything, you don't have to follow those frameworks, right? And so the securities that we tokenize operate within an allow list. And it's basically a compliance perimeter that says, is the sender known? Is the recipient known? Is this, an anticipated transaction? And there are additional safeguards put into it. There's middle grounds like certain stablecoins. Certain stablecoins have the ability to blacklist an address or freeze an address or, destroy the tokens in an address or mint new tokens into an address. You have assets that sort of sit in the middle between like totally permissionless and totally permissioned. But with securities, we operate in a totally permissioned sense. And so even if, Lazarus/North Korea compromised a participant's wallets and their private keys and their ability to initiate a transaction on behalf of a participant, it still is very hard to exfiltrate the funds because all they can do is send it to another KYC'd, permissioned, member of the compliance perimeter. And so is it impossible? No. The level of sophistication of, state level actors is increasing continuously. Their ability to act, always improves. But is it exponentially more difficult than what most people here think of when it comes to crypto and transaction security? Yes, it's exponentially more difficult.
So I'll actually pose one to you, and then I'm curious about Kevin's opinion on this before giving mine. Would you say with something like superstates, allow list, freeze, seize, so basically if your wallet's not already registered, not on the list, and somebody tries to send a token, it just fails. Do you think that's harder or easier to compromise than, call it, a current banks system in the United States?
Both. And I'll say both because, banks deal with compromises pretty frequently, right?
We did.
The thing in their favor is that, everything is reversible. All the data is mutable, right? You can change any 0 to any 1, right? That's how you fix any problem at the end of the day. Like, oops, like, wrong number, fix the wrong number, right? There's a lot of remediations for issues when there's a compromise, when there's a failure, when there's a problem. And like, the thing about crypto is that like, there's less remediation. You can't undo transactions. And so in terms of like compromising the system, just statistically it's harder, simply because there's, the code that a lot of the system that we're operating is on a blockchain and the code itself is immutable, right? And so like, it's more tamper-proof, like the actual software that runs the system, right? Within it, there's, a little bit more difficulty to remediate if there were an issue. Because on a blockchain, if you think of like the Ethereum blockchain as a ledger that's like append only over time, you can't really like reformat what happened in history. And so, remediation would be slightly more difficult, not impossible by any stretch, but more difficult. And so is it a better system? In some ways, in many ways. Is it a more novel approach to administering assets and securities? Yes. And so, I don't want to just throw traditional banks under the bus. They have a lot of problems, right? But at least they're widely understood, right? From an IT perspective, from a regulatory perspective, they're widely understood. And even though I think, a blockchain-based system of asset administration can be significantly more secure and superior, I think there's a, significant reduction in familiarity with it from an operating standpoint and a regulatory standpoint. And so I think the end state there is far superior. I think today it's probably starting off at an earlier stage of the learning curve.
America has this pattern of building really powerful things and then figuring out how to use them and make them safe. Examples of which are in the 60s when Ford hired Carroll Shelby to win the Le Mans. You didn't build your brakes first, you build the engine. You build the largest rocket possible to get to the moon, and then you figure out how to, how many nines of safety you can get. You build the AI system that can do anything, that can do math, that can solve novel coding problems, and then you figure out how to align it. And the same thing has happened for blockchain. Blockchain is a very powerful system. But what it has done with the capabilities is it has increased the onus to design for safety upfront. Robert said this very well, which is the bar to roll out blockchain-based products built on these type of capabilities means that there's a lot less room for error when remediation is limited in the way that it is. So there are pros and cons. The ceiling for the system is higher. The path to get there is harder, but it's worth it.
So I'm going to tell a little bit of a story now of doing the reverse of what happened to Kevin to show some of the unexpected properties that these things have as you get familiar with them. So one of the things that I think most people in this room are probably aware of is there's a decent amount of money laundering and illicit finance that happens in the world across a number of systems. Blockchains are certainly not immune to them. In a weird way, blockchains, however, are more of a problem for the criminals in the long run because although Robert said blockchains are anonymous, I'm going to be very specific about this. They're anonymous at the start. However, as data leaks out over time, to go back to Kevin's failed attempt to get to Meta, if you're familiar with the social graph, thinking around network identification, actually blockchains mostly get revealed. And let me tell you, and all of you are going to laugh at this, the main source of identification is, like all other things, people saying dumb things on the internet. So what you find is over time, people start saying things like, hey, I'm locked out of my Binance account, or hey, this guy scammed me, or hey, can you send me the money here? And sometimes they're saying them on Twitter, on Reddit, GitHub repos. You can find data on the dark web, Telegram, WeChat, Signal. Right? And as you establish more and more data, especially with the advent of AI models, which are very good at taxonomizing all of this data, you start finding some very unexpected connections. So one of the things that's been interesting for me to learn over the last few years is that criminals are incredibly lazy in a lot of areas, right? And what was found by a group of open source intelligence people working with the US government was that the exact same exchanges and tools being used to launder money for a group of, we'll call it evildoers, referred to as the pig butchering scammers, largely based out of Cambodia, were being used by the Iranians to launder money. The exact same tools, same exchanges, same tools, sometimes the same addresses on a blockchain. And public blockchains are public. So let me tell everybody, if you do a transaction on a public blockchain right now, assume that 10 years forward, some jerk at one of the companies I'm advising will know exactly what you did and with whom, okay? And so there was approximately $344 million of USDT that was found to be in the possession of OFAC-sanctioned people affiliated with the Iranian regime in a pair of wallets in Tether on the Tron blockchain. And all of you have heard stories about like Tether is this bad actor, they don't have any controls, et cetera. Well, the great irony is actually Tether has a lot of controls. And the United States has a lot of control over Tether, because I'm going to give everybody in this room 3 guesses as to where custody of their US treasuries happens. In the United States, that's right. So you find people are very responsive when, if you can walk down the street and say to their custodian, hey, give me all their stuff, that's the lever. So there's a case in the Southern District of New York, for which any of you could find the documents online, where somebody explained this whole taxonomy and said, here's where the money is, here are the legal owners, here's how we can prove it, here is all the data. We've combined blockchain data with social media data, with traditional financial data, with legal registry data. These are very clearly the funds of these sanctioned people for whom there are judgments against. There's now $344 million of money frozen by Tether that will likely be returned, in this case, through a court case by Wilkie against the Iranian regime about human rights violations. So the interesting part to me of these situations is that confiscation that Kevin suffered at the hands of the North Koreans appears to now be a two-way street. And the reason I bring this up is exactly what Robert's point was and what he led into, which is as we march forward through time, there are novel capabilities that we're going to discover with these systems that also exist because of other technological advances where we can see far more. And to bring this back full circle, part of why I got involved in this space and was so interested in that was I remember seeing when I'm not going to name the bank, but when I was at a bank and was involved in sort of unpacking some of our reputational and operational risk, a transaction chain that was an American sent money to a relative overseas who spent it at an overseas business, which then paid a dividend to the owner, and the owner sent money to a terrorist organization. And the question was, if you were at the bank at the start of that chain, how do you stop that? Right, I see a lot of people looking very confused in the audience, and that was also my reaction, because the answer is you don't. Right, but once you have visibility across that entire chain, even if it's pseudonyms at some of those points, you can see where the money went and how the money got there. So Kevin, I'm going to bring this all the way back around to your original point about trading and provenance and like cleanliness of funds to ask you the question this way. If when the floating point hack happened, instead of the assets that you were using on a blockchain primarily being truly permissionless, like ETH and Bitcoin, and it was all US dollar stable coins or like securities tokenized by Superstate, would you guys have been able to get that back?
Actually, only the stable coins that were stolen, we got back. We had Bitcoin stolen and we never got that back. We had Ethereum stolen, we never got that back. We had we had a very long list of assets get stolen. But the Tether that we had stolen was seized immediately by Tether. And that, like, I feel like that's probably the best possible example of that. Like, because of that, like the business was able to wind down successfully rather than being insolvent, which, sucks, but it's still I'd much rather wind down a business gracefully rather than go through bankruptcy. But that was the difference.
So I guess as we come to the close here, since we're going to get yelled at and thrown off the stage, they warned us beforehand. I think the interesting part about this neutrality of blockchains and the permissionless nature, but then the things you can build on them, is that your security may be worse and it may be better, and that at the exact same time, a lot of the core threats are going to come from a combination of technologies that precedes the ledger that you choose to use. And I think, Robert, I'll give you the final word on this one to close us out. But I think your view, working at Superstate, is essentially you have to do it very carefully, but you'd think it's possible to build a better system?
Oh, very possible, yes.
All right. So with that, this is why I let Robert finish. I knew he wouldn't go over. So with that, thank you, everybody.
Thanks. Thank you so much, Austin, Kevin, and Robert, for the great discussion. So now we'll turn it over to Scott Gady, Director, Data Governance here at the Federal Reserve Bank of New York, for a panel discussion on quantum safety and potential.
Hello. I thank the organizers for this prime spot. Second to last session of a 2-day conference on a Friday afternoon before a long and holiday week coming up. So I think they did this on purpose. Is this working, or am I just talking loud? I think they did this on purpose because amongst all these really interesting subjects we covered the past couple of days, I feel, and I'm guessing my panel might feel the same, that this might be the most interesting and perhaps least understood. And if it's not on your radar yet, I think it may be time, this may be the moment to take a look and start tracking what's going on with quantum. I'd say, over the conference past couple days, I've been sitting here and I missed a little portion of it. I counted AI being mentioned 67 times. Quantum was mentioned once. So maybe we can turn that around a little bit. But this is the right group of people to get us to that next place of understanding for quantum. These are leaders in the industry making all the changes. I'm going to introduce them real quick and let them give a minute to talk about themselves. So Will Zhang, Javed Shabani, Scott Crowder, and Katie Pizzolota. So I made a mistake in their pronunciation, so they're being kind. So Will, you may just want to spend a minute talk about yourself and what you're doing with quantum.
Sure, great. Hi, everybody. My name is Will Zhang. I'm a partner at Quantination. So my own personal background's been in quantum computing. I'm a quantum computer scientist. I've worked on hardware, worked at some startups building stuff, and now I'm on the venture capital side. And so Quantination's an early stage firm. We're on our second fund now. We manage about $400 million, and we invest in physics and compute tech. We're very active in quantum technologies. I think we're the most active globally when it comes to the early stage. Looking forward to talking with everybody here.
Hello, everyone. My name is Javad Shabani. I'm a professor and director of Quantum Institute at New York University, right here in downtown. I've been academic throughout my life, working on quantum when it was simpler, and then now it's getting complicated. And at NYU, we are trying to kind of create a holistic kind of hardware, software, algorithm, complexity type operation from the academic point of view. I've written a book about sort of how to get started on quantum computing, and also founded a new company on quantum computing materials. So very excited to be here.
Good afternoon. My name is Scott Crowder. I have the privilege of helping start the commercial quantum program at IBM. My role now is to basically get people to use the quantum products and services that Katie built.
Hi, I'm Katie Pizzolato. I've had the privilege of working alongside Scott for the last decade, building the commercial quantum program at IBM. As Scott mentioned, my team builds anything outside of the hardware that anyone uses. Our software stacks, the capabilities that we bring, we work with partners, industry, all toward really advancing the technology through use and algorithms and applications, and all the reasons why quantum is such a good buzzword and such an exciting technology. We're trying to bring that to life.
Thank you. So first question I think you need to answer is what is quantum computing? When I talk to people about it, I've been active in this space and active from the outside, following quantum for the past about 7 years. And the first thing I ask people, they say, well, I've heard of quantum computing. What is it? And most people say it's just a really powerful computer. So I want to dispel that a little bit with this group. So maybe, Scott, you could kick us off. What is a quantum computer? How is it different in classical computers and maybe even AI?
Sure. So, fundamentally, what we're trying to do by creating quantum computers is bring a new computational tool to the world that's based on quantum mechanical characteristics of the computation. So it uses something called quantum information science. It adds a couple different kinds of instructions than you can run on classical computers that do binary arithmetic today. And I think the key thing to think about is that fundamentally what that lets you do is do different algorithmic approaches that don't work on binary arithmetic-based classical systems. And the easiest thing to think about, which is one of the downsides of quantum computing in the long run, is that there are a lot of things that binary arithmetic is not good at computing. And that's a good thing, because if you think about it, computers were good at computing anything, you'd have no crypto standards. So cryptology is based on something that is easy for a human or a computer to do in one direction and really, really, really hard in the other direction. And we know that factoring, one of those problems that's used for cryptology, is one of those problems where this new quantum information science, people have developed an algorithm, Peter Shor's developed an algorithm that allows you to use these extra kind of instructions you can do with quantum information science to come up with a new algorithm that allows you to do that problem more efficiently. Good news is that there are other kinds of algorithms that people have developed that are good from a societal point of view and from a business point of view. But that's the way to think about it. Think about it as a new form of computation that runs algorithms you cannot run on a regular computer.
Yeah, Scott's nailed it. It's not just better computing, it's different computing. And so there are things that we can do with quantum computers that would never be practical, no matter how long NVIDIA keeps improving their GPUs. And then there are some things quantum computers are not really going to be that much better at. So think of it as different.
So what is the infrastructure requirement for a quantum computer? I mean, there's so much talk and concern about the environmental and ecological impact of AI data centers. How do quantum computers compare?
Yeah, so a normal, we think about the big GPU data centers of today, they can go from hundreds of megawatts into the gigawatt type space. The largest computer we have on our roadmap, which is predicted to do a lot of the exciting things that we hear, finance, machine learning, materials, all those kinds of things, it's in the 5 to 6 megawatt range. So it's actually a fairly efficient type of computation. Early days, that was a big reason to get quantum into computation, is because it is efficient type of computer. So, there's lots of debate on how it is always going to be a partner with classical compute. Classical compute is not going away. Like we said here, it's always going to be a co-partner. So there will be a classical compute infrastructure. There will likely be GPUs in this space as well. So it's not like we're going to go from hundreds of megawatts and gigawatts to 0 or to 5 or 6, but we do believe that it will significantly reduce the footprint in the data center.
So I know the financial markets and banking is putting a lot of investment into the possibility of quantum computing. Yavid, can you tell us some of the possibilities, what they're leaning in on, what types of applications where they can make a significant difference?
Sure. I mean, I guess what we can sort of think about quantum computing is an offensive mode and a defensive mode. And on the offensive mode, I guess as Scott mentioned, that you can have the Shor algorithm, and a very big quantum computer can actually hack the regular communication. On the defensive mode, I guess you kind of have to protect the financial assets and other things. So when there is the powerful quantum computer, you can actually protect yourself with these sort of post-quantum approaches and all that. The hardware is developing very fast. If you just look at it, the last decade, it has come such a long way. And we're kind of also transitioning from this near-term hardware to fault-tolerant hardware that would really be a big deal in a few years. On the financial side, for sure, right now, if you look at the roadmap of United States, January 2027, which is almost 6 months away, you're not allowed to have procurement type things that don't have post-quantum solutions to actually be sold into the Department of Defense and War. So that definitely has the finance aspect and the security aspects of it coming up.
Yeah, to that point as well, and maybe we'll dig into this a little further down, but there was just an executive order signed just on Monday where the White House say, well, I think the U.S. needs to spend more resources and time on the abilities for quantum computing and also defensive capabilities as well. So are there any killer apps on the horizon for finance? Would this be in the trading possibly or risk management? What are the banks leaning in on?
So two major areas to start. One is around use of these quantum algorithms for higher order binary optimization and some graph sampling kind of optimization problems. Other area that people are looking at, which is a little bit more controversial because it's harder to prove on a blackboard that there's underlying data that has the right structure, but people are also looking at feature selection for machine learning for a bunch of different applications, including some of the work the HSBC did in feature selection that they could then put into their online system for predicting whether something's going to trade at a certain price or not, and provide better analytics and insights to their trading floor. Is there a killer app yet? I don't think so. I think we're at the stages right now where people are really trying to see how to leverage this math for their technology, but in the portfolio optimization area to better understand not just the return on a particular portfolio, but get a better understanding of the Pareto of risk versus return kind of landscape. They're interested in understanding whether these quantum sampling methods can give them better insight into a significantly different risk profile at very close to the same return kind of answers.
Yeah, and it's good, please.
Sorry, just to add to what Scott said is that risk modeling is something that you want to make a model around things, and then when you add variables, the system gets complicated with dimensionality of the problem, right? So in quantum, one of the things that I guess was mentioned at the beginning, the way the hardware is, you have kind of a superposition of all these states, so it doesn't get as hard as it gets when you have the classical version of this versus quantum. So all sort of modeling around risk and high dimensional stuff would be a great place for optimization.
I was just saying, I think what's really interesting to me about finance is that we, a lot of the things that you think quantum computers are going to be good for, just because of that kind of transition or translation to quantum mechanics. Finance in the beginning didn't jump out from that perspective, but finance has a lot of problems that grow very fast based on the number of inputs. So it lends itself to this type of computation to think about these algorithms and how to map the problems to a quantum computer. And I think the finance industry is very far ahead as an industry. I think a lot of banks have invested. There's a ton of results out there and things that they're finding. And the kind of transition, I think, from, like Scott was saying, the pen and paper, we've proven from a theoretical standpoint, the transition from that to just empirical and heuristic, I tried this thing, it was better, is starting to really ramp up. So I think as a sector, it's farther ahead than some of the other sectors because of the investment and because of the excitement around the limitations of today's current problems in finance, as awesome as classical computers have been and do fun, phenomenal things every day.
Yeah, I think you're totally right. We're in this phase where we've had theory results that speed up meaningful algorithms. Like you can speed up generic Monte Carlo. It's not a huge speed up, but it's real. There's optimization, linear and nonlinear ones that you can speed up. There's differential equation ones. There's inverting big matrices. All of these things have pen and paper theory results that range between 1 and 15 or 20 years old. And now quantum computers are coming online in a way that we can actually try those. And that's mostly a very good thing because it's a lot harder to prove how a hypothetical computer is going to work than to run it and see how it actually works. And so that's this sort of new phase of more practical development that's starting to happen now and is going to happen over the next 5 years. And in finance, it's going to be looking at all the places that have been mentioned, in risk and simulations, in optimization, in ML. ML is the one where it's the biggest wild card because it's the hardest to do on the blackboard. As Scott was saying, we really need the machines first. But I'm pretty optimistic that as the machines come on, we'll get practical heuristics tested for the first time. There's one more thing I want to add, which is kind of like the one other thing that I don't think people think about enough in finance, which is that quantum computing is actually part of a suite of quantum technologies that are becoming available. And the big categories that we often talk about are quantum computers, but also quantum sensors and quantum networks. And in finance, the quantum network angle, I think, it's still early, but could in and of itself have a lot of value. And so what's a quantum network? It's kind of analogous to a quantum computer. A quantum network is a network which allows parties to communicate, but in a way that's different than you can with normal networks. And so there are some proven advantages there too. There are these things called super dense codings, where with 1 bit you can send 2 bits. There are encryption schemes called quantum key distribution or quantum cryptography, where you can prove that if an eavesdropper is looking at your system, then you'll see it, not because of the difficulty of a computational problem, but because of the physics. You can cryptographically assert where you are longitude and latitude which is not something that there's any classical way to do. So these networks are pretty interesting. And you might ask yourself, if you're someone who deals with exchanges and counterparties, if I have a network that allows me to physically enforce fancy types of correlations, like maybe that's useful. And that's a kind of basic and applied research field right now, but something that, like, over the next 5, 10 years, I think could be pretty interesting for finance.
Yeah, I'm glad you brought that up, because also the executive order had a lot of language in around some of the other quantum technologies, sensing and networking as well. I think that's they feel that's a big step for the safety and soundness of the nation. So let's talk about, you mentioned ML. Quantum computing and AI are both upcoming technologies, transformative technologies. How do we see them working together? See quantum to accelerate AI, AI to work on quantum, or might something completely different emerge?
Yeah, I think it's unfortunately all of the above. So it's a long
It's a good
answer.
thing.
Yeah, I mean, I think the first thing is like, quantum computer is the equivalent of kind of like GPU in this sentence. AI is really an application, not a computer. So there will be, like, quantum computers will enable quantum applications, and there may be blurring, like we blur the lines between AI and these mega data centers that people are building to run them. We definitely use AI within our quantum computers. Like every single job that you run on our quantum computer gets transpiled through AI to like map what you send to us to actually what gets run on the hardware. So there's a lot of examples of us using AI to make quantum computing better. Like a lot of examples where you can argue that quantum computing, the kind of math that it does, like theoretically could help make AI more accurate, like from a model answer point of view. Like some of the similar higher order binary optimization type math could be used to like understand all the different potential answers that come out of a large language model query and trying to make the answer a little bit more accurate and consistent and blah, 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 blah. And a lot of other hand-wavy things I can do there. And the last thing is AI, just like other things, is completely transforming how we get people to get comfortable using quantum computers. Like, 10 years ago, we put a lot of money into in-person hackathons. Then COVID hit. We put a lot of money into digital education. Then, AI hit. And now, like, teaching people how to code line by line in Qiskit is less important than making sure, and this is a lot what Katie's team does, making sure that the documentation is up there. So ChatGPT or Claude or whatever the hell AI tool that you want to use, you just type in like write me an optimization problem for this finance problem. I want to run it on using a quantum algorithm, and you get a program you can run on a computer in less than 10 minutes. Like it's changed the way that people learn how to interact with the compute technology.
And I wouldn't underestimate that. Scott's got a really great point here, and IBM's got the most reliable cloud platform up, so they've seen a lot of users use this. But quantum is a new computing technology. If you need to integrate it into a lot of old workflows, even if it's better, that's hard. But with AI, it becomes a lot easier. And so across the spectrum of the sort of stuff we invest in, but in particular for very different kinds of things like quantum, where the programming languages are weird, we're excited that AI is going to make it easier for folks to adopt the new tech.
I actually want to echo what was just said. It's actually amazing, like even from the research lab or even the companies, like the way AI is kind of like coming as Claude and other services that we use is making everything go faster, from material science development, from device fabrication, from precisions that you need for quantum, because quantum in so many ways is a game of perfection. You want everything to be the right thing, right? From the material, no defect, from the algorithm, the best compilation, all of that. And that is just accelerating right now. And then maybe that's why the government and the DOE have all these missions. There is also a specific AI and quantum that kind of goes to the machine learning and others and how to train weights and all that. And that also, I'm really waiting to sort of see surprises there.
There's also this is not so relevant for finance, but you should know about it because it's kind of the answer that I would give in Silicon Valley about how AI is going to use quantum computers. And a lot of the frontier models that the frontier labs, Google, OpenAI, Anthropic are building, they're excited about using them to understand the world. They're excited about using them to do new science and discover new things. And well, it turns out that some of the important parts of the world, like materials for semiconductors or catalysts for industrial processes have quantum physics in them. And so if you want your AI system to understand the quantum mechanical world, one option is to take a bunch of lab data, and we all know how hard that is and how slow that is. But wouldn't it be great if you had a universal, programmable quantum system that you could query over the cloud to generate data to teach your AI how the quantum world works? And that's what quantum computers are.
I was just going to use this opportunity just to say that I think, we kind of said, what is quantum? And, a lot of people might not be familiar, but back to this AI piece, I think a lot of people think their barrier to entry to getting on a quantum computer or to getting, it's much lower than anyone thinks. You could all do it on your phone right now, on your laptop right now. We obviously at IBM and a lot of people have made this a very easy technology to get used to and to start to try out and to start to learn from. And so I know we still kind of talk about quantum as a to-be statement. We're doing a lot of great things, but I think it still kind of feels big and maybe like spooky to people. And I would encourage everyone in your teams, yourselves, it's much closer than you think to be able to access it, especially with AI.
Yeah, speaking of synergies, we covered a number of other related or unrelated technologies in this conference, tokenization, digital assets, blockchain. Are there any other synergies for quantum with those other technologies?
I don't know about synergies, but this post-quantum thing is a real threat, right? So, and there are lots of companies out there now trying to basically put something on their servers that is basically going to protect this, right? So those would directly come to sort of these stories of hacking and if there is a quantum computer or whatnot, or I guess you may want to talk about this harvest.
Well, you opened up the next
Okay,
subject.
if you're going to that route, I think the really good question, actually, Will brought it up too, is that do you want to kind of transition everything to quantum? Do you want to go with a classical solution? Do you want to slow the internet now and then do other things? And then it also needs some sort of agreement from all the parties, whether it is finance or not, and sort of like developing that. But people are seriously thinking about this, really big players across the globe, and then it would really kind of feed back directly to Bitcoin and digital assets.
Yeah, so for blockchain, there's one synergy is like an anti-synergy, right? So just say it out loud, like a big enough quantum computer can steal your Bitcoin, lots of it, not all of it, but anything with a public key exposed, and anyway, some details. And basically every blockchain today is vulnerable, so your banks. So we invest in a lot of quantum computing companies, and that's not an outcome that we really want, even though we want the quantum computers to work. So luckily, we also get to invest on the other side. And so people are deploying different kinds of technologies to do quantum resistance, like Javad said. We've got a great portfolio company that's got a bunch of people here in New York called Project 11, and they've been real thought leaders in the crypto space. They've got a great blog and series of things. They got great white papers. If you want to read about the details of how quantum can threaten blockchains, I'd recommend Project 11's blog and stuff there. I will just say one other thing that's a positive, though it's again in that same thing of like quantum networks are weird. There are some early stage ideas about how to use quantum network and quantum computing technologies for the kinds of things that blockchains care about. And I'll give you two examples. There's this special thing about quantum information, which is that it's unclonable. You can't copy it. And that's great if you want to make quantum money, like little certificates that like no one, the laws of physics say that you couldn't universally copy it. And that's an old idea. But you can also bootstrap that into these things called one-time programs. So if I want to make a program that I can guarantee that a server only runs once and then it's destroyed, because of the usual quantum thing of when you look at it, it is destroyed, you can do that. Now you need quantum computers and quantum networks to do it that we don't have, but it's a long-term, exciting direction.
Thanks. So let's dive into it. If you weren't eyes weren't open till now, I think this is the point where if we really should pay attention. We're going to talk about some of the risks of quantum computing, and maybe you could explain what the risks are. We've got this. I don't know if people may be familiar with the term Q days, become somewhat popular lately. Is largely means around a time where quantum computers get powerful enough to make current encryption standards obsolete, which threatens blockchain and a number of other encryption, a lot of our digital signatures, and a lot of our secrets. So the question to the panel, real quickly, what about why quantum computers? Why are quantum computers so powerful, in what way are they able to put this in jeopardy?
Okay, so I mentioned this factoring thing before, Peter Shor, 1994 algorithm, et cetera, et cetera. People have come up with improvements to his algorithm to make it more efficient, but fundamentally it's an approach that allows you to much more computationally efficiently solve cryptographically relevant problems for asymmetric cryptography. So what is asymmetric cryptography? Asymmetric cryptography is if I want both of us to have the same key to unlock data, I need to encapsulate it with something so I can send it securely to you. So key encapsulation is one, that's asymmetric. Second one, oversimplifying this a little bit, but digital signatures. So any of the digital signatures that you do. The bad news is that those two things are toast when we get to large enough quantum systems. What do we mean by large enough quantum systems? That's a lot of uncertainty there because people can always improve algorithmic approaches, heuristics, blah, 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 blah. But best known current implementations is a quantum computer with thousands of qubits you can program that's capable of running billions of operations and give a good quality result. When you get there, then basically today's asymmetric cryptography or yesterday's asymmetric cryptography is toast. So the good news is that people have come up with math that both classical computers and quantum computers simultaneously suck at, and we can use that as the next crypto standards. NIST has basically standardized them. The standards exist. And then again, to the bad news, but you just need to go change all the stuff that you currently have, which is first, find it. Second, make sure that it's still supported as a technology platform by your vendor, which is actually usually the hardest problem for all of this stuff. And that all your vendors are going to go change it and support it. And then I need a code that you wrote that you went and find it and change it.
So largely, most of the encryption that are used around the world is based upon the premise that these are made of really difficult math problems that up until now, classical computers couldn't solve in any reasonable amount of time, although quantum computers are really good at specifically that type of calculation.
Correct. I mean, the good news for society is there are other things that quantum computers are even better at that will come first. The bad news is that you want to get ready for this way before we get to cryptographically relevant quantum computers because Q-Day is going to happen and nobody's going to announce it.
So when Q-Day happens, do you look at this, there's some reminiscent of other kind of threats, like Y2K, which was very specific. We knew when it was happening, knew what the problem was. But how will Q-Day present? Will it be like a one-time event, or something that can quietly cascade over time?
If I was a bad actor and I had a cryptographically relevant quantum computer, I would not tell you.
I agree with this one. But maybe I can put some numbers on what this guy was saying. 15 years ago, maybe 20 years ago, if you would take up a textbook and you look at it, you needed 10 billion qubits, and there was no quantum computer almost. If you kind of look at how with year we kind of improved, the requirement to kind of get to actually break Shor algorithm has come down quite a bit. Right now we are at 10,000, 100,000, and the number of the qubits that we can put now on a processor is also approaching 1,000, if not more. So if you just very blindly just do 2 lines and then see where they cross, that number will, on the x-axis, would fall around 2030. Whether it would happen or not, I guess as Scott said, there's lots of assumptions there, but it's not infinite anymore, that ratio. It's really coming to converge.
I mean, the roadmaps are suggesting an early 2030, pre-2035 timeframe, 2031, 33, which is not far away if you think about how much data we have out there. And like Scott said, find it, figure it out, protect it.
Yeah, so on our roadmap, if you just draw a straight line of when we're going to have a commercial system that based on what we know of Shor's algorithm today, that intercept point would be 2035. But that's our commercially available system. We are not saying wait till 2035 to be ready because a nation state level bad actor could throw a infinite amount of money at something earlier than that. Yeah.
And so you might ask why there are these big error bars. Why can't we just give a date? And part of the reason is, IBM sort of has a date, but there's a bunch of ways of trying to build quantum computers. And some of them might hit faster, some of them might take longer. And so there's big error bars. And there's decent surveys. I don't think it's more likely than not to happen, expert surveys. I don't think it's more likely than not to happen by 2030, but 10%? It could. And that's 10% times a lot of bad problems. And so you're starting to see people move. Google announced that they're going to upgrade to post-quantum encryption by 2029. Cloudflare is doing the same thing. The White House announced a new executive order that moves some of them up to 2030, 2031, asks other groups to look even earlier. And part of that recent response in the last few months is indeed due to algorithm improvements, not just the hardware. The requirements in terms of quantum memory to do this have gone down by like 20x in the last year. And that's for an algorithm that's been around for 20 years, 25 years, and we've still got new ideas. There's a big decentralized project right now where people are throwing AI at this problem because Google's most recent cutting edge result, they didn't release how to do it. They just said that they could. And they released it with a zero knowledge proof that showed that they could break encryption with a very small circuit, but didn't give the circuit. But that's now been reproduced by a bunch of people throwing Claude at it because they now have this zero knowledge thing as a harness to check their answers against. So the algorithms are getting a lot better. And then in terms of how it will roll out, there's probably one thing that's really important to say, which is a lot of people ask, why do you think this is coming when you still haven't factored any numbers that are bigger than 35? And tracking how big of a number quantum computers have factored is not the right metric for this problem. It's analogous, and this is an analogy from Scott Aronson, which I think is spot on, which is it's like going to the Manhattan Project in 1943 and saying, why haven't you made even a small nuclear explosion? It's not an incremental progress kind of thing. We're going to keep improving, and then all of a sudden you're going to see things go up. And it's because of how fault tolerance works, it's because of details, but that's just don't track the size of factoring as your way to forecast this. You'll be wrong.
So I'm going to leave some time for questions. How much time do we have left? Good. Okay, so I'll leave a few minutes for questions at the end. But there's something even more urgent than just Q-Day, right? There's a Harvest Now Decrypt Later threat that's that's currently ongoing. I don't know if any one of the panelists like to dive into that subject a bit.
Sure, it's fun. So basically, you just need to accept that any information that you have sent over the internet over the last couple decades, somebody within 10 years plus or minus 5 years is going to basically be able to first unencapsulate that key and then go find the other traffic that you sent that was encrypted and de-encrypt it with that key. So that's just a given. And there are certain things that are mutable that you need to have a plan to go change. And there are certain things that are immutable that, if you're a government, you really just don't want that information out there because of state secrets, blah, 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 which is going to suck. And then from a second order peel of the onion of the implications from a cybersecurity point of view there's certain information that, frankly, if you were born before 2035, very likelihood your name, address, social security number, birth date, et cetera, are now everybody's. So that has second order implications that most financial services companies already don't rely on those things, but some still kind of do to prove identity, and you need to think about those second order effects also.
So we covered some of the any other risks for quantum that you guys wanted to cover here that we didn't think about? So we've got
not big enough.
They're really quiet, so they're checking change schedules or being really concerned. Nope. Katie?
I don't think so. I mean, I think we get asked about this a lot. How different is it from normal computation? Do we have to think about protecting things that are outside of the kind of encryption piece of it? Is it going to be a more dangerous technology, things like that? I don't think so. I think we have learned so much about AI and how to protect ourselves against classical computation, how we put some bounds around what that means to protect ourselves against it. I think there's a lot of misinformation out there around kind of the negatives of quantum, outside of the things we talked about for sure. But I think the positives, as Scott mentioned, the excitement around new cancer therapies, new materials for things in our lives, all of our environmental concerns. There's a lot of really exciting potential about quantum that I think I don't want to say outweighs, but we should be just as excited about while we think about the ways to protect ourselves from the technology, like we need to protect ourselves from any technology. So I think the benefits right now on the horizon outweigh the risk, but there's still obviously a lot to keep an eye on.
Yeah, I mean, I'll underline that. I mean, this risk of decryption is a fixable thing that will get fixed and is time-bound. The real big risk is that there's a geopolitical race going on for a transformative technology, and if we lose that, we might not get the benefits of the technology or the economic growth that comes with it.
Yes, that is a really important point. We spend a lot of us spend a lot of time with other global ecosystems, and there is a lot going on outside of the U.S. in this space.
That I will maybe quantify this again a little bit. Is maybe it was in our discussion beforehand that, yeah, we are spending probably billions of dollars in this technology, and it's really accelerating. But if we lose it, that attack will make us pay probably trillions of dollars in terms of damages and other things. So it is good that we are kind of at the forefront of that.
So one of the measures of maturing technology is it becomes kind of invisible. You look at the iPhone, and we have GPS, maps, and people don't even know what they're using behind the scenes or powered by. Do we see quantum computing getting to that stage too, where it's behind the scenes and people are maybe using it on a daily basis but not even aware of it?
Yeah, actually, I think it's probably going to live there, unless there is a killer app that's more, consumer facing. The GPUs, I think, are a thing from a consumer headset, because we were all buying GPUs for our kids, desktops, because they wanted the highest graphics processor, or we grew up doing that. The fact that they're the engine underneath AI, I'm not sure would have been as obvious to people if that hadn't been the first step. And now we just equate AI and GPU kind of as the same thing. Quantum, I don't think is going to start. You never know what the application is going to land on, but it's probably going to be more of a large scientific institution, financial services institution kind of thing. It's going to be good, bad from an IBM perspective, more like the mainframe than the GPU. And I think for 99.999% of humanity, the mainframe is invisible. But it's still 95% of your critical transactions are flowing through that system.
Yeah.
I would say something which is interesting, I guess, kind of there was a time, at least in sort of the last 20 years, I kind of grew up with this, is that, it is amazing how much we make progress, right? So the first dilution fridge that we were cooling things down, they were big. It would take a week to cool it down, and it really needed a lab inside the university. I think today, factoring the money aside, I can put one in my garage and sort of cool down a qubit, right? And again, 10 years from now, might be easier. I don't know.
Is there anything else you'd like to leave the audience with today?
Thanks for staying.
Yeah, maybe just how real they are. I mean, we really touch on this, but 10 years ago, they didn't exist outside of scientific labs. They didn't. There was no such thing as a quantum program. There was no such thing as a quantum developer. There was no such thing as, being able to get cloud access to it. Now you've got multiple vendors who have systems that can run programs you cannot run on the world's largest supercomputer. We're not at the stage yet where it's being used in production for a wide range of use cases, but we've gone amazingly far in the last 10 years, which is why people have confidence that over the next several years you're really going to make huge strides in the technology. As Katie said, it's a lot more approachable than people think it is in terms of we give 10 free minutes a month to anybody who's in the right geography, for access to the technology, and it's really just like Katie said, you can do it on your phone. I mean, it is really quite amazing how much progress there's been in the last decade.
Yeah, and the increase, right? And we don't have our pretty charts here today, but, the hundreds and hundreds of people signing up every day, the trillions of circuits being run over time, over 500,000 people, or probably closer to 700,000, something like that now, have run something on the systems, which is incredibly exciting from when we put the first quantum computer on the cloud. I don't think anyone expected it to advance as much as we have. And that's why I think testament to why we're all here and so excited. But yes, Scott, you're right. It's real. People are using it. It's going faster than you think, and it's wildly approachable.
I want to give 3 points and then maybe as my wrap up. Like, 10 years ago, again, it was for complex theorists and physicists, I guess quantum physicists. Today, you will see a wide range of people looking at it, looking on algorithmic, on application, on RF engineer. Like every person at NYU who can just do something on a quantum computer at IBM on cloud access, right? But with the AI, I really didn't expect it that it's just accelerating so much. Like what we were saying, like people can just put it on and then try ideas. If I want to write something on Qiskit, previously I had to really know it. Now I can just ask Claude, I want to do this example, can you do it? And I think, if we meet in a few years, it's just going to be a completely different thing. Everybody in this room probably has done something on quantum.
I have a quick question, it's okay. I know it's at the end, but, oh, sorry. So I went to a conference exactly on this topic, probably about 10 years ago. And I think I heard the same things that you all are saying. And I'm an innovation person. I'm all about all of this. I just want to understand from you, what's the one thing that's changed over the last 5 years that you think this is now going to be regularly adopted? Thank you.
There's probably different answers. Practically, from my perspective, people are running real problems they want to solve on a quantum computer and getting computational results that matter to them. That's slightly different than saying that it is so much better than classical that they're going to switch production over there. But especially in the chemistry field, people are now running problems that are of interest to them for their daily mission on a quantum computer. That has changed drastically.
Yeah.
Drastically.
10 years ago, nobody had sold any quantum computers. So the quantum computers are 100 times bigger, more than 100 times more powerful.
10 years ago was when we first put one 5-qubit system on the cloud.
So
and now there's been hundreds.
Yeah, it's been steady. Look, it's not done. Like we've got, this is a hard problem. But like what's changed is like everything has gotten better. Like we have more quantum memory. They operate with orders of magnitude less errors. We've sold more of them. The algorithms are orders of magnitude easier. Like it's a matter of time. And then that's why you can guess on your slopes and whatever. But progress is happening. And another really important thing about that is that 10 years ago there basically wasn't much of an industry, and the venture capital investing in this space over the last 5 years has been something like before 2020 it was like I don't know, less than 100 million a year. Now it was like 1 billion, and 1, then 2, then 4, then like 8 last year. It'll be bigger now, which is exciting for us, but peanuts compared to like other kinds of investments. And so the fact that capital is starting to go in and we're seeing that growth means that some of these problems that we're getting better at, we also see we're going to have the resources to keep solving. So that's why we think the progress is going to continue.
Hi there. Just wanted to see if any of the panelists had any perspective or recommendations on post-quantum schemes for blockchain systems. There are a number of proposals out there, some of them kind of contentious, like BIP 360, which is sort of eliminating some of the long tail attacks. Pay-to-Merkle route, it basically eliminates sort of exposure and reuse of addresses, and then eventually getting to kind of post-quantum signature schemes, wide variety of different types of schemes. Some of them are big, some of them are small, some of them are newer. Any advice on sort of how the blockchain communities, Bitcoin in particular, can kind of navigate that landscape? Because it's, any kind of upgrade to these systems are pretty contentious and difficult, as we've seen with the block size debates and things over prior years. So any perspective would be welcome. Thank you.
This is such a great question, because you've highlighted that it's not like we're just going to upgrade. There's a bunch of decisions that need to be made, and it's all about trade-offs. But here I actually get to put on my VC hat and be like, I don't know the answer, but I know who does, and I invested in them. You should talk to Project 11. Because it is really subtle. Like, it is not like a clear, exact way it's going to happen, but something has to happen. And then there's a question, one maybe a thing to highlight. What happens to the coins that don't upgrade? Do we burn them? Do we let anyone who has a quantum computer just take them? Like, these are interesting questions, too. I don't have the answer.
I would just say that, at least for post-quantum, there are also many, many solutions. Like there are software only, there are software and hardware, and then there are the ones that have photonic solutions in them. There are the random generators, quantum random generators. As Will said, ultimately we have to decide on one of them. But some of these solutions go into HP racks and the servers and worldwide, right? But we really need to sit down and say, like, which solution do we really want to pull it off and how we can deploy it. And can we persuade the servers worldwide to kind of go that, or for the Bitcoin in particular?
Thank you. Very quick question. What would you advise the governor of the Central Bank of Nigeria, of the Reserve Bank of India, of the head of data governance of the Federal Reserve Bank of New York to do in the next 6 months to be quantum ready? What is the action?
So I think there's two. I think the first one is, get a couple people in your organization who understand kind of the algorithmic approaches in quantum computing, so you understand basically from a financial markets point of view what the potential implications are. And the second is, I think you need to have a plan for PQC.
For quantum resistant, for upgrading to post-quantum encryption.
For basically the transition to changing the standards. And like I said, the implications, like I was sitting here thinking, oh crap, I don't even know where people are sending like my fingerprint data over the cloud today. Because if they are, I don't know how the hell we're going to authenticate people in 10 years.
And it's going to take forever. Doing this upgrade is not going to be easy. Like, people didn't build all the keys are spread all over the place, just indexing where they are. Like, this is really hard. So you don't necessarily have a lot of time. So the next 6 months, you need to come at it. You really need a plan now. Google has a plan. US government's having a plan. Cloudflare's having a plan. Like, Coinbase is making a plan. Like, you should be making a plan.
Yeah. CNSA Protocol 2.0, which is what the government is putting out, mandates by 2033 everything has to be PQC enabled, and that really raises this discussion that when are we going to agree on what that protocol is going to be. So the game is 27.
I think the EO just moved it in 3 years.
2 years again.
Yeah. But yeah, so it's coming the other direction, which should be your signal on what's changing from a technology point of view. It's changing enough that the U.S. government is moving dates to the left.
I have a question. So I think, William, you mentioned there's good surveys of experts. Like, I think the Global Risk Institute has a survey that puts less than 50% in the next 10 years, but 50 to 75 in the next 15. And then some of the prediction markets have contracts on this. I don't know how much we can trust that, given that there's probably a lot more money to be made in using quantum computing to steal things rather than, betting on a prediction market contract on it. And you mentioned how Y2K is a good historical analog, but of course, like you said, we knew exactly what date that was going to happen or what to, focus on. So it seems like there have been a lot of efforts for different people to coordinate, but what can we do? Government has taken efforts, but what can we do, especially for decentralized organizations, to create a real, to solve a coordination problem and create a focusing point on this risk, given that you don't know when it's going to happen? Or is there anything else we should look at besides prediction markets, besides surveys?
Yeah, so the Global Risk Institute survey, I do think, is a very good one. And also, one of the things that's good to look at is they've been doing them for years. So how are they changing over time? And they're moving, they're consistent. A year goes forward, and it's a year more likely, kind of thing. I haven't found metaculous prediction markets to be pretty bad. We see things in the community come out that are meaningful research results, and you don't see them until a while later. I think the decentralized communities should just not worry about the timeline. This is going to happen at some point. You have to fix it. There's pretty much no other complete bug of this scale. Once you do it, you're done. So just do it, I guess.
I guess this is not very directly relevant, but when you go to, especially the government, Navy, Air Force, Army, they can have their own solutions, but they also have to talk to each other, right? So there is a new unit now called DIU, Defense Innovation Unit, that is in charge of coordinating some of that. But then it gets slower, and there is a lot of kind of discussion now going on and all that. So people are trying to hack this, but it's difficult. It's difficult the way that Will says. We know it's going to happen, But how we can bring everybody together, maybe it has to start from the government or not, that I don't know.
It's like most things in cyber. The underlying math is the easy part. The humans are the hard part. And there's I talked to a lot of boards, and I've definitely seen companies out there that are doing a great job of putting together a plan and trying to intelligently try to address the most critical systems first, then go through the layers of the onion, right? Like I said, I think there's going to be second order effects, and there's going to be a lot of bleeps when people realize the harvest now, decrypt later full implications of that. But there's it's not rocket science, but it is a ton of coordination work across vendors, across internal, and for blockchain and those things, it's a nightmare because of the decentralization.
Yeah, one thing I sometimes hear from people in the crypto communities is making a change like this introduces risk. So let's avoid it. and I get that. But what's really going to introduce the risk is if you have to rush it. And at some point this is going to happen. It might not be 10 years, it might be 15 years. I mean, heck, maybe it's 20. It's still going to happen. So do it when you've got the most luxury of time to do it in the best way to ameliorate the change risk. But there's going to be a change at some point.
I think you can parallel it to where we are in AI right now. The algorithms predicted that this was going to happen. It took a long time for the algorithms to map to the hardware. As the hardware, they figured out how to parallelize the things, and that's where we are. It happened overnight, and now we're all caught. Every industry is caught with, what am I going to do with AI? How am I going to adopt it properly? How am I going to make it efficient in my organization? What is it going to do to our program plans for Qiskit and things like that? I don't think we're trying to make some sense of fear necessarily, but I'm with Will, it's going to happen. And I don't know about your organization, but in our organization, lots of coordination across multiple players to get something together really quickly isn't typical. So I think this is something, like Scott said, we hear all the time. And it's interesting to me, especially in the face of how every organization feels about AI, that there's still this massive question about this piece of it.
I would just say it as a fact that there are lots of adversaries, places and countries that have very powerful quantum computers, maybe very close to what we have in the United States. So it's coming, and the risk is real.
Okay, well, thank you, everybody. Appreciate the time.
Thanks.
Thank you.
Thank you all so much for this really interesting panel. So next we welcome back to the stage Per von Selowitz for his panel to wrap us up. Where do we go from here? The convergence of agentic AI and the tokenization of the financial markets.
Well, thank you, and I'll start off by saying Scott was complaining about the second to last panel of the day being a bad spot, and I'll disagree with him. I think the last panel of the day is actually the best spot because we have the opportunity really to reflect on the last 2 days and all of the interesting conversations that we've heard and the different panelists and speakers. And this panel is really designed, among other things, to try to wrap up some of those topics. So really understand how a number of the domains that we've discussed, whether it's AI or tokenization or others, are really working together. And oftentimes, I think the discussions that we have focus on these domains really in silos. So what are the implications of one technology or another technology? But if we look forward, my hypothesis is that we'll be in a future state where many of these are interacting with each other. And the real value propositions, the real impacts that we realize from these technologies will be the result of that interaction between the technologies and not those technologies really operating in isolation. So today I'm absolutely privileged to have 3 panelists joining us here in the bank. So Carolyn Weinberg, the Chief Product and Innovation Officer at BNY, Guy Ouellette, General Partner at A16Z, and Jonah Powell, Managing Director of Technology Research and Innovation at DTCC. So we'll start off the panel, if that's okay with the three of you, where I'll ask you just to add to your bio a little bit, so provide a quick introduction of who you are and what you're focusing on at your different firms. And then I'll pose the same question to all three of you. So again, on this convergence issue, we often discuss these technologies again as separate tracks. And when we talk about the convergence of agentic AI and tokenized markets, are these really distinct concepts? Are these technologies dependent on each other? What's really required to have these technologies scale and operate together? So Jonna, could I start with you?
Yeah, absolutely. And thank you so much for having me. So my name is Jonna Powell. I lead technology research and innovation at DTCC. And for those of you not familiar with DTCC, we are kind of at the center of the capital markets industry. We settle about $5 quadrillion per year in securities. That's trillions of dollars per day, and that's quite a few hundreds of millions of dollars per hour. So quite significant. And my specific role within DTCC is to look at kind of three areas. One is digital assets, where we're doing a lot of initiatives. We're launching a tokenization initiative in July and also in October. I oversee the AI enterprise strategy as well for the firm, and spend the rest of my time on next-gen capabilities and emerging technology. Would you like me to answer the question, or do you want to first go through introductions?
Why don't we go through the introductions, and then we can go to the question.
Great. Well, thank you for having me in this great panel, and it's great to be at the end of the day. Cheers for that. Yeah, so I am the Chief Product and Innovation Officer at BNY. Similar to the commentary about DTCC, we also sit very much at the center of the infrastructure of financial markets. We touch about 20 to 30% of all the securities that transact every single day. We are core infrastructure for the Treasury market itself, and we are a custodian for about 60 trillion of assets. And then there's a whole host of other things we do with regards to payments. We are transacting about 2.5 to 3 trillion of payments every single day. We also, by the way, have a $2+ trillion asset manager. So there's a huge amount of critical and core businesses that BNY participates in for the financial markets. And what we'll get to talk about throughout this panel is how actually AI and digital assets connects all of those together to enable our clients. Collateral is another big area where we're, I think, the largest collateral manager, for example. So all of these fit together to enable our clients, and that's what excites me. So just to add to the bio, I guess for me, just as a background, I studied applied math. I get very excited about all things applied math, genuinely. So I remember, before going to business school, I had the time off. I actually went to New Zealand to work at the New Zealand Stock Exchange for fun and for free. So I genuinely enjoy this. This is fun, free time. Between BlackRock, where I worked prior to BNY, and here, I spent about 6 months doing quite a lot of research on the future of financial markets and all of the amazing ways that you can combine AI actually and digital assets to transform and improve the market. So market structure, leveraging the latest technologies, and for me, it's about enabling in a auditable, secure, and resilient way market movements from a security to a data to a enablement for all of the different elements of asset management, insurance, and so on and so forth. So how do we make the market safer, better, cheaper, while we are very focused on this auditable, resilient market infrastructure? And obviously, BNY is a perfect place for me to be working to do all of that. So I'm happy to share some of these thoughts later in this conversation.
It's great to be here. My name is Guy Willett. I'm one of the general partners at Andreessen Horowitz, focused on investing in crypto projects. We invest across technologies at the firm, but the crypto team is very focused on blockchains and on financial services today. I think it's an interesting way to start to say that we call ourselves a crypto team, and most people think of that in the context of cryptocurrency, assets like Bitcoin. But we think of that as meaning crypto network, or building an internet service on a blockchain as a better way to build services on the internet. And we fundamentally view financial services as a network-based business, and networks can often be built better on blockchains. And so when we talk about digital assets, to me that means taking all of the traditional assets that the entire world cares about and putting them on a blockchain, largely for better efficiency, lower latency, and stronger access. I think we've seen that work really well in two places so far, which hopefully we'll talk a little bit about today. The first being stablecoins, essentially putting US dollars on a blockchain and having those be programmable and global by default, and then in new forms of exchange. And I would point to things like perpetual futures and prediction markets as really starting to find massive product market fit. So we focus on investing in early stage startups, and it's wonderful to see people like BNY and DTCC really focused on moving financial services on chain as a great proof point for all of the innovation happening here.
Great, thank you. So Jonna, perhaps we can go back to you with that first question about the convergence of these two domains, and help us understand how these might operate together. Are they dependent on each other? What's required really to scale?
Yeah, and I think you kind of mentioned they're, are they separate? Are they converging? And I think, at the beginning, certainly they've been very separate. And I think in many cases, in many financial institutions, they're still quite separate. But I think they're going to converge quite quickly. And we're already seeing that convergence in various ways, using agentic AI to, read and write smart contracts in different languages and things like that. I think, the convergence is good because each one solves the other one's biggest limitation. And so tokenization, it gives us programmable assets, which is great for, 24/7 settlement, atomicity, and so on. But that's only as good as the, intelligence that drives it. And usually that's human-driven or hard-coded. Whereas agentic AI is kind of the opposite situation, where agents are getting remarkably good at reasoning, they're getting good at planning and coordinating, but they need an environment that they can work in. And when you look at traditional legacy environments, with all of the reconciliation, it's batch-based, it's intermediate, it's not really necessarily this environment that's conducive for agentic AI to work within. So when you put them together, that's where you kind of get something quite new and exciting, because agentic AI working on digitized rails is more like the native environment for agentic AI to work within. And if any of you have used an agent to go into Etherscan and see just how natively it's able to read the blockchain. It's fascinating. It's very difficult to do that, manually as a human. So I think, each can scale somewhat on their own, but from a step change, I think the thing that reorganizes how markets work is, really at the convergence. So you can kind of think of, at least the way I think about it is, one is the hands and one is the brain.
That's great, thank you.
So when we think about our strategy at BNY, as I mentioned, we are big in storage. We store 60 trillion of assets. And when we think about what digital assets and AI does for us, we think now about storage for mobility. And we say it's powered by digital asset infrastructure and financial intelligence. And the combination of those four pieces, again, storage for mobility, digital market infrastructure, and financial intelligence, really tells you from an AI and a digital asset perspective that convergence is significant and real. There are many elements where without AI, we wouldn't be able to drive that financial intelligence layer. So you can build a road that's a superhighway, but if you can't actually see where the other cars are on it, which is essentially the financial intelligence and how you interact with them, it doesn't work as well. So digital assets is actually perfect for programmability, and it enables you to have that superhighway alongside that brain. So when we actually think about our digital market infrastructure, we often call it, here's what we need for the infrastructure for the build, and here's what we need to make sure that the brain works on top. And we actually architect that digital market infrastructure with the concept and the knowledge that we are going to drive financial intelligence alongside it. And when I talked about what BNY does, all of the pieces, that financial intelligence with that context layer of the firm will actually be a big unlock and is a big unlock for our clients. You have an asset in custody here, it can be used in collateral over here. And by the way, you're settling something else over there, and maybe we can help you make sure you have settlement. Oh, and by the way, you had a payment that went out that had a mistake on it, and we can fix that. So that the context layer, or that actually powers the financial intelligence, to drive a context layer, you need AI to build that. It is another piece. So we often think about AI, and I call it like, this is just my own made up word of like precision AI, because often we talk about AI and people are thinking, oh, that's going to help improve my productivity. And that's amazing and great, and we all do that all the time. At the same time, there is an element when we talk about the precision of financial intelligence and the markets, where if I told you it was going to be wrong 1% of the time, that would be a huge problem. But if I tell you your productivity will improve significantly, but it'll be wrong 1% of the time, you're super happy. You're like, oh, my call notes are great, and my calendar's better, and all these other things. But that 1% wrong, totally fine. So how do you drive a context layer with precision is the focus area that drives, therefore, then, our concept of how do we link it with our blockchain and our books and records that enable that power. So I just want to separate out a little bit of AI can power things with that brain, but you also use AI to build the context layer that with precision that drives that better decision making. And it's sort of linkage, if you will, but different elements and aspects in which how you use AI and how you build that data layer and the different layers on top to, again, make better decisions.
Perfect. So I'll start with, I think the ratio of the number of times AI was said to the number of times quantum was said is a good indication of what we're all focused on. 67 mentions of AI during the conference, and I think that's for good reason. It's pretty cool to be alive at a time where we're probably coming to AGI. I would argue pretty strongly that at the end of last year, probably with Opus 4.6, we actually got to the point of artificial general intelligence. And so my question to everyone in this room would be, well, if we have AGI, why have we not seen an increase in GDP growth? Why have we not seen kind of these broad macro factors of increased productivity begin to show up? And my answer would be that AI is struggling to have a very specific impact on the economy more broadly because our financial system and the way we transact is not built for agents. It's not built for permissionless actors to be running around at the speed of compute. It's built for humans, like we all are in this room. And I think for agents to have a real impact in our economy, they will need smart contracts, and they will need financial services on a blockchain, or we will need to see all financial services infrastructure upgrade at a pace that it's never upgraded previously. So I think it's kind of a happy accident that a lot of what was built in a blockchain context is a perfect fit for the way AI agents want to transact in this new modern economy. So that's kind of the high-level top-down vision for why I think AI and crypto are convergent. And then on the other perspective, I would say a lot of back-end financial services, I think, can and will be automated and become much more efficient over the coming years. I think it's not a mistake that the large financial institutions on this panel are, both serious leaders in, back-end and back-office financial services. And I see AI and smart contracts both kind of attacking the back office and automating it. With one example that we see from some startups we're working with, talking about loan servicing, that today in many cases is a large number of people with Excel spreadsheets, and I think in the future will be a combination of AI agents and smart contracts. And so I think there's both kind of the important top-down macro question of how will AI agents actually make our economy more productive, and then there are the very specific kind of tangible use cases of where will we first see that pop up, and that's what we're focused on every day.
Thank you. I think that's a great way to set the scene for the discussion, and I really like the description of infrastructure and intelligence. I think that's an important way to frame these two areas. And what's also interesting, Guy, as you said, is we know something about the development of the technology. We know something about how it's progressed and the state of that, but it hasn't necessarily shown up in productivity. It hasn't demonstrated its value yet from a practical standpoint. We can't see that as tangibly as we might want to at this point in time. As we know, all technologies take some time to actually turn into value, if they indeed actually do turn into value at some point in the future. And we have a hypothesis around that. But I think what's also true is that these cycles seem to be moving faster anyway now. So we do have the benefit of, I think, learning more quickly and also demonstrating more quickly the true value or unvalidating the value of these technologies. So we'll move now a bit from this high-level discussion and get into some more specifics. And I'll continue with you, Guy. If we look at AI agents, as you were referencing before, AI agents need some sort of payment and settlement layer to execute transactions autonomously. So they can't just do all this on their own. They need the infrastructure that's there also to make this happen. So as we look at these components of infrastructure, are tokenized rails, stable coins, or smart contracts, do you see that as the natural economic infrastructure for AI agents? Are there others that you would reference? And are there any specific infrastructure bottlenecks that you think are most important that we need to solve today?
Yeah, I think stablecoins and smart contracts are a natural fit for agents that want to make payments. I think usually people start with the use case of, well, my agent will buy something for me, and so it needs stablecoins. And I think that's not quite right. You know, there is an alternative to using stablecoins, and I would propose virtual cards for that. If you want your agent to make a purchase on your behalf, a virtual card actually does that pretty well. But if you want agents to transact with each other in very small amounts of value at very high speeds, then I think you need something like stablecoins that have a very low overhead cost per transaction and where the latency is almost instantaneous, and you have true settlement instantaneously. And so I think the use case we've seen that has progressed most tangibly on this so far has been that your agent, I imagine most people in this room have used Claude or Codex or one of the agentic platforms. Your agent is much more useful if it has data and context about the question you're asking it. If it doesn't have access to the internet and it doesn't have access specifically to paid APIs, your agent is just generally less productive. And so we've invested in a couple of companies that are focused on essentially doing API fractionalization and allowing your agent to pay for a very specific API in stablecoins at fractions of a cent, where that payment happens instantaneously. And your agent can pull data from, in some cases, tens of different APIs within less than a second and make fractional payments to each of those APIs in order to give you, the best possible answer to your question or take the best possible action on your behalf. And it is theoretically possible that we could redesign a lot of the payment infrastructure in the US to enable something like that. But I think because stablecoins are such a good fit for that specific use case, we've seen a lot of really people coming from an AI background discovering blockchains as the payment mechanism that makes the most sense for their company.
Great, thank you. And yeah, stablecoins are clearly one of those instruments, and there's others. We've been involved with quite a bit of research here in the New York Innovation Center, looking at some of these infrastructures and these different types of instruments. So it's an area of real interest for us, and we're continuing to try to understand really where is the value delivered, how do we validate these different value propositions, and what do these future states look like. So I appreciate that perspective. So Carolyn, I'd like to move to you now and continue digging into the infrastructure topic a bit more. And when you think about autonomous software agents that are working now or starting to work with tokenized market infrastructure, and BNY obviously has invested in tokenized market infrastructure and starting to serve that market quite aggressively now. What do you see as some of the immediate practical use cases for adding the intelligent automation to the life cycle of a tokenized asset?
So just to clarify, when we say tokenized asset, we're really talking about we have treasuries or we have assets that are transacting, and we are representing those transactions or that asset on our internal blockchain, or we're seeing it elsewhere. There's like a fund that's sitting on a block, but it's the representation of that books and records and the settlement of it. So it's not like there's this like amazing thing that all of a sudden the asset's tokenized. It's just like, how are you representing? And I just want to make sure that people understand what we're talking about when we're saying a tokenized asset, because it's truly just, how am I recording the position of this asset? Am I putting it in a system that closes down and has batch processing, or am I doing it and representing it on a blockchain that is always on and actually accessible in certain ways? So that's sort of like the first commentary. Second one is, so my background also is markets and sales and trading, and this concept of machine learning. What is the right price of that asset? How do you do evaluated pricing? And for anyone who's in the bond market knows, bonds don't trade very much. So therefore, like if you're actually going to price a portfolio of bonds, and you look at any ETF that trades, the stuff inside maybe only 10% traded that day. So therefore, this concept of evaluated pricing, auto market making, and how do you actually understand what sits inside from a pricing perspective, that's all machine learning. That's like a predecessor to AI in many ways. And now what happens is you can say, gosh, how do I leverage all of this data that we have? Can we leverage more data and more context and other information to better price and evaluate the movement of these securities? So that's sort of like one really important thing, the evaluation of security pricing, the movement of the money, and the unlocks that could come to be as you start to layer in more AI thinking as opposed to simply machine learning is really relevant and important. I would say another thing that's critical is that as one thinks about the settlement markets as an example, so we have much more information about the markets we play in than anything else. We talked about context and so on and so forth. So if we look at all of our clearing and settlement data, we actually, and we can go back in time, so we, as I mentioned, for the treasury markets, about 25 trillion every day. These are like massive numbers, by the way, obviously. So just as an aside, our systems work really well. So it's really important to appreciate that, that resiliency also means that the existing systems that can settle with like specificity and certainty, 25 trillion, we're really happy about those. And it's about enabling AI against what we have and digital assets against, or blockchain against what we have today, that combination. But imagine now you have all of this information on what settles. And now you can actually start to think through from a data perspective more than you could before. Well, what isn't settling? Why didn't it settle? Do we know it's not going to settle? And if you start to think about settlement from an AI perspective and an agent that says, gosh, the last 5 times these two pairs came together to trade, it didn't work so well, and actually that means probably someone's middle office is not clean or something happened. We know that now. So we actually can leverage AI to improve the certainty of settlement because we know, gosh, either these pairs don't work, or if we're this far down the cycle of settlement and it's not there, we have a sense. So what do? We actually can call both parties human intervention because the agent has said, like, it's gone from green to amber to maybe red, and we can stop the daisy chain effect that takes place when something doesn't settle. So just giving like slight examples to which you go from sort of machine learning, which worked well, to AI that has more context, and then actually activities that can really improve financial markets. But you need to understand what data do you have, how do you actually harness that data in the right way towards real, tangible, useful things, because we all can imagine lots of ways to leverage data or leverage AI that are frankly not useful. So if you actually can find real clear use cases for why you are leveraging either AI, digital assets, or both, it actually unlocks real opportunities for clients, but you have to be clear and specific of the value created, and that's how you drive scale and opportunity for your clients.
Thank you, and I appreciate your comment about how the infrastructure works well today. So it's not a situation where everything is broken and doesn't work today and we're trying to fix it. But are there opportunities to improve things and identifying where are the opportunities that are highest value? Where can we encourage these new value propositions given the emerging technologies that we're testing? And John, I'd like to move to you. And DTCC has a digital asset launchpad, and I'll ask you to just describe briefly what that is. But I think this is a great practical example of how your organization is experimenting and testing some of these areas to try and really discover where are these new value propositions relevant for DTCC and perhaps more broadly the financial markets. So I wonder if you could talk a little bit about the initiatives that have been within the Digital Asset Launchpad, what they've taught you about the infrastructure required to link tokenized assets to tokenized wholesale money. And when you introduce AI agents as coordinators or the intelligence around these rails, what are some of the biggest interoperability bottlenecks that you think the industry needs to solve now?
Yeah, absolutely. And by the way, I loved Carolyn's point around, finding the real use cases that are actually going to drive value. You can't be taking an AI magic wand and just think you're magically going to solve problems. So the digital launchpad, it's an experimentation environment. It's designed to enable proofs of concept for our participants across leveraging multiple Web3 components, Web3 applications, partners, and from there guide deployment to production in a seamless way. So we're using that launchpad and multiple other environments as well to guide a lot of activities that we're doing right now that we'll be launching in July as well as in October, several different use cases. I think one lesson from the Launchpad that we learned was that it's, the hard part is never necessarily tokenizing the asset. Really, as Carolyn mentioned, it's a representation. It's a digital representation of an asset. The technology has been around a long time. You can put a security, a fund share, collateral on a ledger. It's largely solved, I think. But you can't realize the promise of tokenization necessarily unless you have your wholesale cash on the same rail. So that is one of the things that we actually showcased during the collateral experiment last year with Finality. So we showcased an atomic real live DVP with central bank-like money. So that was exciting. I think the second lesson is around interoperability. So it's not just a technology problem, it's a legal problem, it's a security problem. It's also an integration with legacy technology problem. There's a lot to it, and it's quite complex. So, you don't want to end up rebuilding the same fragmentation that we already have across the markets, because every institution kind of wants to build its own walled garden. And when we think about all of us working together, and you think about the whole point of financial market infrastructure is to be the shared kind of neutral connective tissue. So a big part of our work has been about pushing standards and pushing common ways of creating this infrastructure. Now, when you add AI agents, and we're not doing a ton of AI agents within our digital asset launchpad just yet, we're doing it more in our DTC CIQ environment, which is a little bit separate. I think the one big challenge, the bottleneck really sharpens into kind of one word, and that's identity, right? Ensuring that for the agent to move value safely across networks, every party and every asset kind of needs a verifiable, machine-readable identity. And I think the market isn't quite there yet where we actually have a layer that validates that identity.
Well, thank you. I think that's such an interesting perspective, and I'm glad you brought up identity. It's obviously one of the key pieces of the puzzle that needs to be inherent and needs to be solved and improved as we think about all these future states, and we think about things like AI agents also having identity, so being independent actors, and that's one of the key elements of that. We heard Leanne Russell on the first day of the conference talk about in BNY, and you tell me if I'm describing this in the right way, but you have AI agents as employees, I think, in BNY now, which is an interesting concept. I'm sure they're compensated differently perhaps than the humans are, but they might have other characteristics that are similar. And I thought that was just a fascinating concept, but that's an example of how I'm sure they have identity that's critical to their functioning in the organization. So now, Guy, I'd like to move over to you, and this is examining a bit of some of the concept that we've talked about related, I think, to understanding the intelligence versus the infrastructure and the different characteristics that are related to those two elements. So if we look at the Web3 space, we talk about smart contracts enabling programmability. So if X, then Y sort of scenario. But standard smart contracts are deterministic. They're not probabilistic. So as you look at the next generation of financial wholesale infrastructure, the startups that you're working with that are trying to understand this and reinvent this in many ways, how are the startups building a bridge between the probabilistic AI agents and the immutable execution required by the wholesale clearing and settling systems?
Yeah, I think when we talk about agents transacting or participating in financial markets, it's not that the trade is non-deterministic. It's that you as a human have some high-level intent, and you are asking the agent to translate your high-level intent, like, please buy me this asset from this venue. The agent is translating that into code in many cases, and then submitting an order on your behalf. It's not that the order is perhaps submitted and perhaps not submitted. I think that would probably be highly detrimental and not particularly helpful at all. It's much more that the agent is a much better interface for a human to communicate with a computer. And financial markets running on a computer, it's probably in many cases much simpler for a human to talk to the agent and have the agent transact on your behalf. You could see this being much faster depending on the market and the use case, and you could see a lot of the decision making about what sort of transactions you want to be undertaking also determined by the agent. But the placing of an order is, as it should be, and as it is today, deterministic. So I don't think that specifically will change. I think this is true outside of a financial context as well, and you've seen this in a lot of the discussions around token maxing recently. Some of you may have heard of much larger companies wanting their employees to use as many tokens as humanly possible, essentially trying to encourage innovation within their company. But as soon as anything that is a measure becomes a metric, the measure becomes much less useful. And so you may have heard some large companies talking about how they're not getting the right return on tokens they want from their token maxing. And I think this highlights really that agents should be writing software for users. And you should be turning high-level intents into deterministic code that executes repeatedly, as opposed to talking to an agent every time you need some action to be taken. And so I think that applies doubly in a financial context where you have to be certain that the action you're taking is the action you want. But I suspect we'll see this across use cases and even outside of financial services, that you will talk to an agent, the agent will write software personalized to you or your use case on your behalf, and then you will call that software over and over again.
I think that I think that's super interesting. I also think that only works when you know what you want. And one of the challenges is the possibilities that AI can deliver for you, particularly in this precise way, and what your data looks like in such a way that you have confidence in that. And one of the areas we've been very focused on is this context layer and the knowledge graphing that comes with that, and the ability for us to say, gosh, the probability that these two things inside the firm are the same. Therefore, you can give that. So if the security lives in lots of places, it's in this fund, it's in someone's account, whatever it might be, and where it's how do we know that it's the same thing we're talking about? And even that concept that the security may be in different places, and it's obviously there's lots of, just like Apple stock, or where even you, the client. And having that context layer and then the probability that those things are the same is actually a tool that many don't even know exists. And for us, we actually use knowledge graphing and the probabilistic concepts of are those things the same or is this accurate is really important. So you talked about loan enablement. We are giant in that space. We do about $2 trillion of that every in notional. There are lots of pieces of paper in a loan. Anyone's looked at a loan, it is like an entire ream of paper. So you can't just send that into an AI agent and be like, tell me what it says. That's sort of obviously useless. So the methodology by which you can turn pieces of paper into terms and conditions with actual probabilities that those terms and conditions are accurate, and then actually have an auditable mechanism to check and make sure and then make that real, and then creating an identifier against it, then enables an agent to perhaps execute on those 300 or so terms and conditions with digital cash. But it's just important to understand and separate out this concept of I know exactly what I want from understanding the possibilities of what AI can do alongside, frankly, traditional, knowledge graphing has been around since the 70s or even earlier, statistical modeling. So my mom's a stats professor and she's gosh, I'm cool now. She's retired, she worked at NYU for 50 years. But all of a sudden, everyone cares about statistics. So it's just really important to understand what tools are out there, how you can leverage these things to actually do the things that we're talking about. So that's sort of where Leanne, I think, talked a lot about this concept of enabling so that people can dabble to learn then to enable you to do those things with specificity.
Yeah, thank you, and all moms are cool, so let's just establish that. But John, I'd like to ask you for a quick follow-up on that, because this concept of how to understand the probabilistic characteristics and opportunities, I think, is an interesting one. So AI agents operate probabilistically. They have the potential to hallucinate. They can make predictive guesses about certain things. They're not always right. They have the ability to adapt depending on what they learn, these kinds of things. So as you know, with post-trade infrastructure, it needs to be deterministic. You need to have absolute certainty. There's no room for hallucination, ultimately, in that sort of environment. So as you're thinking about governance required and the safety components that need to be put in place to ensure that it operates in that way, I wonder if you could help us understand how you're thinking about that.
Yeah, absolutely. I mean, I think we're very far from putting probabilistic, agentic AI into our settlement rails. But I mean, I think one of the things we think about, and I think a lot of people maybe are not necessarily thinking about, is separating out the decisioning layer and the execution layer, right? Where the decisioning layer could be the agentic layer. That's where they're doing the analyzing, the recommending, the drafting, the predicting. But the execution layer, that's clearing, that's settlement, that's the final movement of value that has to be deterministic. It would be a mistake to put anything probabilistic in that layer. So I think there needs to be a clear boundary between the decisioning layer and the execution layer. So of course, then the agent would have to have a constrained space. It would have to have limitations. It would have to be, kill switches, things like that. But you could think of the agent as, I think a lot of us think about agents as a very smart analyst who makes recommendations, and you can take that recommendation or not. But it has to go through, all of the rules and checks in order to have anything deterministic happen. And I think, then when you wrap the governance around the agent, then you have to make sure that everything is logged. You have to make sure that everything is fully auditable. You have to make sure you have identity attached to it, so it's consistently trackable. And again, it has to have limited authority, very specified authority for specified amounts of time, circuit breakers, and so on.
Great, thank you. So fascinating so far, and I think we're starting to understand how these different elements have the potential to weave together, and we're learning a lot. So Carolyn, one follow-up question, which is related to, in some sense, the question that Jonna just answered. So as we're thinking about wholesale payments, and we're moving wholesale payments to tokenized rails, potentially run by autonomous agents in the future at some point in time. And one of the discussions around the evolution of these technologies is the ability to deliver atomic settlement. So the concept of a conditional payment, the security and efficiency of payment versus payment, or delivery versus payment like settlement that we experience today. So how do you and BNY think about your risk and control structures, and how they might have to change with agentic systems, where agentic systems can dynamically shift collateral, for example, to fund a payment in near real time, so very quickly instead of potentially over hours or much longer settlement times?
So first is the control layers we have today are critical and important, and what's important that we think about is all of the things that we do for resilience. How do we leverage that knowledge and that experience into any future state we think about? And what's important that you talk through is, gosh, like if you're in a world where you have atomic settlement and things are moving faster, and there could be like liquidity challenges, or which is essentially what I'm hearing you say, like how do you make sure that you do that properly and with the right governance and audit and so on and so forth? And what's interesting and important about the development of and the convergence of AI, speed, digital assets, is that it makes you rethink the whole system in a very simplistic way. And you think, why? Everything went from here to here to here. So the amount of flow charts of how actually things work after a trade or post-trade. So it's fascinating when you're on a trading floor and you do price formation, you bid on something, you offered something, trade happened, and most of those traders don't think about it ever again. You're in asset management, you're like, I'd like to buy that bond, or I'd like to buy that equity. you got it at that price. You don't think about actually what happened after all of that. We obsess about it at BNY. So you guys don't have to, because we do. Now, when you think about how that evolved over time, it may or may not have, the processes by which we do things to enable T+1 settlement or whatever the timeline that's required is, it may or may not have been, if you drew a white sheet of paper, from a white sheet of paper, drew how you should do this. And what happens with AI and digital assets and all of this, and the speed, means that actually you take a white sheet of paper and you say, how does it work today, and how would you redraw it? And how much of it already sits inside the firm? So we think about innovation in 3 different buckets, in fairness. One is just incrementally. It went from A to B to C. Can we do it slightly differently, like incrementally? Now we think inside of the walls of BNY, how would you redraw that? How do we enable that connectivity in a faster, better, cheaper way? And then lastly, is there like a wholesale transformation of the entire ecosystem? And when you do all of those things with that resilience, with that obsession of control, liquidity, making sure you don't have any fails, or if you have a fail, you knew and you could come ahead of the time, all of that is part of that. So people often say incremental is boring, incremental is critical, and then where do you have control and where do you know, and how do you rethink with partners? You actually have to do it in that format. But if you don't actually leverage the control environment, the resilience, all of that governance from the beginning, you're going to miss something. And it can't be something that, it can't be like, oh, by the way, we've rebuilt the system and we now have to add quality checks and controls in there. It's almost like, as I talked about earlier, when we think about books and records on chain, we design it to be programmable with the brain on top. We call it the ELIZA brain, but that's because we call our own system ELIZA. Hamilton's wife. Hamilton founded BNY. Yeah, that's the idea.
Well, thank you. And we've learned a lot from this discussion so far. And I'd like to end with our last question for the two of you. And it'll be the same question. And it uses my 2 favorite innovation tools, which are the magic wand and the crystal ball. And so as you think about some point in the future, and oftentimes we talk about 5-year timeframes and these kinds of things. My opinion is that perhaps the 5-year time frame is no longer sufficient, and we should think about even something much shorter than that, based on how quickly innovation cycles are developing these days. But imagine you're standing here in some few years from now. Will you see the combination of agentic AI and tokenization still be specialized niches for high-tech trading or digital assets, or do you see this as really the new baseline operating system for the capital markets? Will this be the new normal infrastructure, normal approach to executing capital markets? And if that's the case, what's the one major hurdle that we need to overcome in order to reach that future state?
If I could do one thing, I would create a reciprocal KYC standard for securities on chain so that you could transfer a tokenized security or commodity or other asset type and not have to go through KYC for every centralized institution that you face off against. I think that's probably the single biggest inhibitor to having more traditional assets move on chain and to having a more efficient ecosystem.
So I've rarely had a client say to me, I would love a tokenized treasury. Or like, wow, it would be amazing if you could deliver me a tokenized deposit. What they say to me is, I would love to be able to settle with certainty with an optimization that enables me to actually mirror my liquidity with my transactions, or something along those lines. Or wouldn't it be nice if I didn't have to have excess cash in Asia so that I can fund my operations there, but if actually could move it instantaneously from the US 24/7? And wouldn't it be nice if actually my clients in the Middle East who work on Sundays, that the US markets were actually open, or that they could move money? Now, it happens that the solutions are, in some cases, are tokenization or AI or both. But the future state is actually just about solving specific client problems. It's not about the combination of this or that. It actually is about the combination of many of these things. It's about reimagining and rewiring our systems so that we can, with more specificity, more intelligence, and cheaper capital, in fairness, because if you could unlock capital by not leaving it everywhere around the world, more in margins, more initial margin, whatever it might be, you're actually going to have real unlocks for our clients. So for me, that future state just continues to improve the systems for our clients, continues to rethink about, again, this incremental rewiring or reimagined systems inside firms, and then wholesale transformations that'll take place. And in that wholesale transformation, for me, it's about identifiers, it's about data, and it's about that reliance and trust on the system to do the things that need to get done. So I would say that, in my mind, while it's critical and important for, I would say, like startups and disruptors to disrupt, I think it's really critical for the large players who have central position, trust and scale, and expertise, and resilience and regulatory frameworks to reimagine their own systems and partner with some of the latest technologies and leverage all of that to help clients unlock all of the value that could possibly come from these interlocks. So that's sort of how I see that future state. It's really about that those unlocks for client needs. And again, like when someone starts asking me about tokenization specifically, it's a really rare moment. I think I speak to clients all day long.
Well, thank you. And this has just been a fascinating discussion, and I've learned a lot. And it's interesting. My hypothesis is still that we'll experience this convergence, and that's what's going to deliver, I think, the most impactful value propositions to the financial markets. Clearly, there are other technologies that we talked about over the last 2 days, and others that we didn't discuss at all that could be very important relative to this convergence discussion also. And it just creates a very complex environment, but just a fascinating problem to try and understand and solve, and lots of opportunity for all of us. I think we might have time for one or two questions if anyone has a question before we wrap up.
Come on, don't be shy.
Yeah, and if there are no questions, Jonna had to run to take an important phone call. Oh, question there? Grab the microphone, please.
Good afternoon. First, thank you all for an amazing discussion. What I would like to do is use this opportunity to not ask a new question, but maybe to ask for a little bit more color on a point about the promise of the future state, and specifically the opportunity to reduce the frictions, the customers. You said one thing I heard, I took my notes. It's not just about the customer wanting a tokenized treasury. It's the promise of the frictionless payments and the increased settlement. Now, you said a lot, but I was just wondering, how do you see that on scale? Like, can you talk a little bit more about what that promise is?
Sure. So let's take like the treasury market itself, which is the baseline, in fairness, of a lot of stablecoins. So just as a reminder, if you think about a stablecoin is made up of treasuries, money market funds, which, by the way, are made up of treasuries, and cash. It's like essentially that. So it's a Saturday, and gosh, like someone minted a new stablecoin. But actually the systems don't work on the weekend. So you have a new stablecoin and you don't have treasuries purchased or anything, like nothing happened inside the thing. So why is that relevant? So the question is like, why are we even talking about 24/7? If you take like a big step back. So a big step back is that Bitcoin, which is the beginning of some of this stuff, we have a market that actually works 24/7 in the sense of like, there are tweets on a weekend. There is a war that may be taking place on a weekend, impacts the oil markets. Macro trading is a big topic for potentially for weekends. So the markets, in theory, there is reflected pricing or news, but it's not happening. So, right, just so we think of evaluated pricing. So if you imagine a world where you're like, gosh, if only I could represent this like oil trade right now, or this currency trade right now, or whatever it might be, okay. But then all of a sudden Bitcoin comes about and people are like, ooh, I could do that. So all of a sudden these like macro traders started to do macro trading because Bitcoin was like the thing that they could do on a weekend. Now you have to buy something with something. So what are you going to buy the Bitcoin with? A stable coin. I think Per was talking about that. Like on the rails, you need cash. The cash rail was that. The emergence of stablecoin. And some people were like, well, shoot, like relative to Bitcoin, which has like a crazy potential like volatility, it's moving a lot in a day, do I care that I'm not getting yield on it? The answer was like, no, because I'm like dealing with this very risky thing. But then as the world started to become more mainstream of sorts, and we started to see the emergence of blockchain and other currencies and other use cases, the concept of like, gosh, do I really want no yield or do I want some yield? And then you start to see the emergence of other things going on chain. And then you so I'm just painting the picture of why we're even talking about this. And then you have like the Robinhoods and a whole host of other players who are doing, enabling the retail market to do things in different hours. And then you have prediction markets that are out there. So I'm sort of trying to explain, like, there's a whole world out there. And ultimately, all these things need a payment leg. And all of those payment legs, essentially underneath, are treasuries. So why do people always, or often talk very quickly about tokenized treasuries? It's because of that. The world was starting to move 24/7, macro traders, prediction markets, whatever else it might be, you need to pay with that. Therefore, I need a stablecoin, therefore I need a treasury. And I think that connection, I know that's like a long A to B to C to D, but it's just important to understand that. Why do we talk about that? So now you've got this market of treasuries. And if you're going to make the US dollar or the treasury ultimately the currency for this 24/7 future market, which ultimately we talk about tokenizing all things and unlocking collateral for all things, you really need to make sure that these settle and that they actually work and the rails move and you know who's holding your US government bonds. So when you start to think through that cycle of, and then you think about, gosh, I need tokenized deposits also, tokenized money market funds also, and you're wondering why has there been an emergence of tokenized deposits, treasuries, and money market funds? It's because they all fit into a stable coin, and that interoperability going in and out is what's needed. So again, you sort of go back to so how does this start to play out from an operational settlement needs perspective? You start to see that, and then therefore, you start to see payment, treasurers of big companies saying, "Ooh, wait, can I use this to do these things?" And then they're pushing their corporate banks to say, "I have money here, can't you just move it that way? Because if you're not going to, I'm going to put it in stablecoin and send it myself for very cheap." So I know this is a long history lesson of sorts, but the point of sharing that is you get to then the point we're at today, where all of the systems need to work at scale for institutional clients. When it started as a bit of a retail play, merged a little bit of macro players with retail play to becoming now institutional, this concept of how do you marry it all to make sure that things settle and move in the right way to the right people, all of a sudden there's massive unlocks. And I guess I don't know if that answers your question, but hopefully it does, but we often forget why do we jump quickly to these other pieces. It's because of that. And then you start to wonder, this perpetual futures, wouldn't it be nice if I could trade oil? There's a war that impacts oil, I'd like to do that. So, and while Bitcoin is relevant, it's much less relevant today because it's not the only game in town anymore. And that's what you're starting to see in terms of the asset classes and these unlocks. And then all of a sudden, you have financial institutions who are looking at the rails and saying, gosh, this is pretty awesome. If I marry this with what I have today, I can really supercharge my clients and enable them to unlock more for what they have. And that's sort of the trend that we've seen. And as a result, all of it becomes important and you start to go into detail. So hopefully that's helpful.
Thank you so much. Wonderful. Well, please join me in thanking Jana, Carolyn, and Guy for this insightful conversation. All right. Well, I'll just move from that seat over to standing here. But first of all, thank you, everyone, for two fantastic days of discussions and insight. And as we're closing this conference, again, I want to express my gratitude to all of our moderators, panelists, the keynote speakers, all the organizers of the conference for all the work that they've done, all of you for 2 days of incredibly valuable dialogue here in the New York Fed. And we started this week talking about the concept of finance at an inflection point, that theme that we've now explored. And our final session, I think, drove that home with the convergence topic, hearing about the eventual convergence of agentic AI and tokenization and potentially other technologies to inform the future architecture of the financial system. I think this conference also demonstrated the value of convening and continuous learning. So we didn't just discuss theoretical issues, we evaluated real-world opportunities across all the discussions. We grappled with the legal and operational questions of digital assets in different forms, and we weighed the risks of public blockchains against their neutrality benefits. And what stands out most from many of these discussions is the collaboration between the public and private sectors. So this is absolutely a critical path. It's a critical opportunity for us as we all try and figure these things out. And if we are to achieve our objectives of progress and safety, as we discussed earlier and throughout the last 2 days, regulators and innovators need to move forward together. So the private sector's agility and the public sector's commitment to financial stability really inform each other in a very effective way. So looking forward, the momentum that we've heard about relative to innovation in the Second District, I think remains exceptionally strong. We've seen, again, practical examples of that. The work showcased in our Innovation Expo, from fighting deepfakes and fraud to advancing real-time data transparency, reminds us that the work that's going on here is really a launch pad. So again, thank you for your time, your insights, and your dedication to shaping a safe, innovative financial frontier. Travel safely, and I hope to see you again soon.